Invest like a champion with Hamilton Champions ETFs CMVP and SMVP. Exposure to Canadian and U.S. dividend all-stars. Hamilton Champions ETFs. Zero management fee until January 2026.
A diaper this leak-free sets them free. Only Pampers Cruisers 360 have a 360 stretchy waistband for up to 100% leak-free fit on every wild child. Pampers Cruisers 360. Live wild and free.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach, one that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
Want to get the most out of one sheet? Grab Bounty. It's inspired by a dishcloth, and you can ditch the mess when you're done. Bounty, the quicker picker-upper.
Gold standard. Gold dust. Pot of gold. Solid gold. You're worth your weight in gold. Golden boy, golden girl, golden goose, golden egg, golden age, golden ticket, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
Hello there, welcome to The Open right here on BNN Bloomberg. We have a packed show for you. U.S. inflation in February dropped more than expected. That's apparently encouraging investors today. However, U.S. President Donald Trump's 25% tariffs on Canadian steel and aluminum have now come into effect. Of course, he backed down from a 50% levy after Ontario's Premier Doug Ford delayed his export tax on electricity sales to the United States. And we've got that Bank of Canada rate decision coming up in about 45 minutes' time. And the widespread expectation is that our central bank reduces borrowing costs for a 7th straight meeting, getting rates down to the lowest since the fall of 2022. Let's get to the other big stories we're bringing you from the BNN Bloomberg newsroom. U.S. President Donald Trump's 25% import levies on steel and aluminum are now in effect. And these tariffs apply worldwide. And they have triggered an immediate response from the European Union, which announced its own retaliatory measures on U.S. industrial and farm products. Meanwhile, Ottawa is expected to announce its own tariffs on more than $29 billion worth of goods today in response to the new U.S. levies. Peyto Exploration is out with its latest earnings. There's a look at the stock yesterday. It did post profit that fell 15% year over year, and it lagged analyst estimates. Natural gas and natural gas liquid sales saw a decline. Peyto notes that the majority of its natural gas contracts tied to the U.S. are actually physically delivered within Canada and would not, certainly on the surface, be exposed to U.S. tariffs. The company also sources most of the materials for its operations domestically. Shares in Groupon, well, there's a name from the past, jumping in pre-market trading. That's after the online coupon company posted revenue in its latest quarter that rose 5% year over year and topped estimates, and the company issued a revenue forecast for the year that beat Wall Street expectations. There's another look at the U.S. futures. It looks like we might get a positive open today, despite the disruption from Trump's actual tariffs and tariff threats. Let's have a look at the TSX. TSX, of course, has been outpacing the U.S. market over the past few weeks, especially because those Mag 7 stocks south of the border have come under pressure. Let's have a look at oil. Now, there was word that the White House is planning to clamp down on sanctions on Iranian oil, and that supported prices yesterday, and crude is up again this morning. Let's have a look at gold, which of course has been trading near record highs, and once again it is up, not far short of that $3,000 US level. It will be the first time it's broken 3K. There's the Canadian dollar rallying a little bit today. And let's have a look at Bitcoin, which of course has come well down from its record highs. It surged after Trump's election in November because the new administration is seen as crypto friendly. Bank of Canada expected to cut rates by another quarter percentage point. That announcement is coming at 9:45 a.m. Eastern Time this morning. Uncertainty about trade and persistent threats of U.S. tariffs are, of course, creating downside risks for the economy. Let's get more from Leslie Marks, Chief Investment Officer at Mackenzie Investments. Great to see you, Leslie. Thanks for joining us.
Good morning.
So the Bank of Canada Governor, Tiff Macklem, as you know, has said, monetary policy is not really the right tool to deal with tariff threats, but he is expected to go again, trying to prop up the economy.
Well, I think the important word that you used was tariff threats. So I think that the Bank of Canada will certainly utilize monetary policy to deal with a weakening Canadian economy. But right now, we're still in the early days of tariffs and tariff threats. And so the Bank of Canada is really responding to the historical data. And they're not going to be preemptive to try and anticipate what the real impact of tariffs could be on the Canadian economy. So I expect today we will get the 25 basis point cut. And we will, hear from a very dovish Bank of Canada about the future and the potential for utilization of monetary policy to support the Canadian economy.
It looks as though this is going to bring us, if we do get this cut, it'll bring us into the mid-range for the so-called neutral interest rate. So at that stage, the Bank of Canada won't be either stimulating or slowing the economy.
That's right. I mean, that just indicates that there's more room for the Bank of Canada to cut. And by the way, that range could really float. The range could really change if the outlook changes when it comes to tariffs and we see a huge impact on the Canadian economy, elimination of jobs, et cetera. If the unemployment rate really rises, then I think we will see a change in that neutral policy rate.
Well, that's interesting. They might decide maybe we should go even lower because that wouldn't really be stimulating the economy given all these challenges.
That's right. I mean, they're really going to offset or have to offset potential headwinds as they start to see those headwinds come through. The other area of uncertainty is we don't know the length of time that the tariffs will be in place, even if we see big tariff numbers coming in through announcements, as we've endured on a daily basis, it seems.
Let's venture into politics at our peril. Mark Carney looks set to take over as Prime Minister. We don't know for how long. Will he have an opportunity, I wonder, even to put his mark on economic policy?
Well, that's a really interesting perspective. I mean, the speculation is that Mark Carney is going to be calling an election fairly quickly. So we could see an election as early as the end of April, early May. And so to your point, he will have limited scope in that interim period because the focus is really going to be the election campaign. What I'm really interested to hear is, when you're campaigning to be a party leader, that's a very different campaign than to be campaigning in an election against other parties, most notably, of course, Pierre Poilievre and the Conservatives. So I think from both parties, once the election is called, we're going to hear a lot more around potential economic policy and how each of these potential governments will combat the threat of tariffs and bolster the Canadian economy through policy.
What do you think voters really want to hear on the economic front from the candidates?
I think what they really want to hear is that we have an incredible resource in Canada that's really untapped. And I don't just mean natural resources, I mean human capital as well. There's no question that Canada has what the world wants. And so what people want to hear is that the next Prime Minister will responsibly utilize our advantages to make us a strong country that can compete in the future and stand up to our biggest trading partner and still thrive as a Canadian economy.
I mean, it is frustrating. We've had this weak business investment for years in Canada, which implies that workers aren't being given the tools to create as much wealth as they could.
And absolutely. And, you know, we have heard from Pierre Poilievre about the focus on business investment, but we have yet to hear that really in a really strong way messaging from Mark Carney. But I think it's early days. You know, I would say let's wait and see what happens when we're on an election platform.
The market, the TSX, for once outperforming the S&P 500, as have European stocks. Do you think this is a turning? I know this is an impossible question to answer, but maybe if we put up a 10-year chart for the S&P 500, are we at a turning point for the sentiment on these Mag 7 stocks? Do you think investors have decided this is about as good as it gets?
Yeah, so funny you should say that, and you said once and for all. You know, the S&P TSX is actually, I just checked this morning, has outperformed on a one-year basis the S&P 500 on a local currency basis. Of course, if you were converting your S&P 500 unhedged to Canadian dollars, it would have a stronger return. So the Canadian market has actually surprised investors. We've seen a very significant, to your point, downturn in the leading stocks in the S&P 500. We have a couple advantages. For one, we don't have the same concentration in a few large stocks the same way the Mag 7 impact the S&P 500. So while we have seen a bit of a downturn in our technology sector, it hasn't had as big an impact. The second advantage that we have is the chart you showed earlier today, which is the close to all-time highs in gold prices. And the mining sector and gold specifically has been very helpful to the returns for the S&P TSX. So the Canadian stock market, to your question, you know, are we in sort of a new dawn for Canadian stocks? I mean, wouldn't that be fantastic and certainly unexpected? But I do think that what people are looking at today is, you know, that one-way trade of the only place to be was the United States. I think that thesis is starting to crumble here, and people are looking at other markets, and I hope that Canadian stocks and European stocks and Asian stocks continue to benefit from this changing view and shifting that we're seeing across the global world order.
What about Europe? Are you seeing opportunities there?
So I think that Europe is going to be a very interesting opportunity. The approach is a little bit different when you hear about the large defense spending and the stimulation that could have on the economy. That's very much a fiscal approach, and that's very different than what the U.S. is doing, which is saying we're moving away from fiscal towards business. But that does tend to be good for the economy. Whether you agree with that as good, sustainable, long-term policy is another question. But in the short to medium term, it certainly does have a multiplier impact on economic growth. So I think that the outlook for Europe is improving, and the market is getting that actually right.
I mean, yeah, it is. Socially, it's a shame that we're wasting money on weapons, but that's the new world we're in, it seems.
Yeah, I think we're in a very different world now where capital allocation might become actually very efficient. You look at what the U.S. is expecting of their domestic manufacturing industry. They're asking them to build facilities within the United States when they already have facilities in other parts of the world. It's not like capital is free. It's not like capital is easy to access. And shareholders demand prudent capital allocation decisions. And so what you could see is an inefficient allocation of capital as a result of duplication of building out plants and facilities in the United States right now.
Just to pander to Mr. Trump.
Exactly, yeah.
What about China? Do you see opportunities there?
So China's been really interesting. It's certainly been benefiting from the AI trade. It's sort of ironic, as we've seen the Mag 7 really negatively impacted here in North America and United States specifically. China's kind of gone the opposite way. You know, with DeepSeek, we're starting to see a lot more interest in Chinese AI plays. And you have the Chinese government, which, of course, is also thinking more fiscally about how they can stimulate their economy and fight back against tariffs. It's very much an export-driven economy. And so we have sort of this bifurcation of one part of the world that's very focused on moving away from fiscal, and then almost the rest of the world moving towards fiscal stimulus.
Sorry, give me that again. Sorry.
So you know, what we're seeing is places like China, similar to Europe, will be looking at more fiscal stimulus for their economy, as opposed to the U.S. shift, which is away from fiscal towards fighting that deficit and bringing that number down so that they can trigger or stimulate business investment. China, Europe, for example, will be doing the opposite. And in the fullness of time, we'll have to see what Canada does.
Leslie, thank you very much. Leslie Marks, Chief Investment Officer at Mackenzie Investments. Coming up, we are going to drill into those inflation numbers out of the U.S. The increase was less than expected, and it looks like equity investors are encouraged. We've got Bloomberg's Vince Signorella up next.
The Open is brought to you in part by Canaccord Genuity Wealth Management. Wealth Management Reimagined. Discover more at wealthreimagined.ca.
Bitcoin is surging as major financial institutions rapidly integrate it into their portfolios.
Bitcoin since the election has gone from $60,000 to $100,000.
Deregulation across the nation means strong support for Bitcoin, and Hive is thriving. Hive is positioned to quadruple their global footprint in 2025, aiming to capture 3% of the world's Bitcoin supply. Hive Digital Technologies.
A diaper this leak-free sets them free. Only Pampers Cruisers 360 have a 360 stretchy waistband for up to 100% leak-free fit on every wild child. Pampers Cruisers 360. Live wild and free.
It happened on March 9th at 6:17 p.m. First to arrive was Marco, who came by way of train with his plane and first dog, Minnie. The Maui's made it en route to their regional curling championship / family vacation. Self-proclaimed content queen Quinn, well, she'll share how she managed to make it shortly. So how did the never-available host Julie make the unplannable happen?
Find the best time for group dinner and add to calendar.
Plan the unplannable with Samsung Galaxy AI on Bell.
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
We just got U.S. inflation numbers for February. U.S. consumer prices were up 0.2% last month, and that was the slowest in 4 months. Shelter costs helped out there. But, of course, any hiking in prices because of tariffs lies ahead. Let's bring in Bloomberg's Vince Signorella. He is the voice of Bloomberg Global Macro Squawk. Thank you very much indeed for joining us, Vince. So it is kind of the calm before the storm, isn't it? It looks as though some prices will come up in a tariff war.
Yeah, I mean, and the problem with this data is as good as it looked on the surface, is February data doesn't really take into account the tariffs. I think we're going to need another month of data to see what that looks like. One thing I wanted to put on everyone's radar is we get retail sales on Monday, and it's February data as well. But I think we need to start looking at the consumer data to see if they're starting to bring forward purchases in anticipation of the tariffs. That would be a good indicator of maybe what inflation effects we're going to see down the road and what growth we're going to see down the road. Whether people are going to be borrowing from the second quarter to bring to the first quarter to avoid the tariffs that are certainly coming. I mean, this is not something I think we're going to see go away. Either this administration is going to impose tariffs or they're going to ask countries that have tariffs on the U.S. to either drop them or reduce them considerably. So one way or the other, we're going to get some sort of a trade war, and it's definitely going to be a lose-lose for everyone.
It's interesting, you guys reporting today, your colleague Thomas Seal saying that world leaders from New Delhi to Brussels are watching Canada's pushback on the tariffs to see, is this the right way? Is there too much risk of provoking Trump, for example?
I mean, right now, literally as we speak, we're seeing Howard Lutnick speak, and he's saying auto tariffs are coming on April 2nd, but they are going to negotiate with all of Canada. So we're getting information out right now in terms of those tariffs, and essentially they are coming.
So they're not backing down on that when so that's, of course, the U.S. Commerce Secretary, Howard Lutnick. Yeah. I mean, on the face of it, it's just shooting yourself in the kneecaps, isn't it, really, putting tariffs on autos?
It seems that way, but, what they're really trying to do, and I think people really need to get this and understand this, is the $1 trillion trade deficit that Trump sees. He sees that as the U.S. Just giving money away to the rest of the world. He wants to change that completely. He doesn't want to see growth in the U.S. driven by government spending, wants to see it driven by private spending. And in his mind, putting tariffs brings home to the U.S. manufacturing, et cetera, that'll bring that capital expense from the private sector to the economy. And at the same time, with his DOGE, is reducing government spending. So he's trying to flip what happened with globalization from the 90s to now in the last 30, 35 years or so. And it's going to be painful, and it's going to be painful for everyone.
Just finally, we've got our interest rate decision coming up, as you know, in less than half an hour's time, widely expected to bring it smack down into the neutral rate, the core borrowing cost. Bank of Canada, though, it's tough for them. I mean, they can only do so much. Tariffs are an extraneous factor, an external factor that's so hard to predict.
Yeah, I mean, monetary policy is not really the right tool to deal with tariffs, but it's come sometimes for the bank. I mean, obviously, that's all they have to keep things loose. They're obviously expected to cut rates by 25 basis points. Typically what we saw over the holidays was low inflation and a surprise uptick in growth, and you would expect the Bank of Canada to stand pat at that time. But in this situation with tariffs coming, I would expect that they will go through with the 25 basis point cut.
It's interesting. Politico, and of course we're talking politics, says that some Trump allies are frustrated with Lutnick, the Commerce Secretary, and that in some of his TV appearances, he's demonstrated a lack of knowledge as to how tariffs actually work.
I'm a little frustrated with him myself. I've had personal dealings with Howard, so I can understand the frustration. I mean, he's still speaking now, and he's moving markets, to be honest. He's talking about steel tariffs, gasoline, copper. Yeah, I can understand that. There's definitely going to be a few loose cannons going off, I think, in the Trump cabinet that's going to keep people on their toes.
Thanks, Vince. Thanks very much indeed. Vince Signorella. Bloomberg, Trump's tariffs on metal just kicked in. We'll have more on that when we return.
The Open is brought to you by Emirates. Fly Emirates to Dubai and beyond to over 140 destinations from Toronto and Montreal. Fly Emirates. Fly better.
Inheriting a property can be a life-changing experience. There's a lot to get a handle on. And what you choose to do with the property could come with some tax implications. Should you keep it, there's no immediate tax impact. That's because there's no inheritance tax in Canada. But be mindful that there could be tax implications for the deceased individual's estate, depending on how they use that property. Should you sell it later, you may be subject to capital gains tax if you didn't use the property as your principal residence. And should you choose to rent it out, you'll have to report your rental income, but there are certain expenses you may be able to deduct, but be aware of new short-term rental rules. And consider working with an advisor who understands you and your unique situation. I'm Kim Parley, and that's your Money Talk Minute.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
A revolution is happening in sports nutrition, and investors are taking notice. Sizzle Brands is seizing a fast-growing market, delivering premium hydration and nutrition worldwide. With a retail presence growing by the minute, Sizzle is expanding rapidly, outpacing all new brands and market share growth. Now trading on the CBOE under the symbol CZZL. Sizzle Brands is quickly shaping the future of sports nutrition.
Closed captioning of this BNN Bloomberg program is brought to you by Sizzle Brands, one of North America's fastest growing sports nutrition companies, trading on the CBOE under CZZL.
Trump's 25% tariffs on steel and aluminum imports from Asia, Europe, and, of course, Canada have come into force. Now, those latest levies come after a pretty chaotic day. Yesterday, the White House said Trump would not follow through on threats to double tariffs on Canadian steel and aluminum. He was talking about 50%, and that's after Ontario agreed to pause a surcharge on electricity exports to the U.S. Let's get the latest from CTV's Scott Hurst. It's kind of like watching a tennis match, isn't it, Scott?
Andrew, it's sometimes hard to follow so much back and forth, particularly as you mentioned yesterday. We'll get into that in just a moment. But first and foremost, Canada's response to these tariffs is that they are unjustified tariffs against steel and aluminum. And we will get a more detailed response from the government of Canada in less than 1 hour, as Dominic LeBlanc, the finance minister, Mélanie Joly, the foreign affairs minister, and François-Philippe Champagne, the industry minister, will outline Canada's response. They're expected to talk at around 9:45 Eastern time this morning, so that's coming up in less than 1 hour. But according to Reuters, it's expected to be in line Canada's response with about $30 billion in retaliatory tariffs because of the 25% tariffs that have now been imposed on Canadian goods and goods from around the world on steel and aluminum, as the U.S. has now imposed these 25% tariffs that, as you mentioned, will affect all countries, including Canada. But Canada will be significantly impacted, as Canada is the largest supplier of U.S. steel and aluminum. It is a major move, of course, by the Trump administration, sending shockwaves through the global economy, as Trump has constantly complained, Andrew, that America is getting ripped off by its trading partners. And so that is why he says he wants to continue the push to bring jobs back to America and impose these tariffs, not just on Canada, but on steel and aluminum from around the world, Andrew.
And Howard Lutnick, the Commerce Secretary, saying today that once again, really sounding this note, that Canada has to work with the U.S. to integrate the two economies. So they're not backing down from that thing either. Just give us the latest. Doug Ford showed up on the radar yesterday, didn't he? The Ontario Premier.
And this is the back and forth that you were talking about that was quite dizzying yesterday. These latest tariffs of 25% come into effect as yesterday. The Trump administration was threatening 50% tariffs on Canadian steel and aluminum as the U.S. President and Ontario Premier Doug Ford went back and forth with threats yesterday online and on TV as Ford agreed to back down on the 25% tariff on energy exports to 3 states as he was able to secure then a meeting with U.S. Commerce Secretary Howard Lutnick, and he plans to go down to Washington on Thursday. And because he backed off, we did hear from the U.S. President yesterday afternoon praising Ford for backing off that threat, calling him a strong man and a gentleman. So we're expecting to have Ford go to Washington tomorrow.
Thanks very much indeed, Scott. Scott Hurst of CTV News. Up next, the opening bells.
Focus on your goals. Trust in our ETF experience. BMO has been offering ETFs to Canadians since 2009. BMO ETFs. Build on trust. Learn more at bmogam.com/ETF.
Did you know the first signs of aging start around your eyes? Try Olay Super Eye Serum, the serum that targets top eye concerns. It hydrates, brightens, refreshes tired eyes, and improves fine lines and puffiness. Try Olay Super Eye Serum.
On a $100,000 margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
Hi, I'm Jim Gordon. You're watching Market 1 Minute. Joining us is Kit Mars, Western Alaska Minerals. Talk about the company's unique investment opportunity.
Well, what really makes us special and unique is really 3 things. One, we have the potential for very large scale. Second is very important. We have one of the highest grade silver deposits in North America. And the third is jurisdiction, which is becoming very important today. We're on 100% state of Alaska land.
Tell us more about your assets.
We have, again, a very unique position. We have a large carbonate replacement deposit system. What sets us apart is we actually have 2 resources, one at either end, the high-grade silver at Water Pump Creek, 75 million ounces of silver equivalent, and also 500,000 ounces of gold at the past-producing Illinois Creek mine.
Kit, thanks for joining us.
Thank you.
The rubber hits the road on a new season of F1 on TSN.
I have missed this. This is so close. Brilliant. This is Formula One at its absolute finest.
And it all fires up down under.
Welcome along to the Australian Grand Prix.
On TSN and TSN Plus.
Okay, so trading has started on Bay Street and Wall Street. You can see the festivities going on there. Let's start off with a look at the big North American benchmarks. And we did get an indication of a positive open earlier from the U.S. stock futures. Inflation actually dropping in February more than expected in the United States. And you can see we are moving up this morning. However, it's been a rough go, as the Australians call it, for U.S. stocks over the past while. And we are, of course, counting down as well. You can see we got our clock there in the bottom left of your screen for that Bank of Canada rate announcement. Another cut in borrowing costs expected at 9:45 a.m. Eastern time today. A couple of stocks that are on our radar. Let's have a look at some of the Canadian metal players. This tariff kicks in 25%, sure enough, the American import levy. However, Trump did back away yesterday from his threat to impose a 50% charge on Canadian metals. And of course, this 25% levy on metal imports into the United States applies to all kinds of worldwide suppliers, not just not just Canada. So let's have a look now at the Canadian banks, always an important driver of returns for our market. Not a great clear pattern there. You can see TD losing a little bit of ground. Now, Canadian tech stocks have been under pressure over the past, thank you, Control Room. Canadian tech stocks have been under pressure over the past week, notably Shopify. You can see it is rallying a bit today. And Celestica, too. Celestica has seen a lot of selling amid fears that this AI-related build-out may not be as big as investors had hoped. Let's check out a couple of smaller stocks in Toronto. Labrador Iron Ore, TD is cutting its rating on that stock to hold after Q4 results. TD says that it is concerned about the macroeconomic impact on steel demand and escalating tariff risks. And of course, that company gets a royalty, has a piece of the revenue from Rio Tinto's giant iron ore operations in Canada. And there is Step Energy Services. That one is down about 3%. This is a big provider of frac sand, that special sand for breaking up rocks way below the surface, or helping to hold the cracks open so you can get the oil and gas out. The company is winding down its U.S. frac sand operations, and Raymond James said that this could be viewed negatively. Okay, so we've got those two stocks on the move. Let's get more for shares of interest south of the border. We are joined by Bailey Lipschultz of Bloomberg. Bailey, go ahead, please.
Yeah, Andy, want to start with a deep loser this morning, and that is iRobot. Now, really a tiny company, but not too long ago, this was a company that was going to be acquired by Amazon for more than $1 billion. So going from a takeover darling to a company that was kind of cast aside after U.S. regulators shot down and did not approve that deal. Now the company missing expectations dramatically, canceling their earnings call to discuss the quarter and the year ahead, and then also warning having a going concern warning, which means that they aren't sure that they will be in existence a year from now. As you can see, down 36%. This is a company that is tiny. Again, at one point not too long ago, takeover target, now potentially at risk of going bankruptcy according to their filing. Canceling an earnings call is never a good look, so certainly one to keep an eye on. Again, maybe consumers know them, Roomba, vacuum makers, kind of those robot vacuums, but again, barrier to entry maybe not as high as the company was hoping for, and sales and expectations nowhere near what they once were.
That's interesting. So it could be cheaper products, I wonder, coming out. Yeah, these things, yeah, that's capitalism. You attract rivals. What's going on with GE Vernova, please, Bailey?
Yeah, this is a company in the cleaner tech space, was spun out of GE, typical General Electric, now GE Aerospace. They split that company into 3 businesses. But right now, GE Vernova, adding to recent gains, had rebounded yesterday. So a 2-day rally after management struck a pretty optimistic tone in a few interviews with Bloomberg and in panels at a key industry conference over the course of the last few days. So we are seeing investors piling back into the company. It was one of the best performers of those large cap stocks in 2024. So working back towards where it once was. Obviously, all eyes on clean tech, energy, especially with this Trump administration, what that can mean. So certainly a name to keep an eye on. Again, being separated from GE proper really in the last year and change.
And finally, what's going on with Intel, please, Bailey?
Stocks rallying this morning, but if you look at it on a 12-month basis, really struggling to get back to where it once was, still down more than 55% on a 12-month basis. This comes after Taiwan Semi, according to reports, had been floating potentially joint venturing for the foundry division, so partnering with NVIDIA and others to help actually make the chips, righting one of the wrongs that has been plaguing Intel as it's been left cast aside by investors who have been chasing all things AI. As you can see, the stock up more than 4.5%. Again, really trying to rebound back to where it was, but still a story that is going to take quite some time and quite some heavy lifting from management to get things right. But again, that report from a Bloomberg competitor coming out saying that Taiwan Semi has been talking to chip makers, again, trying to kind of make an inroads with Intel and help build out their foundry to help kind of build chips here in the U.S.
Bailey, thank you very much indeed for joining us, Bailey Lipschultz. Let me just clarify something. I got mixed up there. Step Energy Services, sure enough, the company is winding down its operations, but they're not a player in frac sand. They are a player in general fracking services. That's Step Energy, STEP, seeing some selling as that company gets set to wind down its U.S. operations. But it looks like they're not a player in actual frac sand. It's more general services for fracking. After the break, we're going to get more on the markets with the chief market strategist at Calbay Investments.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me or is there some kind of clue here? I don't know.
Did you know cold viruses often start in the nose before they spread and make you really sick? Try Vicks Early Defense Nasal Spray. When used at the first sign of a cold, Vicks traps, blocks, and removes cold viruses at the source. When you can't afford to get really sick, always have Vicks Early Defense Nasal Spray on hand.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
Investors have had an unpleasant experience this week. The S&P turned into negative territory. However, investors have an opportunity here. According to our guest, let's bring in Clark Garanan, Chief Market Strategist at Calbay Investments. Thank you so much indeed for joining us. I guess that's the odd thing about the market. When the going gets tough, the tough get going, and you can find bargains potentially.
Yes, absolutely. We do see this as an opportunity. With the S&P now down over 5% year to date, and we've had the 10% drawback over the past 20 days, really we've been seeing this as an opportunity. At the end of 2024, we did see a rollover from the large cap growth names into value names, which now we've seen NASDAQ down over 10% year to date, and even more so since the peak. As we've seen, this has played out in the equal weight S&P 500, which is only down less than 2% and not getting hit nearly as much as the market weight S&P has been. Right. So we do feel that this is an opportunity. When we've seen these quick pullbacks like we have over the past 20 days, the other 5 times that this has happened in this short of a window, last time was in 2020. And in all of those circumstances, positive gains in 3-month, 6-month, and 12-month. So we do think that that sets some nice precedents heading into this year.
Give us that number again, if you would. So a bearish performance leads pretty reliably to gains. Give us that number again, Clark, would you?
Sure. So over the past 20 days, there's been a 10% pullback in the S&P 500. Okay. Which is one of the 5 fastest pullbacks of 10% or more. So from the 52 weeks high that we hit back in February, we've had a greater than 10% pullback. Of the other 4 times that this has happened, the 3-month, 6-month, and 12-month performance off of those lows have all been positive returns.
That is the good news. What about the Mag 7? I know it's a very broad group, but are you seeing attractive opportunities there in these tech giants?
Sure, there are. Well, we have seen Apple hold up recently, and sometimes they trade conversely to the rest of the markets, but not that we're out of the Mag 7, right? At the end of 2024, we did have to perform a rebalance, and the old adage, pigs get fat and hogs get slaughtered, and so we saw that so far over the past 2 months in the NASDAQ. So I wouldn't say we're underweight. At this point, we're just equal weight Mag 7 and going to hold on to those positions for the long term.
Clark, thank you very much indeed. Really appreciate it. Clark Garanan joining us there, a chief market strategist at Calbay Investments. Coming up, we are counting down to that Bank of Canada rate decision, and we have a panel of experts lined up for you to break down the announcement. We'll return right after this.
Closed captioning of this BNN Bloomberg program is brought to you by Helium Evolution, unlocking Canada's helium potential, trading on the TSX Venture under symbol HEVI.
Are you selling a business worth $25 million or more? Let Stenner Wealth Partners put your hard-earned liquid capital back to work for you. Contact us today in complete confidence. We'll be here when you're ready.
What keeps baby's skin healthy? A diaper that doesn't leave skin wet. That's why Pampers Swaddlers absorbs wetness better for up to 100% leak-proof protection and 0% skin irritation. Pampers, for healthy baby skin.
Do you need financing for your business? Get up to $800,000 in less than 24 hours from Merchant Growth. Apply online today and get your no-obligation quote. Trusted by over 10,000 businesses, Merchant Growth is Canada's leader for convenient business financing. Apply now at merchantgrowth.ca.
The Harvest Diversified Monthly Income ETF. Consistent monthly income. The Harvest Diversified Monthly Income ETF. HDIF on the TSX.
Introducing the Brompton Cash Flow Kings ETFs. Investing in high cash flow yielding companies, putting their power to work for your portfolio. Brompton Cash Flow Kings ETFs. Because cash is king.
AEW Collision, Saturdays at 8 Eastern, 5 Pacific on USA Network.
Bank of Canada decision is imminent. We've got two heavy hitters joining us right now. Ed Devlin, founder of Devlin Capital, senior fellow at the C.T. Howe Institute, former head of Canadian Portfolio Management at PIMCO, and Warren Lovely, chief rate strategist at National Bank of Canada. Guys, thanks very much indeed for joining us. Warren, just very quickly, if I could, you are expecting a rate cut that would bring the Bank of Canada right into the middle of neutral rate territory.
That's right, us, and I think pretty much everyone, Ed, probably as well. So it'd be the right call, given the amount of uncertainty we have. I guess to some extent you could call it a bit of an insurance move at this juncture, but we're facing, I think, an existential threat to the Canadian economy, and moving a little bit lower into neutral is just the right move at this time.
Even though Tiff Macklem did indicate, Ed, a while ago, you know, monetary policy is not that suitable a tactic or a tool when you're dealing with a tariff war.
Exactly. But that, yeah, so what'll be interesting to see today is, you know, what role the Bank of Canada thinks they're going to be in playing this Team Canada, you know, response to the tariffs. You know, I think that'll be the kind of the interesting thing to watch today.
It's quite, they're strange times, aren't they? The Commerce Secretary, Howard Lutnick, south of the border, saying Canada needs to integrate with the US.
Haven't we already?
Yes, good point. Okay, so we are getting the decision from the Bank of Canada right now. And there is the Canadian dollar. And the Bank of Canada is cutting rates, bringing it down as expected. The dogs in the street were barking this, 25 basis points, bringing the core rate to 2.75%. Warren, no great surprise, but we haven't read the commentary.
Right, no real surprise, and I think Ed's already touched on it. It'll be interesting to hear what the governor and the senior deputy governor have to say in defending this. I think we all agree monetary policy, not a perfectly calibrated tool for a trade war. We know there's some inflation fears that come when we're in a beggar thy neighbor, you know, full-on retaliatory trade fight. So they're, I'm sure, mindful of that. But at the same time, we risk economic paralysis here. So not appropriate to be at 3%. I guess the real question will be how far down do interest rates need to go in conjunction with what we fully expect will be a government fiscal policy reaction as well. I think it's going to be all hands on deck. to be frank.
That's interesting, yeah, because Ed, I think we've heard talk it could be a COVID-style stimulus package for the economy.
Yeah, I'm not sure. I think it'll be hopefully better. I think Mark Carney has a better understanding of economics than Justin Trudeau does, so I think it'll probably be better. It'll be interesting now that you have a former Bank of Canada governor setting fiscal, and the Bank of Canada. So I agree with you that similar to COVID, there will be a coordination between the fiscal and the monetary agents, and how that works out. That'll be key. I think that's what I'm looking for today. The balance sheet. What do they do with it? If nothing, do something. It'll be interesting to see.
Oh, you mean, sorry, quantitative easing measures, maybe?
Correct. So what basically happened during COVID was, the massive amount of fiscal spending to support, vulnerable people, and the Bank of Canada said, we'll fund it for you. You issue them, we'll buy them, right, kind of thing. So do we have something similar to that? I've been a big advocate, and the central banks hate it, and they're not probably going to do it, but they should. They just won't. They should be engaging their balance sheet before they get to the zero lower bound. Right, because normally the order of operations is get the interest rates as low as they can go, and when that bullet has been spent, then they turn around and use the balance sheet, right? And I think that is probably, I think when you get to the zero lower bound, bad things happen. There's unintended negative consequences that happen. So it's probably better to do that before you get to the zero lower bound. So if you have to engage the balance sheet, do it earlier. That is my suggestion or recommendation. It is not my forecaster.
Well, you mean bad things happen when you bring interest rates down drastically, such as asset bubbles?
Exactly. All kinds of asset bubbles. You get things like, the potential for more of a deflationary spiral, inability to handle shocks, because you can no longer cut anymore because you already spent all your bullets. So financial stability issues. There's lots of things that happen that are just nasty. You get ask the Bank of Japan, kind of thing. So I think that it would be my recommendation. And these are unprecedented times. This trade war we've got with our closest friends and neighbors. So will they think outside the box? I don't know. I hope so.
Warren, is there a risk that if we do keep bringing down interest rates, that people will just start saying, well, the heck with it, I'll just bid up houses, I'll put my money into real estate, and we'll get into...
Well, theoretically, yeah, but you do need to see confidence. You do need buyers to have confidence in the economic outlook, their own job prospects. So this is where it's a little bit, it's a little bit more of a nuanced conversation, right? So at this juncture, we have, the irony here is we had some signals that the Canadian economy was starting to show some signs of life in response to earlier interest rate cuts. We had seen some firming in GDP. Inflation was had a little bit of a heartbeat to it below the surface. So on its own, if you could somehow suspend the tariff discussion, set aside geopolitics for just a brief moment, it's not so clear that we need drastically lower interest rates at this juncture, but you can't suspend it. We know that we face this threat. It's hard for Canadians to be confident in where the economy is going. It's hard for them to be confident in their own finances. And as a result, lowering interest rates, if we get some relief in mortgage interest rates, I'm not sure it's going to bring about this tidal wave of enthusiasm for housing markets and housing prices. So the fear of setting off some asset bubble here, I think, is it's really not a non-existent threat, to be frank.
That's interesting because, I mean, obviously, politically, it would be unpopular if affordability dropped off and governments are allegedly making it easier to buy a house.
Right. Well, I mean, I think the question is you make the right policy decision for that moment in time. And in an ideal world, you like to be forward-looking as well. And that's where I say, on a forward-looking basis, we've really lost a lot of confidence, I think, in the economic road ahead here in Canada. What business is going to be investing in the Canadian economy right now when you're not even certain you can access the United States, right, that you can integrate that with in a North American context? So I think we're going to see business investment in the deep freeze. We're already starting to see some signs of weakness, paralysis, as I say, in the housing market. Confidence channels risk being broken here. So the right decision for today was to lower interest rates. I don't think we're done here. And Ed, I think you share this opinion as well. I mean, I think the debate is how low do we need to go on interest rates to improve our economic prospects and maybe encourage the economic transformation that, again, we all kind of agree we're probably going to need, particularly if access to the U.S. market is not going to be as reliable as we'd like it to be.
So Ed, if we go on, if the Bank of Canada goes on cutting rates, we're going to move towards negative real interest rates, I guess.
That's right, exactly. So put it this way, if we, if they can get inflation down a bit to their target, and then, like I've kind of been saying literally for a year or so, they're going to go to 2. And I still kind of hold that. And I think market right now is priced to 2.25. So it's largely been priced in now. There's no magic to 2, but 2 is a 0 real interest rate, right? Where you're just getting the rate of inflation on your cash kind of thing. To me, that's the logical place to be. So yeah, but I think the more important thing is the central banks in general, Bank of Canada included, have this concept of what I call risk management. What is their left tail risk and what is their right tail risk? Where is there a skew kind of thing? And I would be very interested in hearing from the bank how they think of tariffs from a risk management perspective. Because if you think about it, it's probably likely that this is going to go on for all 4 years of Donald Trump. Do you think he's just going to say, "Oh, that's done, I'm out," right? I don't, kind of thing. And to Warren's point, we've permanently degraded the U.S. as our counterparty, as an economic counterparty. They've reneged on their deal, right? So logically, and Carney said this in his speech on Sunday, is time to diversify, time to move to other kinds of markets. So what does the Bank of Canada think its role is in that plan? And I think these would be the kind of really interesting things to hear from the bank on.
Oh, I mean, so we've got at least, our incoming prime minister saying we've got to diversify our exports. I mean, there's nothing new there. We've heard that for decades. Meanwhile, south of the border, they're saying, no, you've got to integrate.
More closely integrate. Yeah, I mean, I sympathize with policymakers, monetary and fiscal, at this juncture, because this is a really extraordinary amount of uncertainty that we're dealing with. It's not really clear. You don't necessarily get the same message, the same signal from U.S. administrators from day to day, right? So the playing field is kind of moving under our feet to some extent, which makes it very, very difficult. The type of sort of diversification and economic transformation that Ed is alluding to, I mean, to some extent, and I agree, I mean, you want to understand what the Bank of Canada views its role in that type of transformation. But I think it's also clear that political leaders, elected officials, prime ministers, and premiers have a major role to play here as well. And Ed touched on balance sheet from a central bank perspective, but think about the balance sheet from a government perspective. We're probably going to need to be using whatever balance sheet room that we created earlier as we retool the Canadian economy.
Big deficits then, or bigger deficits?
Well, arguably, yeah. I mean, and I don't think this is going to be unique to Canada, to be honest. I mean, we're seeing this in other jurisdictions. Look at what Germany's doing, right, in terms of a transformative investment in defense and infrastructure. We're going to need to take these types of probably extraordinary, what will look like in a historical context, extraordinary actions to set us up down the road. What you hope is that political leaders look through maybe an electoral cycle or two, make those big long-term structural decisions that we're going to need as Canadians, because the old rules don't apply. The old rules of engagement are gone. I like the way Ed put this. I mean, the U.S. has reneged on the deal. I mean, I think that's the right way to think about it.
This reminds me of back in 2008 when I was trading derivatives with Bear Stearns and Lehman Brothers. When they started to get bad news, what's the thing you do? You remove your risk to the counterparty, right? Like, that's what you do. And, we've got bad news from our trading counterparty. I'm going to remove, as much as I can, remove that risk. That's what any logical investor would do.
Let's dip in here, sorry guys, because we've got the Finance Minister, Dominic LeBlanc, and the Foreign Affairs Minister, Melanie Joly, holding a news conference right now. Let's have a quick listen.
Injuries. We remind all in-person participants to keep their earpieces away from all microphones at all times. When you are not using your earpiece, please place it face down on the middle of the sticker for this purpose that you will find on the table. Please consult the cards on the table for guidelines to prevent audio feedback incidents. These measures are in place so that we can protect the health and safety of all participants, including the interpreters, and conduct our business without interruption. Thank you all for your cooperation. We have with us today Finance Minister Dominic LeBlanc, Foreign Affairs Minister Melanie Joly, and Industry Minister
those ministers getting set to announce what's expected to be
and then
a whole bunch of new tariffs and almost $30 billion worth of trade between the United States and Canada.
Spoken to you, let me know that you will have a question.
And there's Melanie Joly, the Foreign Minister.
For 20 minutes myself, and then the others could share the rest of the time.
I think we're hearing from...
That's a joke. Bonjour,
Dominique
bonjour
LeBlanc
à
first,
tous et à toutes. Plus tôt aujourd'hui, les États-Unis ont imposé des droits de douane de 25% sur les produits d'acier et d'aluminium du Canada. Ces tarifs, comme on l'a toujours dit, sont totalement injustifiés, injustes et franchement déraisonnables. As has been the case since the American president first threatened to put tariffs on Canadian exports to the United States, our sole focus is to stand up for Canadian interests, Canadian jobs, and Canadian workers. It has been extremely heartening to see Canadians from across the country rally to this cause in defense of Canada. I would also like to thank the premiers from across the country for their work on these important matters. I know Canadians are proud to see their governments stick up for their respective provinces and territories, and also, of course, stick up for the whole country. Together, we will do what we must do to protect Canada's economy. With these most recent tariffs on Canadian steel and aluminum, the U.S. administration is once again inserting disruption and disorder into an incredibly successful trading partnership and raising the costs of everyday goods for Canadians and American households alike. We will not stand idly by while our iconic steel and aluminum industries are being unfairly targeted. Today, I am announcing that the Government of Canada, following a dollar-for-dollar approach, will be imposing, as of 12:01 a.m. tomorrow, March 13th, 2025, 25% reciprocal tariffs on an additional $29.8 billion of imports from the United States. This includes steel products worth $12.6 billion and aluminum products worth $3 billion, as well as additional imported U.S. goods worth $14.2 billion for a total of $29.8 billion. The list of additional products affected by counter tariffs includes computers, sports equipment, and cast iron products as examples. These tariffs are in addition to Canada's 25% counter tariffs on $30 billion of imports from the United States in response to U.S. tariffs put in place on March 4th. In addition, we learned yesterday that the United States tariffs would also be imposed on steel and aluminum content in certain derivative products. The government is currently assessing this aspect and may impose, of course, further tariffs in response to this measure as well. Aujourd'hui, j'annonce que le gouvernement du Canada, suivant une approche dollar pour dollar,
following a dollar-to-dollar approach, will impose from midnight and 1 minute tomorrow, March 13, 2025, reciprocal 25% retortion tariff on $29.8 billion coming from the United States. That includes products, steel, the value of $12.6 billion, aluminum products, $3 billion, American products, supplementary products for $14.2 billion. The total value of $29.8 billion.
Okay, so we're hearing the Finance Minister, Dominique LeBlanc, talking about, as expected, Canada moving ahead with levies on almost $30 billion worth of goods from the United States. Warren Lovely, as expected. We got to hit back, I guess a lot of people would say.
Well, as expected, but extraordinary at the same time. Right? In terms of just the circumstances that we're in now. You know, we're just kind of further down the rabbit hole. In terms of trade action, retaliation, hitting back, punching each other in the face, economically speaking, right? And I think what we can assume comes of this is economic destruction, loss of confidence, loss of wealth, loss of opportunity. For Canada, also, I think you've heard a lot of Canadians argue for America as well. No one wins in a trade war. I think, again, that's kind of what the theory and past practice tells us. So as expected, and I tend to agree, I mean, you need to retaliate to unfair action. But really a sad, continuing sad story in what is likely to be a sad saga. And I, again, agree with Ed. I mean, where's the likelihood that the U.S. changes tactic here anytime soon? I don't really see that.
Yep.
We have heard that, tariffs, that Trump's rhetoric is a bargaining tactic, but it could be more serious than that.
Who knows what goes on in that man's mind? I mean, seriously, this is just bad policy, period, full stop. So, if he wants to implement bad policy, God bless, the markets will reward him for it, kind of thing by punishing him. I think that I agree with everything Warren just said. I'd say one thing though, like we'll see, what we want is just to go away, right? That's what we want. We want no trade war. We want to just go back to more of a free trade type of arrangement if we can. I would have a minor point of contention here with what they just announced, which was dollar for dollar. I would say GDP weighted would be the right way to do it because, think about it, they're 10 times bigger than we are. So they're punishing us. They're punching us in the face and we're slapping them on the wrist.
On a per capita basis, right? It's much harsher. Yeah.
So we are 10 times smaller. We're much more open. We're an open economy. Trade is a much bigger part of our economy. They're a large closed economy. If you want to get their attention, I think there has to be a bigger response. That being said, as an initial response, I think it's fine. And because what we really want is not to escalate this into, the 1930s, again, kind of thing. What we want to do is, can we give him a face-saving way? We'll tell, him how brilliant he is, and he won and he beat us, and whatever we can say, dear leader. And then, hopefully get back to business as usual. But by the way, even if that optimistic scenario played itself out, and I don't think it will, or might, we'll still always have that threat. So we still, economically, Canada has to reorient itself over the longer term, not to be more integrated with the U.S., to be less, because they've proven themselves a bad trading counterparty.
Have we been complacent in economic policy over the past few decades in Canada? For example, our median income now lagging the Americans significantly, it seems.
Yeah, I mean, I think whether you want to call it a lost decade or maybe you're invoking lost couple decades, yeah, I mean, I think to be fair, yeah, you can look back here and go, yeah, missed opportunities, significant missed opportunities. We've really put the Canadian economy on a long-term trajectory that's just less competitive, less compelling jurisdiction to do a marginal investment, and we've seen that, the hollowing out of once proud traditional drivers of economic activity. And I mean, you look for proof in the data and you see it manifest, right? GDP per capita declining, no productivity growth. Again, difficulties attracting and securing marginal investments. And we've had some growth, we've had some job creation, there has been some wealth creation. It's been missed opportunity. We could have had much more of it. And as a result, we're entering into this now geopolitical uncertainty period from a position of weakness.
And I'll be blunt, and sorry.
Finish your thoughts, Ed, if you would.
I'll be blunt. The Trudeau era has been about running big deficits for redistributing wealth and, to borrowing from others and not growing the pie. And that's what leads to this kind of situation. High taxes and disincentives for economic risk-taking.
Guys, I think we have to jump. Thank you so much for joining us. Ed Devlin, founder of Devlin Capital, Senior Fellow at the C.D. Howe Institute, and Warren Lovely, Chief Rate Strategist at National Bank of Canada. I think we're handing it back now to the Foreign Minister, Mélanie Joly.
In also the Sioux, in Regina, in Kitimat. People working in the steel and aluminum sectors. Pour nos travailleurs et travailleuses dans l'industrie de l'acier et de l'aluminium, nous sommes ici pour vous. Nous avons pris des mesures fortes en 2018.
We took strong measures in 2018 when Trump president imposed tariffs, and we will keep on doing so. They are not justified in 2018, and they're not justified today either.
and best ally. Many of us have family on both sides of the border. Canada is also America's best and biggest customer. We buy more American goods than the UK, France, China, and Japan altogether. Together, we have spent generations building a relationship between our countries that is the envy of the world. Canada is not the one driving up the cost of your groceries or of your gasoline or any of your construction. Canada is not the one putting your jobs at risk. Canada is not the one that is ultimately starting this war. President Trump's tariffs against you are causing that. And there are no winners in a trade war. American friends, help us help you. Please help us end these tariffs as quickly as possible. And please talk to your elected representatives at the federal, at the state and municipal level. Please talk to your governors, to your senators, to your House representatives, and to your mayors. Send the message to the White House. Working together, Canada and the U.S. have built a strong enough economy, and working together, we can bring down inflation and bring stability to the markets. To my European colleagues, we will work together to put pressure to end these tariffs against you too. À mes collègues en Europe et dans le monde entier, je dis depuis longtemps que le Canada est le canari dans la mine. Que si les États-Unis peuvent nous
If the United States
leur allié
can do that to us, or best ally forever, they can do that to anybody.
Aujourd'hui, ces droits de douane
Today,
injustifiés ont été imposés à
those
vous aussi.
tariffs not justified were imposed to us. But we'll do everything to eliminate that. Work together to put pressure, and also the United States of America people can put pressure on their elected representatives. And we have to do it again. We did it in 2018, and we have to do it over.
I'll be meeting with Secretary Rubio. I will also be meeting with my European and British counterparts. In every single meeting, I will raise the issue of tariffs to coordinate a response with the Europeans and to put pressure on the Americans. This is much more than about our economy. It is about the future of our country. Canadian sovereignty and identity are non-negotiable. Canadians have had enough, and we are a strong country who will defend our sovereignty, will defend our jobs, and will defend our way of living. And we will do so all together every single day and one day at a time. Thank you.
Bon matin tout le monde, bonjour tout le monde. Nous vivons l'un des moments
Everyone, the very serious moment in our history today. The United States are going with their tariff aggression against Canada, 25% on our steel and aluminum product from Canada. They're not justified, and they will have an economic impact, negative impact. I was telling to my colleagues on both sides of the border.
American friend, tariffs on Canada is a tax on American. And as I've seen someone yesterday saying, these tariffs are bringing the Wild West on the factory floors across North America. This needs to stop. This is hurtful for workers. This is hurtful for industry. This is hurtful for the competitiveness of North America. Canadian steel and aluminum are essential for North America. And we live in a time, as my colleagues have said, that where you see a nexus between economic security.
So there we're hearing from three federal ministers on Canada's retaliation to those latest U.S. tariffs, and Canada, as expected, putting import duties on almost $30 billion worth of goods from the United States, including aluminum and steel. We're joined now by Bipan Rai, Managing Director and Head of ETF and Structured Solutions Strategy over at BMO, and we've also got Tiffany Wilding, Managing Director and North American Economist with PIMCO. Thank you very much indeed for joining us both, guys. Really appreciate it. Tiffany, give us your thought off the top. We're right in the trenches now, aren't we, in a tariff war, and it seems obvious that this is economically damaging.
Yeah, I mean, I think we're getting increasing evidence, within the surveys that all of this tariff volatility is increasing uncertainty and it's reducing sentiment. When it's very uncostly to wait, to delay hiring decisions, to delay investment, we think that's going to have an increasing impact on both the United States and Canada. And I think you saw that coming out very clearly in the Bank of Canada statements this morning. Obviously against that, though, there will be some price level adjustments that will happen, as companies try to pass some of these additional costs through. So we're basically, we're coming to a system with, lower potential growth and a higher price level as a result of all of this.
Bipan, are you surprised that President Trump is willing to cause this economic damage? I know his long-term goal, he says, is to remodel the U.S. economy.
Yeah, to a degree. I mean, this is a long-standing trade
these
relationship between the two countries that, has been integral to the, the fundamental structure of each economy, right? So, in this sort of a environment where we're heading into a meaningful trade shock, I mean, it does surprise us to a significant degree that we're willing to inflict these economic wounds on ourselves, right? And from there, we got to, pay attention really to how that plays out in the real economy, both in terms of the labor force and also where the imbalances here. We've got a few imbalances here in Canada that we need to pay tribute to.
What do you mean imbalances?
Well, for one, at our household level, we're sitting on an inordinate amount of debt, right? There's a lot of mortgages that are coming due to be refinanced over the next couple of years. Now, if we look at direct trade with the United States, 10% of the labor force is, subject to that. And then that expands even more once we consider indirect trade with the United States. So, unfortunately, we could be in a scenario where the unemployment rate does tick up. And then all of a sudden, those imbalances that I talked about, including the amount of household debt we're sitting on, that comes into sharper relief as more and more households start to prioritize, deleveraging and really at the expense of discretionary spending. That is how, the potential growth of the Canadian economy goes lower, as Tiffany mentioned earlier. And that necessitates further easing from the Bank of Canada. Certainly, we got the first salvo of that today, post-trade war.
Tiffany, your take, if I understand it, is that the Bank of Canada is likely to arrive at a terminal rate for its core borrowing cost of 2.5%. We're down to 2.75% right now. So do you think that they may be near the bottom of the cutting of interest rates?
Yeah, I mean, I think outside of the tariff-related announcements, the volatility associated with that, the Canadian economy actually looks like it's doing okay. The Bank of Canada obviously said they thought it was in a good place. We've gotten inflation, back down to target, and we've seen the economy really start to reaccelerate a little bit as a result of lower interest rates and the pass-through, there as well. Of course, as was suggested, we are still getting folks that are having mortgage rates that are resetting higher, but nevertheless, some of that easing of financial conditions was starting to come through. Now the tariff-related uncertainty is really changing the picture there. So outside of that, yes, we would have said kind of 2.5% interest rates seems like a reasonable level for where they would get and stay. But I think there's certainly some downside risk to that. To the extent that you have tariffs that are more damaging, I think the risk is certainly they go below that and need to accommodate as a result.
I know you're not an asset allocation specialist, you're an economist, but do you think bonds look like a decent buy in Canada right now in the sense that people tend to go to fixed income when they're worried about the economy?
Yeah, I mean, I think that's generally the case, not just in Canada, but elsewhere either. When we look at, bond yields in the United States, I think we would say the same thing. And I think, the broader takeaway that we would also just point to is that you look at valuations across asset classes. So, versus equity markets, or credit, et cetera, bonds, just look like in terms of valuation, they provide just better value at this point, just given the overall uncertainty.
A lot of our viewers are in their 60s and, you know, they're nearing the end of their career or they may have finished. I think some of them may be thinking, wow, should I move a whole bunch of my portfolio to a money market fund right now? Bipan, give us your thoughts on that.
Certainly, we've seen flows in that direction. I guess, you know, in this sort of environment where you get a significant degree of market chop, you know, a lot of investors tend to prioritize liquidity. And if you can get, you know, certain yield enhancement there, all the better. But, you know, at the same time, it's worth reminding investors in the audience out there that even during periods of significant chop, there's certainly a lot of investable products to potentially look at that could protect you know, you from meaningful downside when it comes to market gyration. So, yes, in the near term, we have seen some movement towards, you know, prioritizing that liquidity that you get at the ultra short, or at least the front end of the curve. But, you know, over time, and especially if we're sort of continuing to move sideways or seeing a protracted drawdown in risk appetite, I do think that we'll see some more flows into some of those other investable products that tend to be a little bit more structured in nature.
Right. And what is the yield? I'm just looking, I mean, of course, you guys are major players in ETFs and mutual funds. What is the yield on your flagship money market fund right now? Can you give us a benchmark idea?
Certainly. I mean, the last I checked, I believe we were close to just around 2 3/4 to 3%. So you're still getting a meaningful yield pickup there when it comes to some of our ETF products that tend to shadow money market funds.
Thanks. Tiffany, that's got to be tempting for a lot of people. I know, sorry, I keep asking you asset allocation questions and you're an economist, but that's got to be on the mind of a lot of people, I think. Should I just go to the sidelines here and put my money in something like a money market fund?
Yeah, I mean, you know, certainly people should think about, you know, the risks of their portfolio, you know, just given their personal preference and what have you. But, you know, one thing that we would just really highlight is if you look at the broader, you know, aggregate bond index, you know, either global index or elsewhere, it actually has started to yield more than money market rates. So we would actually argue, you know, this is a good time to move out of cash. You know, and I think the other point that, you know, we would really emphasize is that you don't really get diversification benefits of bonds if you're sitting in a money market account. You do get that if you do move out the curve a little bit. You know, now we wouldn't argue long duration, you know, ultra long duration, you know, but kind of an intermediate duration type of security, mutual fund, ETF, et cetera, you know, really makes sense to us. You get that diversification benefit, you get still elevated yields, and you get that sort of surety amid all of this uncertainty.
We have got to leave it there, guys. Thank you very much indeed. We've been joined by Tiffany Wilding, a Managing Director and North American Economist at PIMCO. Thank you very much, Tiffany. And also right here in studio, Bipan Rai, Managing Director at BMO Global Asset Management. We're going to hand you back to this news conference with 3 federal cabinet ministers. I think the Finance Minister, Dominic LeBlanc, is talking. Yeah, there he is. Let's have a listen.
Le gouvernement de M. Trump sur l'objectif d'enlever les tarifs douaniers qui s'appliquent injustement à l'économie du Canada.
Non, je vous dirais,
imposed without any justification to Canada.
In English, and then François Philippe can add, the discussion tomorrow, it's not about renegotiating the USMCA. That is not the purpose of the conversation tomorrow. The conversation tomorrow will be what can we do to deal with this completely unjustified application of tariffs to steel and aluminum from Canada that came into effect today. The, again, unjustified decision of March 4th. As you know, certain products that are compliant with the agreement were exempted until April 2nd. All of that points to a conversation that we've been having with the Trump administration around getting to April 2nd with the objective of obviously removing all of these tariffs that are applying to the Canadian economy. We will continue to maintain our countermeasures and increase them on April 2nd. This is no surprise to the American administration if we can't get to a position where their initial measures are all lifted from Canadian businesses. So the conversation tomorrow will be around lowering the temperature and focusing on the process that President Trump set up, where Secretary Lutnick has up to April 2nd to determine a series of global tariff decisions. Obviously, we think that they should respect the agreement that President Trump signed, the Canada-U.S. Mexico Free Trade Agreement. In the agreement itself, there's a provision to have a review in 2026. It's not a renegotiation, it's a review. If one of the three parties wants to, at some point, begin a process of that review earlier, then of course Canada would be ready. We've always said the best approach is a coherent conversation that looks at all of these issues, where the three economies are part of the conversation, and where we can arrive at the best agreement for North America. That's been the success of previous conversations, but for the moment it's difficult to get there because day over day, week over week, you have these decisions. So if we can sort of clear the underbrush and get to a position where we can get to April 2nd with a coherent plan, I certainly think that would be the objective of the conversation tomorrow, and it continues on conversations we've been having over recent weeks as well.
Je pense que Dominique l'a bien dit. Demain, pour être clair devant les Canadiens et Canadiennes.
Dominic did say so. Tomorrow will not be negotiation on the free trade agreement, but myself, what I would like to bring up to the table to bring us back, the more uncertainty, it's not good at all. So we like to be more a stable mode, actually. The industry of aluminum and the steel, and you look, the last week we did have, you see with those tariffs, it's the, everything gets fragilized. So you see, people tell us we cannot operate in that type of world, in that type of chaos. Stock markets are talking to you. Look, all the diminution. I think there's a 4,000 of billions that were lost in the United States. Businesses are talking to you. We had a large meeting with the automotive industry to return that something is more stable. As Mr. LeBlanc was saying, we will have to keep on, tell to our ally the economic security will eventually have a larger impact, in the car industry, the way we are integrated right now. It's only a few days between the supply chains will stop, on both sides of the border. So we had that talk before. We have to be careful because in a few days, the U.S. plan may stop operating. I think our mission in Washington is just, to bring back that to the table. The industries are talking, workers are talking, stock markets are talking, and I think we have to find a way, to lower the tension. So bring us back to somewhere when we can see investments on both sides.
As many as we possibly can. I am looking at you. I believe the finance minister is also looking at you. Rachel Haynes, CTV.
Thank you so much, ministers. I'll direct this to Minister LeBlanc because it's still about the meeting tomorrow. Premier Ford yesterday had said that this was an olive branch from Howard Lutnick, but at the same time, President Trump says he wants to finish the auto industry and also make Canada the 51st state. So how do you trust the U.S. administration going into tomorrow's meeting?
Well, so obviously, outrageous comments, and Melanie talked about it, from Mr. Trump in that regard, aren't constructive to building an economy that is in the interest of both Canada and the United States, and obviously with our Mexican partners as well. So our focus is not on exaggerated rhetoric. Our focus is on doing the work that Canadian workers and businesses expect their governments to do together. Premier Ford has been an important leader as not only the chair of the Council of the Federation, but as the premier of our biggest province in defending the Canadian economy and the economy of his province. I think it would be irresponsible not to take an opportunity to talk to Howard Lutnick about what we think is important to build a strong North American economy and why we think these continued tariff measures and the necessary and appropriate response that comes from Canada is not a constructive path to be on. If you're like racing to the basement, there's no real prize for being the first person to get to the basement. Like it's not It doesn't feel like the path that we want to be on. I've had with Secretary Lutnick constructive conversations. So this is an opportunity again to figure out, I hope, the best way to get to April 2nd, the decision points that they have set up themselves in a way that protects the
Okay, so we're going to break away from that news conference. That was the Finance Minister, Dominic LeBlanc, speaking. John Zechner, one of our regulars, joins us now. John, where to begin, you know? I said yesterday, this is my vision, that Jagmeet Singh, Pierre Poilievre, and Mark Carney appear on the stage together and say, whatever our differences, we're all heading for Canada.
Yeah, and I mean, how do you react? I mean, it's sort of irrational what's coming in from the other side of the border, so how do you react in that environment? So, you know, you can't really turn off the noise because you have to, you know, take it into account on an investing basis. So that's, you know, my decision. I'm a trader. I got to figure out what we're doing for our clients and what we're doing in the markets, Andy. And that's sort of, you know, the strategy right now. I went into this year cautious, and there were three things that bothered me about the stock market: valuations, sentiment, and positioning. We've corrected one of those in the past month. I mean, I think you've corrected that overly bullish sentiment, which is
south of the border anyway.
Exactly. Overall, it's actually, you know, because of what's been going on. So that helps, but that's not enough. And you know, in fact, positioning is still very positive, very bullish right now. When you look at, you know, where hedge funds are, where quant funds are, where the public is over 70%, which is why you sort of see, I'd be curious to see the market open up this morning. How does it close at the end of the day? Because you're still, you know, people are selling into the rallies rather than buying the dips. So I think that that's a risk going forward. So, you know, I don't think that's about to change. You're still an expensive market, even though stocks have come down. You're still 21 times forward earnings in the U.S. So, you know, it's not cheap. And like I say, positioning is a risk. You know, sentiment's got a little bit better. So you might get a trading bounce at some point. But, you know, the market will give you opportunities. And you know, we're looking around. What's getting beaten up? Where does it make logical sense to do some buying and put some of our cash to work? I mean, I look at a name like Celestica, was trading up north of 190. Suddenly we're buying it down to 110.
CLS in Toronto, yeah.
Yeah, and you know, nothing has changed in terms of the story for data centers and the build-out and where they're positioned. In fact, they're beating their earnings. You know, Capital Power, another one, the electricity story. So the market will give you these opportunities to buy things. I think the other important thing about these tariffs, you know, we were buying Algoma Steel yesterday and some of those names, which seems, you know, why would you do something that ridiculous? I don't think in the end what Trump is trying to do is going to be achievable, of sort of reorienting sort of U.S. business entirely. I think the problem is that capital decisions are made for long periods of time. You spent 4 decades putting this supply chain in place, in North American supply chain, building it, putting it in place, getting dynamics of it. They're not going to unwind it in a hurry. They'll do some token moves, but capital expenditures, you know, they need to know what's going to be happening for the next, you know, 10 or 15 plus years.
Or longer even,
Or longer. You know, what everybody knows is that this guy's not going to be president in 4 years, and whether it's, you know, a Democrat or Republican, it doesn't really matter. They're not going to make big policy changes, big capital expenditures in that environment. So, you know, when someone comes on and says we're going to eradicate, you know, the Canadian steel industry or the Canadian auto industry or whatever, it's not going to happen. You know, ultimately, we'll take some pain, but the stocks are already reflecting it. So where you can get the worst case scenarios built in and you can buy these things a little bit cheaper, you know, I'll go out and buy them. And like I say, the market has driven so many things down recently, and we take the opportunity. We're still, you know, underweight stocks. I'm still, you know, we got rid of all our high-value stocks, the high-value tech stock, you know, the cyber stocks. You know, those things are most at risk. And, you know, economically sensitive stocks are somewhat at risk still, but the market gives you opportunities. And I mean, people like myself, I mean, I probably drive my trader crazy lately. I mean, it's an active market, and I think it'll give you opportunities to add. We're still sticking with U.S. bonds for now. They haven't defaulted on their debt yet, so something like, you know, 4.6, 4.7 for long-term U.S. bonds. It's still a nice hedge in the portfolio. It's acted well, I think, to protect the values, and we'll just continue on. But it's a time to be cautious. economy slowing down, rates are coming down. You know, that's a bit of a warning flag.
John, I think we're going to have to leave it there. Thank you very much. We had a very brief time with you, but thanks. That is a reality check. People aren't going to change plans fundamentally just on the basis of one presidency. No. John Zechner, we have to take a break. We are... Oh, no, we're going over to the Bank of Canada governor right now, and there is a look at the Canadian dollar. So no huge reaction to the decision by the Bank of Canada, as expected, to reduce interest rates by 1/4 percentage point for a 7th straight meeting. Let's hear from the man of the hour, Tiff Macklem, governor of the Bank of Canada.
2 3/4%. The Canadian economy ended 2024 in good shape. Inflation has been close to the 2% target since last summer. Substantial cuts to our policy interest rate through the second half of last year boosted household spending and strengthened economic growth. However, in recent months, the pervasive uncertainty created by continuously changing U.S. tariff threats have shaken business and consumer confidence. This is restraining household spending intentions and businesses' plans to hire and invest. Against this backdrop, and with inflation near the 2% target, the Governing Council decided to reduce the policy rate a further 25 basis points. Looking ahead, the trade conflict with the United States can be expected to weigh on economic activity while also increasing prices and inflation. The Governing Council will proceed carefully with any further changes to our policy rate, given the need to assess both the upward pressure on inflation from higher costs and the downward pressure from weaker demand. L'économie canadienne a fini 2024 en bonne posture. L'inflation est autour de la...
Inflation has been close to the 2% target since last summer. Substantial cuts to our policy rate through the second half of last year boosted household spending and economic growth. However, in recent months, the pervasive uncertainty created by continuously changing U.S. tariff threats has shaken business and consumer confidence at this time. The result is that this is restraining household spending intentions, as well as businesses' plans to hire and invest. Against this backdrop, and with inflation near the 2% target, the Governing Council decided to reduce the policy rate a further 25 basis points. Looking ahead, the trade conflict with the United States can be expected to weigh on economic activity while also increasing prices and inflation. Governing Council will proceed carefully with any further changes to our policy rate, given the need to assess both the upward pressures on inflation from higher costs and the downward pressures from weaker demand.
So let me expand on these considerations. Economic data since our January monetary policy report suggests the Canadian economy ended 2024 on a stronger footing than we expected. Past interest rate cuts have boosted consumer spending and business investment, increasing domestic demand in the fourth quarter by a robust 5.6%. Overall, GDP grew 2.6% in the fourth quarter after upwardly revised growth of 2.2% in the third quarter. This growth path is considerably stronger than we were expecting based on the information we had in January. Job growth also strengthened around the end of the year before stalling in February. Growth in employment increased in November through January, surpassing labor force growth, and the unemployment rate declined to 6.6%. There are also signs wage growth is moderating. Inflation has remained close to the 2% target. The temporary GST-HST holiday has lowered some consumer prices, but January inflation came in a little firmer than expected at 1.9%. Inflation is forecast to increase to about 2.5% in March with the end of the tax break. Today, we published new survey data on what we are hearing from businesses and households. While it is still too early to see much impact of new tariffs on economic activity, our surveys suggest that threats to new tariffs and uncertainty about the Canada-U.S. trade relationship are already having a big impact on business and consumer intentions. Canadians are more worried about their job security and financial health as a result of trade tensions, and they intend to spend more cautiously. Job security concerns increase particularly among workers in export-oriented industries, including manufacturing, mining, and oil and gas. Businesses have lowered their sales outlooks, notably in manufacturing and in sectors that depend on discretionary spending by households. Credit has become more difficult to access for some businesses, and with a weaker Canadian dollar, the cost of imported machinery and equipment has risen. As a result of all these trade-related factors, many businesses have scaled back their hiring and investment plans. Our surveys also suggest business intentions to raise prices have increased as they cope with higher costs related to both uncertainty and tariffs. At the same time, inflation expectations have moved up as Canadians brace for the possibility of higher prices. This recent shift in consumer and business intentions is expected to translate into a marked slowing in domestic demand in the first quarter of this year. At the same time, merchandise trade data suggests businesses on both sides of the border have stocked up on imports in advance of tariffs. As a result, Canadian exports and imports are both expected to be stronger than expected in the first quarter. But the impact on exports looks to be bigger, which should provide some offset to weaker domestic demand in the quarter. Of course, this pull forward in exports likely means weakness ahead. If households and business spending intentions remain restrained, the combination of weaker exports and softer domestic demand would weigh further on economic activity in the second quarter. The impacts of uncertainty and tariffs on inflation are more difficult to assess. Uncertainty that weighs on household and business spending tends to put downward pressure on inflation, and new tariffs will hurt our exports and weaken business investment. But costs are rising too, and this will put upward pressure on inflation. A weaker Canadian dollar and new retaliatory tariffs both make imports more expensive. Businesses are also telling us that uncertainty itself has costs. It will take some time for the impacts of higher costs and weaker demand to work their way through the economy and affect the prices that Canadians will face. Governing Council will be tracing the impact of cost pressures through to consumer prices. We'll also be closely monitoring inflation expectations. Keeping medium and longer-term inflation expectations well anchored is imperative to ensure that any rise in inflation is temporary. Let me wrap up. À la fin de 2024, l'économie était solide.
We ended 2024 on a solid economic footing, but we're now facing a new crisis. Depending on the extent and the duration of these new U.S. tariffs, the economic impact could be severe. The uncertainty alone is causing harm. Monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. The focus of Governing Council will therefore be on assessing the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time.
We ended 2024 on a solid economic footing. We are now facing a new crisis. Depending on the extent and duration of new U.S. tariffs, the economic impact could be severe. The uncertainty alone is already causing harm. Monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. The focus of the Governing Council will be on assessing the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time. And with that, the Senior Deputy Governor and I will be very pleased to take your questions. Thank you.
Okay, thank you, Governor. We will go to questions now. We'll start with the reporters here in the room in Ottawa, after which we'll go to those who have joined us remotely. We've got some work to do to get to everybody, so I'm going to ask you to limit yourself to one question only so that we can try to get to every outlet. If I forget to do so, please state your name and affiliation. And we have a few new folks with us here today. Please, in the room, please press the green button on the microphone in front of you to ask your question and activate your microphone. Press it again to shut it off once you're done. Please try to speak directly into that microphone so everybody can hear the question. Avant de poser une question, veuillez-vous...
Before asking your question, please identify yourself. And you are, of course, free to ask your question in the official language of your choice.
Mail.
Thank you very much, Governor, for taking the question. You talk about the potential inflationary impacts of trade war, whether that's retaliatory tariffs, depreciation. What kind of inflationary impact are we talking about? And do you view that as a one-off jump in price level, or is this something that could feed through to inflation? How are you kind of gaming that out?
Well, Mark, first of all, given the pervasive uncertainty and the unpredictability of U.S. trade policy, I can't put a number on it. The scenario is changing every day with new announcements literally every day. In terms of the channels, though, in the monetary policy report, in my speech in Mississauga, we were very clear in identifying a number of channels. The Canadian dollar has depreciated. If you're a business importing machinery and equipment, if you're importing goods from the United States, a weaker Canadian dollar means they're going to be more expensive in Canada. Obviously, retaliatory tariffs puts an extra charge on U.S. goods coming into Canada. That adds costs. The other thing we're hearing from businesses is that the uncertainty itself is adding costs. I mean, businesses are looking for new suppliers. They're holding extra inventory. They're looking for new markets for their goods. That all entails new costs. So, there are a number of new costs that businesses are facing, and ultimately those will get passed through to the prices that Canadians face. There's quite a bit of uncertainty about how quickly that happens. Does it get fully passed through? How quickly does it get passed through? So those are things that we are going to be doing our very best to trace. We have data on. We have CPI data, we have micro CPI data, we have data when goods cross the border. So we should be able to do a fairly good job of tracing how these things are working through the economy. And then to get to the second part of your question, I mean, the reality is some prices are going to go up. We can't change that. What we're particularly focused on is what we don't want to see is we don't want to see that first round of price increases have knock-on effects causing other prices to go up, that becoming generalized and ongoing inflation. That's what we can't let happen.
Okay, our next question is from Pramit Mukherjee of Thomson Reuters.
Good morning, Governor. Governor, while you have said that the Governing Council will proceed very carefully with further changes to policy, your comments indicate a kind of hawkish stance. And there are, of course, lot of inflationary pressures everywhere. Do you think there's a possibility of a hike also somewhere in the future?
Look, the reality is there's a lot of uncertainty. And against that background, we can't provide forward guidance. Look, what I can tell you is how we're thinking about monetary policy in the face of a trade war and what we're particularly focused on. So let me start with the first one. How are we thinking about it? We've been very clear, monetary policy cannot offset the impacts of a trade war. We're going to get weaker economic activity. We're going to get higher prices, higher inflation. We can't change that. What we can do is ensure that any rise in inflation is temporary. And what does that mean? What it means is we're going to do as much as we can to help the economy adjust to the painful adjustment to higher U.S. tariffs. But what we can do is limited by the need to control inflation. We can't lean against weaker growth and higher inflation at the same time. So what are we focused on? I'd highlight two things. First of all, and I discussed this a bit in response to Mark's question, we're focused on assessing the upward pressure on inflation coming from new costs and the downward pressures on inflation from weaker demand, both external demand and domestic demand. We're going to be doing our best to try to trace how those costs are working through the economy to the final goods prices that households face. That's, it's going to take some time for that to work through. The other thing we're focused on is inflation expectations. It's going to be critically important that medium and longer term inflation expectations remain well anchored. When that happens, any increase in inflation will be temporary. Inflation will come back to target. So those are the two things that we are particularly focused on.
We'll go now to Mackenzie Gray, please.
Hi, Governor. Your colleague in the U.S., Jay Powell, has talked about how it's yet to be seen if the tariffs will be inflationary. The Trump administration has been very clear. Howard Lutnick has said that he does not think the tariffs will be inflationary. Can you just explain why you believe you think the tariffs will be inflationary and what you make of the fact the U.S. administration has been adamant that this will not increase inflation?
Well, look, I'm going to let the U.S. administration speak for themselves. We've been very clear. There are two effects of tariffs on inflation. Tariffs are going to weaken the Canadian economy. They're going to weaken U.S. demand for our exports. Americans have to pay those tariffs when they import our goods. That's going to reduce their demand for our exports. So our exports to the United States will be weaker. Certainly what we're hearing from businesses is that is having an impact on their investment plans. They're scaling back their hiring intentions. So that's going to spill into the domestic economy. It could well mean layoffs. Certainly what we're hearing from Canadians that they are becoming more worried about their job security, particularly in export-oriented sectors. That, of course, means that they're becoming more cautious in their spending, so domestic demand will also slow. That will all put downward pressure on inflation. But as I outlined earlier, there are a number of direct cost pressures involved with tariffs. The Canadian dollar is depreciating. Anything you import is more expensive as a result. Retaliatory tariffs add an extra charge on anything coming in from across the U.S. border. That increases costs. Businesses they're also looking for new suppliers to avoid tariffs. They're looking for new markets. That entails costs. There could well be supply chain problems. Businesses are holding more inventories to try to manage those things. These things all have costs. Somebody has to pay for those costs, and ultimately they get passed through to the consumer. So it wouldn't be surprising if you saw some increase in inflation as those costs get passed through. What we're doing is we're focused on weighing those downward pressures and those upward pressures. Our job is to maintain price stability, and that's what we're focused on.
Okay, I'll go over here now to Jordan Gowling from the Financial Post, please.
Hi, Governor. The surveys you published today say 40% of businesses plan to pull back on hiring. There are talks of potential layoffs in export industries. So what do you anticipate that's going to do to Canada's unemployment rate this year? How much do you anticipate it's going to rise?
Well, I don't have a forecast for you. I think in terms of what we're expecting to see in the first quarter, so as I mentioned, fourth quarter, very strong. 2.6% growth. We expect the first quarter to be weaker. We actually expect domestic demand, so consumption and business investment, to be quite a bit weaker in the first quarter than it was in the fourth quarter. We expect it to be quite weak, frankly. We do expect some offset on first quarter GDP growth, because what we've seen is we've seen a surge in exports as businesses try to get ahead of the tariffs. So first quarter, we think domestic demand will be very weak. We think exports will be up. GDP growth will be weaker than it's been, but probably not that weak. Going forward, though, of course, if you pull exports forward, that means you're going to get less exports in the future. So, you know, if household demand, if business investment remains restrained in the second quarter, and you'll likely see weakness in exports, you could see an even weaker second quarter. So yes, you know, I would expect if that plays out, you'd see some rise in the unemployment rate.
Okay, now I'm going to call on Judy Trin from CTV, please.
Hello, Governor. I am wondering, you use the word crisis. That's a strong word. You don't usually see it coming from the Bank of Canada, but you did not use the word recession. Is a recession imminent? Do we have to tell Canadians that we need to brace? And also, how do you feel about a former bank governor now leading the nation in terms of its negotiations during a trade war?
Those are two pretty separate questions. Why don't you take the first one? I'll take the second one. That's a good idea.
Well, Judy, we don't have a forecast at this decision. You know, we've put out, unusually we put out our survey data ahead. Usually we package it up with our forecast as sort of a complement to the projection that we provide. We put it out today because we promised you at the last decision that in this environment of high uncertainty, we would do our very best to keep Canadians up to date, help them understand how we were thinking about the economy, how we were thinking about the situation we were in, and what kind of data we were looking at. So we've stepped up our outreach to Canadians. The survey data is an example of that. We put it out, but it's not meant to provide a forecast on either output or on unemployment, as the previous question. So we don't have an economic forecast right now. What we do take from what we're hearing from Canadians is the sentiment has turned quite sharply. The economy came in quite strong at the end of last year. That would have been really good news. But for this large cloud of uncertainty hanging over the economy, what businesses are telling us is they're slowing investment, they're slowing hiring. Canadians are saving more, spending less. So all of those things don't bode well for growth. But, you know, we'll see. We'll have a forecast at our next decision.
I mean, the short answer to that question is it's going to depend a lot what the U.S. does with their trade policy. We'll have to see. Regarding your second question, I don't have much to say. Look, you know, as you said, Mark Carney and I worked together here at the Bank of Canada. He was the governor. I was the senior deputy governor. Mark has now entered politics. The Bank of Canada operates independently of the political process. That is really important. And what that means is it comes with a responsibility. The Bank of Canada needs to stay clear of any comments that could be seen as political in nature. So I have no further comments. I'm not going to be commenting on political leaders or political developments.
We'll go now to Pam Almeida from Market News, please.
Good morning, Governor. My question is, did you consider cutting interest rates by 50 basis points? And if so, did you consider whether cutting rates by more than 25 basis points could have made things worse by adding to uncertainty or a loss of confidence among Canadians?
I mean, you're going to get the summary of deliberations in a couple of weeks, so you're going to see, you're going to get more details on our deliberations. But I mean, the short answer to your question is we did not seriously consider a cut of 50 basis points. And you know, why is that? Well, monetary policy does need to be forward-looking. And, what we see from, the hard data so far still looks good. You can't see much of damage from the trade war in the hard data yet. But when you look at the survey data, it's pretty clear. Consumer confidence, business confidence has been sharply affected, and we are expecting to see a pullback in household spending and business investment. That's going to have an impact in the economy, and that's really why we decided to cut 25 basis points. Monetary policy does need to be forward-looking, but there is a lot of uncertainty. This is a very fluid situation. There is a lot of unpredictability in terms of what the U.S. is going to do. And, as we've outlined time and again, a trade war, yes, it weakens growth, but it will also increase prices and inflation. We've got to be very careful to balance those two. So against that background, we did not want to get ahead of ourselves. And, we're going to be assessing these things carefully. That's going to take some time. And our message really is that we will proceed carefully with any further changes to our policy rate.
Okay, next I'm going to go to Paul Vieira from the Wall Street Journal, please.
I know, I'm aware that the Bank of Canada does not target foreign exchange rates. However, the communications does talk about the impact of the Canadian dollar on a weaker Canadian dollar lifting prices. Will Bank of Canada officials be more sensitive about movements in the Canadian dollar when it comes to future rate decisions?
Well, Paul, the Canadian dollar has certainly moved down largely as a result of the continuing tariff threats. It's actually been, it's been volatile day to day, but it hasn't changed that much since our last decision. Obviously, as the market keeps getting new information, new statements out of the U.S. administration, you're seeing some volatility in the dollar. But overall, it hasn't changed much since our last decision. The Canadian dollar is reflecting what's going on. And, it's moved, and that's something that we need to take account in our decisions. To some extent, it's a shock absorber. It will help the economy adjust to some extent. It offsets some of the impact for exporters, or at least some exporters, depending on the nature of their business, not everybody. It also affects the costs that businesses and Canadians are facing when they buy goods from the United States. So yes, we need to factor that in. And when something's moving, yes, it gets more attention. So that is something we'll look at, but we're going to look at it in the context of everything else that is going on.
Okay, next I'm going to go to the back for Craig Lord of Canadian Press, please.
Good morning. How much of a role do you think Canada's own retaliatory tariffs will play in the economic shock and the inflation shock compared to the U.S. actions?
Yeah, retaliatory tariffs are going to add to the uncertainty. They're going to add to the potential price increases that Canadians and Canadian businesses face. There's really no question about that. But these are really tough decisions. They're decisions that don't belong to the central bank. They're trade policy decisions, and they're made by the government. And I'm sure they're not easy decisions to take, but governments need all the tools they can get in a trade war. Retaliatory tariffs are really designed to try and get us back to a mutually beneficial trading relationship. That's a goal we all want. So. But yeah, they're gonna add in the near term, certainly to the uncertainty and to the effects.
Okay, I've got 3 left here in the room before we go to the phones. I'll call on Daiichi Mishimi from Nikkei, please.
Thank you for taking my question. I just want to
follow up on the former question about the effects. While I understand that you don't target currency rate itself, do you think that depreciation of the Canadian dollar has a stronger impact on economic activity than the traditional pass-through, where cutting rates boost investment and consumption? Thank you.
Look, certainly in an open economy like Canada's, part of the way monetary policy works is through the exchange rate. And I mean, you have to abstract a bit from the current situation, but in a normal situation, when we cut interest rates, that tends to depreciate the Canadian dollar. So when you cut interest rates, that supports domestic demand, that lowers the cost of credit for businesses, for Canadians borrowing, that tends to stimulate domestic demand. The depreciation of the exchange rate tends to make Canadian exports more competitive, and so that boosts foreign demand. So they both work in the same direction, and that's part of the way monetary policy works. As I said, the fact that we've been lowering interest rates has had some effect on the Canadian dollar. I think if you look at the timing of the effects and the magnitude, our assessment is that they're more related to the uncertainty and the trade actions created by the U.S. government. But yes, that, as I said in the previous question, the exchange rate is operating as somewhat of a shock absorber. It's certainly not perfect, and it has some cost consequences as well, and we'll have to take that into account along with everything else as we move forward.
Okay, Randy Thandong-Knight from Bloomberg is next.
Hi, Governor. How would you characterize the current level of interest rates? Would you call it neutral, or is it slightly stimulative?
Well, there's always a lot of uncertainty about exactly where neutral is. We do our best to estimate neutral, and we have a number of different approaches to do that. We do that once a year. I think the next meeting we will be, at our April meeting, we will be having another look at that. Right now, actually, our estimate of neutral is centered on 2 3/4, which is where we are. What we actually put out is a range reflecting to try to give some idea of the uncertainty. But yes, I think the Governing Council thinks of us as in that neutral range.
And last here in Ottawa is Kevin Carmichael from The Logic, please.
Good morning. Household debt in Canada is extremely elevated. Public debt is elevated. Markets are volatile again. The President of the United States is musing about defaulting on debt. Could you talk a bit about how financial stability is factoring into your thinking right now?
Yeah, we saw that particular musing concerning. We'll have our financial stability report out in May, Kevin, and so we'll dive a bit deeper then. But we're seeing the markets, the equity markets in particular, in recent days start to react to trade policy. There was some thinking that maybe they were underestimating effects, but I think reality is sinking in. We're seeing the equity markets move around. We're seeing yields move around, spreads move around, as I think everybody sort of digests what's coming out of the White House. So it's certainly adding to volatility. We haven't seen it really have a destabilizing effect in Canada so far, but that's something we'll watch closely. But these are questions that we'll definitely dive deeper on in May when we put out our financial stability report.
Okay, that's it for the room here in Ottawa. We're going to go to the reporters who have joined us remotely now. I'll just remind you, if you're on the line, come off mute only, please, to ask your question, and then go back on mute as soon as you have finished, so that everybody can hear the response. I'm going to start with Alicia Sikirska from Yahoo Finance, please. Go ahead, Alicia.
Thank you for taking my question.
You said that the economic impact could be severe. So how should Canadians prepare themselves financially and otherwise for that?
I mean, I think what we're seeing in the survey data is Canadians are preparing themselves. We're seeing saving rates go up, discretionary spending go down. These are the kinds of things that are going to feed through and have an impact. I mean, we are seeing concern around job security. I mean, I think that's probably what's leading to the decisions around spending and saving. I think Canadians are responsible. They're reading the news. They're watching this with the same level of concern we have, and they're preparing in the best way they can.
I would just add, what we can do and what we have been doing is to provide analysis of what this could look like. Obviously, there are many scenarios. Trade policy is shifting every day. There's a lot of unpredictability, but we have been publishing various scenarios. We published one in the Monetary Policy Report. I published another one. We published another one in the speech I gave a couple of weeks ago in Mississauga. Today we published the survey evidence so everybody can see what we're seeing. Look, we can't make this go away, but at least by providing some analysis about what it could look like, that can help Canadians prepare.
And what we know Canadians don't want, on top of all the uncertainty coming out of the U.S., is another spout of inflation. So that's what we're determined to head off.
Okay, next I'm going to call on Max Sato from Mace News, please.
Good morning, all. My question is for both of you, Governor and Senior Deputy Governor. Under the current market conditions with the threat of a global trade war, could we say it is better to have a stronger Canadian dollar than a weaker one for households and businesses from the viewpoint of keeping import costs lower, or do we also have to watch out for the negative impact of a stronger Canadian dollar on exporter profits?
Well, maybe I'll start off here. Well, first of all, I just want to remind you, we don't target the Canadian dollar. In fact, the flexible exchange rate is part of our monetary policy regime. It is what allows us to gear monetary policy to the needs of the Canadian economy, the needs of Canadians. The dollar is determined in markets. It fluctuates. And as I said in previous questions, what you're seeing in the dollar is reflecting what's going on. It has depreciated, and that largely reflects the continued threats by the U.S. administration of significant tariffs. I don't know. Do you want to add much?
I think we've said a lot about the U.S. dollar, Canadian dollar right now. So.
Okay, I've got 3 questions left. I'll go now to Anna Pereira from the Toronto Star.
Hi, good morning. So I know you've already addressed much of this today, but I wondered if you could expand on the mechanism through which you see tariffs pass through to consumer prices. In your scenario from January, most of the pass-through happens in year 3, but as we saw during the pandemic, businesses can adjust costs quite quickly. Especially related to supply chain. So why not sooner, and are you prepared if it happens more quickly than expected?
Well, it's a very good question. And well, the reality is there's a lot of uncertainty about that, and we are concerned, but that's why we're tracking it. But perhaps you want to expand on that.
Yeah, I mean, the speed of pass-through and the magnitude of pass-through are 2 of the big questions, the big uncertainties. Our models give us a way to analyze that, but they're not a crystal ball. We can't predict with certainty. I mean, you're drawing a comparison to the pandemic, and I think there are some similarities. I mean, a trade war is a supply shock. It's going to disrupt supply chains. It's going to affect production costs and production capacity. So in that sense, it's similar to what we saw in COVID. What is different, though, is the supply constraints in COVID ran headlong into a surge in demand as we all came out of lockdowns and we had a lot of pent-up demand for goods and services. So the economy was running really hot at the same time as we had supply constraints. And that was an environment where businesses could pass through price increases really quickly, and that's what we saw. What we expect in a trade war is more likely is we will see lower demand, and you see that really in the survey data that we were just talking about. Canadians are planning to spend less. They're worried about job security, so we don't expect that the supply constraints from the tariffs and the trade war will run into the same surge in demand we saw. So that could mean that we don't see the speed or the magnitude of pass-through to prices. But as the governor said, that's a big question. We'll be watching it carefully.
And the only thing I would add is that it depends exactly on what the good is. On things like fruit and vegetables, for example, if we're buying on more differentiated, more durable goods, you might expect to see slower pass-through. So when I say we're tracking it, we have to track it by different good categories, and then we have to come to some overall assessment, and that's going to take some time.
Okay, I'll go now to Rob McClister from Mortgage Logic News. Go ahead, Rob.
Good morning. Longer-term inflation expectations are obviously critical, but short-term expectations usually react quicker, and they're rising as we speak. So given it's hard for people to make predictions far into the future, is there any validity to weighting short-term inflation expectations more than long-term expectations when forecasting inflation trend changes?
Well, I mean, the short answer is, look, we look at them both. But, I mean, given the tariff threats, given the depreciation of the Canadian dollar, given the clear intention of the Canadian government to respond with retaliatory tariffs, you can understand why people's perceptions that inflation could go up have increased. They see there could be some new costs, and that's going to cause new price increases. And as I said to one of the previous questions, actually, monetary policy can't stop that. Some prices are going to go up. What we want to make sure is that those first direct price increases don't knock on to, spill over into other price increases and becoming ongoing inflation. And one of the ways that we look at that is we focus on medium to long-term expectations, because if people begin to believe that the rise in inflation, which is raising short-term inflation expectations, is going to persist, you'll start to see that in their medium and longer-term inflation expectations, and that would certainly be a big warning sign for us.
Et en terminant, passons maintenant à Philippe de Montigny.
Philippe de Montigny, Radio-Canada. Are you there, Philippe?
Hey, il m'a dit qu'il a voulu une question.
He said he wanted to ask a question. No?
In that case, that will conclude today's press conference. Oh, okay, Philippe, if you can come off mute right now, please.
Philippe?
Okay, we're having a technical problem hearing you, unfortunately, so we'll have to get you the next time. Apologies for that. That will conclude today's press conference. Thank you to the governor and senior deputy governor.
And that, of course, is the conclusion of the press conference held today by Bank of Canada Governor Tiff Macklem and senior deputy governor Carolyn Rogers, taking numerous questions from the news media on different topics. We'll recap those in just a second. First of all, let's take a look at some highlights from the announcement that was released released at 9:45 a.m. this morning. The bank, of course, reduced its benchmark interest rate by 25 basis points to 2.75%. And here are some of the things that it said along the way. We'll show you now three separate quotes from the Bank of Canada. The bank at one point in its initial statement said economic growth in the first quarter of 2025 will likely slow as the intensifying trade conflict weighs on sentiment and activity. And during the news conference, there was numerous references to sentiment. The statement also said recent surveys suggest a sharp drop in consumer confidence and a slowdown in business spending as companies postpone or cancel their investments. And at near the end of the statement, there was this blunt comment, also repeated during the news conference, that monetary policy cannot offset the impacts of a trade war. It's the job of the central bank to keep its eye on inflation, and that point was made several times. Okay, so from highlights from the press conference, the first question was asked on inflation impacts. What does the bank see as the inflationary impact or consequences of a trade war? And those largely center on Canada's retaliatory tariffs, which have been announced today. Those retaliatory tariffs will make U.S. goods more expensive in this country. What is the knock-on effect on inflation? Tiff Macklem answered by saying, I can't put a number on it. Things are changing daily. In the monetary policy report most recently released, we identified a number of channels. Retaliatory tariffs add costs. Business also says uncertainty adds costs. For instance, businesses that may be now looking for new markets, there's a cost to doing that, and that cost will be passed through. So Tiff Macklem said some prices will go up. We don't want to see knock-on effects that lead to more generalized inflation. Also, a question was asked, do you have a forecast on the rate of unemployment arising from the tariff war? Tiff Macklem says, I don't have a forecast for you. We do expect a dip in first quarter gross domestic product. Exports to the United States have been pulled forward. What he means there is that many Canadian companies who ship to the U.S. accelerated their shipments into the U.S. market to avoid the onset of tariffs. In the subsequent second quarter, we might see weaker growth, Tiff Macklem said, and if so, unemployment would likely rise. Our colleague at CTV News, Judy Trinh, asked a question as well on whether the bank sees a recession coming in Canada or not. Carolyn Rogers, Senior Deputy Governor Carolyn Rogers, took that question. Her response was, we don't have a recession forecast today. We have released survey data. I'm paraphrasing here. We have released survey data. It's not intended to provide a forecast, but sentiment has turned quite quickly, she said. And businesses are telling us that they are slowing down their planned investments. Both of those things would suggest an economic slowdown. And finally, Carolyn Rogers made an interesting reference near the end of that press conference to equity markets. The bank doesn't often comment on stock markets, but she said at one point, reality is starting to set in. In other words, equity markets are starting to understand that the Trump tariff threats were not simply bargaining positions as was common before to hear from observers before the tariffs actually took place. Okay, let's speak to our expert guest on all that has happened today. Here's how the Canadian dollar is performing. We did see the Canadian dollar. Bond yields have reacted as well. There's the Canadian dollar up a little bit, 69.43 cents US is the value of the Canadian dollar. Here's the Toronto Stock Exchange and how it is faring today, the S&P TSX Composite Index. It is up very, very slightly today. And we will now go to our expert guest. Our guest reacting to the Bank of Canada announcement, Stuart Paul. He's with Bloomberg Economic. Stuart, what do you think? The bank had lots to say today about the impact of the tariff war on the Canadian economy, both on the negative effect on economic growth and possibly the upward effect on inflation. How do you assess what the bank has said?
There was a little bit of mixed messaging, but I think on net, the takeaway should be that the central bank is actually a bit more dovish. Yes, the messaging was very much so focused exoterically or very explicitly on the inflation consequences of the tariff fight, supply chains getting snarled or otherwise producers needing to find other sources beyond the U.S. for inputs to production, the weakening loonie. But the weakening loonie is in part attributable to monetary policy divergence because of different domestic fundamentals between the U.S. and Canada. You also have the inflationary consequences of retaliatory tariffs. That was what a lot of the outward messaging has been focused on. But I think that what's more important and what I'm indexing more on is that Macklem is calling this an acute crisis. Frankly, he's identifying the trade war as a crisis specifically. He's looking at domestic fundamentals weakening in the first quarter and really cautioning against declining growth in the second quarter as net exports decline more swiftly. So I think that the real question is what's going to end up dominating the need to establish firm and low inflation expectations or a true fear about a growth crisis. I think that ultimately is going to shake out in favor of monetary policymakers taking a more dovish approach to cater to softening growth, especially in the near term.
I'm looking right now at your reaction on the Bloomberg terminal to today's announcement and comments. You say we expect additional quarter-point cuts in the first half of this year. How many?
Right now, our base case is that we get to 2.5, so another quarter-point cut. But I think that, frankly, risk is skewed toward maybe even getting down to 2% early in the third quarter. Right now, the central bank is approaching neutral territory, where we heard Macklem say that in response to a question from one of my news colleagues that 2.75% is roundabout neutral. But I think that with mounting growth risks, the expectation, at least here, is that policymakers are going to want to become quite a bit more accommodative even. I truly think that the growth risks dominate the inflation risks, especially in the near term. Policymakers can worry about inflation more so in 2026 than in the first half of this year, certainly.
That's interesting. Let's circle back to inflation. The first question that Macklem took in the press conference was on inflation. He said not surprisingly, he said he was not forecasting inflation today, but he did say prices will go up as a result of U.S. trade tariffs, and he concluded that answer by saying we don't want to see knock-on effects. We don't want to see inflation spreading to a more generalized uptick in inflation. What's your take on the likelihood of the Bank of Canada being able to contain inflation at a time when, as you've noted, it is much more inclined to reduce rates than raise them?
My expectation is that relatively weak growth and softening domestic demand is what's going to restrain inflation. I guess that the real thing is that you have a couple factors that are in play. You have, in the very near term, so over the next 2 months, you have the inflation effect of the expiring general sales tax holiday. That's going to boost the monthly inflation prints that we get over the next couple months. And so that's going to start reverberating through markets. That's going to reverberate a little bit through expectations. Policymakers should be discounting that. You're going to have some supply chain snarling. That's going to only affect consumer prices with a relatively long lag. I'm thinking 6 months to a year. With direct goods that are imported from the U.S., some foodstuffs, sure, we could see that more quickly, but most of those items are going to be outside of the core. And so monetary policymakers at least should be relatively less responsive to that. The thing is that the central bank does explicitly have a pretty narrow mandate, and that's ensuring price stability. So it makes sense that their messaging on the inflation front is going to be rooted in a desire to ensure stable inflation expectations. And the financial market response, as you just noted, it suggests that they did a relatively good job of that. But when we think about what they're looking at in terms of domestic economic fundamentals and risks to the growth outlook, to me, it just suggests that they're going to need to maintain a dovish bias. They're going to need to maintain a rate cutting bias, especially in the first half of this year.
There were numerous references to business sentiment softening in the trade tension environment, and in fact, the bank took the additional step today of releasing some survey data, surveys of consumers and businesses on their sentiment. And the bank, of course, pays a lot of attention to business sentiment. One of its regular publications is the Business Outlook survey. The next time we get a full, comprehensive survey by the Bank of Canada of Canada's business community, what would you expect to see?
I'm expecting to see continually softening sentiment. We see softening consumer sentiment. We think that CEOs are going to start picking up on that on the weakening consumer sentiment and a weakening order book, and that's going to ripple through into business sentiment. Already, policymakers are noting that they're seeing canceled and postponed investment plans. So again, already in action, business sentiment is becoming more evident in economic activity and in planned economic activity ahead. Economic policy uncertainty, the policy uncertainty index has spiked to levels unseen in years. And when that starts to then dominate any sort of activity that we're seeing in the present, and uncertainty starts to cloud further expectations, and it starts to weigh on plans, I think that, yeah, we're going to start seeing in the central bank survey data weaker CEO sentiment, weaker business sentiment. Consumer sentiment has already turned. I think that that's only going to continue deteriorating in the near term. I think that this is something that's going to continue for most of 2025. The USMCA, the primary North American trade deal, is up for review. We heard LeBlanc say not necessarily renegotiation, but Trump is going to say that 2026 review of the USMCA is going to be part of a renegotiation. This tariff uncertainty, the looming tariff threats, the waxing and waning of implemented tariffs on basically an hourly basis, this is the sort of thing that can continue throughout 2025 until we get to that 2026 USMCA review and potential renegotiation. And when that's the case, again, business sentiment, consumer sentiment, policy uncertainty, and planned investment are all going to continue weakening.
Tiff Macklem took a question on the Canadian dollar. As is typical, he largely deflected that question with a stock answer about the pros and cons of a weaker Canadian dollar. The dollar seems to have found a floor, a near-term floor, at about 69.5 cents U.S. That's almost exactly where it is right now. What is your take on the currency markets and how they are judging the uncertainty of this tariff war?
It looks like right now the Canadian dollar is moving primarily on the messaging from Macklem that was focused on trying to establish an upper bound on inflation expectations. And Macklem's focus on trying to ensure price stability, I think that that's what's undergirding and supporting the Canadian dollar right now. We've been focused on monetary policy divergence between the Fed and the Bank of Canada as the key determinant of the Canadian dollar's value against the USD right now. And we think that that's going to continue to be the case going forward. We think that the Fed is going to stay on hold through the first half of this year, and the Bank of Canada is going to be skewed towards cutting rates in the first half of this year while this trade war continues escalating. And when that's the case, it's really difficult to stay bullish on the Canadian dollar. I'm not an FX strategist, but when I think about the Canadian dollar in the context of the economic outlook, to me, the weakening loonie portends perhaps a rebound in inflation in 2026. But again, that is in part because of monetary policy divergence that we've already seen. I would expect to see more monetary policy divergence ahead as a consequence of the weakening growth outlook in Canada specifically.
Stuart, thank you so much for your insight today on a big day, of course, Bank of Canada Announcement Day. Bloomberg Economics economist Stuart Paul. We just want to update you as well that Mark Carney, the incoming Prime Minister in this country, has spoken in Hamilton, Ontario just moments ago. He said he's ready to meet with U.S. President Donald Trump and is looking for a common approach to resolve the trade tensions between the two countries. When we come back, we'll take a look at how today's Bank of Canada announcement may affect homeowners and their mortgages, and if now is the time to lock into a fixed-rate mortgage.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian Preferred Share ETF, Mulvihill.
I love that my daughter still needs me, but sometimes I can't help due to pain in my hands. So I use Nervive Nerve Relief.
Its dose of ALA helps relieve pain associated with peripheral neuropathy, with results starting in 14 days.
Now I can help again. Feel the difference with Nervive.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
Have you recently inherited $10 million or more? A significant inheritance can be complex. At Stinner Wealth Partners, we can provide specialized guidance to inheritors. Contact us today in complete confidence. We'll be here when you are ready.
Ever notice some odors don't come out in the wash? Odors like those from sweat, urine, and other musty odors can get trapped in fabrics. Try Downy Purifying Rinse. Just add to the fabric softener drawer. It's formulated with odor-releasing technology to help remove odors 3 times better than detergent alone. Plus, it's gentle on sensitive skin and on all fabrics. Release trapped odors the first time with Downy Purifying Rinse. Also available in fragrance-free. Brand power helping you buy better.
Helium Evolution, advancing Canada's quest for a critical mineral essential in today's most advanced technologies. With helium demand forecast to explode by 70% over the next 15 years, a land position of over 5 million prospective acres in Saskatchewan, among the world's cleanest helium producers, and an ongoing development program in partnership with the industry's largest producer, one company is poised for significant future growth. Helium Evolution, unlocking Canada's helium potential.
The federal government has announced new 25% counter tariffs on nearly $30 billion worth of U.S. goods after the U.S. Trump administration went ahead with global levies on imports of steel and aluminum into the United States. Ottawa's retaliatory tariffs will target U.S. steel and aluminum products as well as consumer items like computers and sporting goods. The new levies will take effect tomorrow. The U.S. tariffs have also triggered an immediate response from the European Union, which has announced retaliatory tariffs on U.S. industrial and farm products. The Bank of Canada cut its key interest rate by 25 basis points this morning to 2.75%. Governor Tiff Macklem calls the trade battle with the U.S. a new crisis and says there are warning signs the trade conflict could disrupt Canada's labor market. Macklem also said business intentions to raise prices have increased and firms are lowering their sales outlooks and scaling back hiring plans. Macklem also reiterated there's a limit to how much the central bank can intervene.
We've been very clear, monetary policy cannot offset the impacts of a trade war. We're going to get weaker economic activity, we're going to get higher prices, higher inflation. We can't change that. What we can do is ensure that any rise in inflation is temporary. We're going to do as much as we can to help the economy adjust to the painful adjustment to higher U.S. tariffs.
Shares of Peyto Exploration are higher by 3%, as you can see. That comes after that company released its latest earnings. Peyto reported profit that exceeded estimates and also posted earnings that topped expectations. Revenue, overall production rather, rose 11% versus the year before and came in above estimates. Peyto noted the majority of its existing natural gas contracts tied to the U.S. are physically delivered within Canada and therefore would not be exposed to U.S. tariffs. Here's a look at North American markets after a couple of consecutive days of declines, one of them Monday, a day of severe declines. Here's an up day, at least 2 hours into the trading day. The TSX Composite is up by about 1/4 percentage point. The U.S. markets, as measured by the S&P 500 and the NASDAQ Composite, are also trading higher. Here's a quick snapshot of where the strength is coming from in Toronto. Shopify up by 3.5%, adding 41 points to the rally on the TSX, followed by Royal Bank of Canada, Constellation Software, Canadian Natural Resources, and Bank of Montreal. Those are the top 5 most influential advancers. Well, for Canadians waiting on the sidelines, getting ready to make the decision to buy a new home or renew an existing mortgage, let's find out what the Bank of Canada's 25 basis point rate cut could mean for mortgage rates. Let's bring in an expert in the field. Ron Butler is a mortgage broker at Butler Mortgage. Ron, thanks for coming in.
Thanks.
Okay, 25 basis points. Let's just remind viewers what happens when the bank cuts, what happens to mortgages when the bank cuts its interest rate.
Sure, we'll have all the major banks switch prime by tomorrow. By the end of the month, those savings will be reflected for variable rate holders and HELOC holders. They'll see their payments in some cases go down, but they'll all see their interest go down. So it's just good news for variable and home equity line of credit people.
A very different story in the fixed mortgage market, correct? It's all to do with 5-year bond yields, correct?
All to do with bond yields, and that's a bit more precarious. As the Bank of Canada Governor addressed this morning, there is probability that there will be some inflation, but before that, there'll be some downward trends. So most likely, the bond yields will come off a bit, and we'll see slightly lower fixed rates, but it's not going to go to the bottom anytime soon.
So how do homeowners grapple with the question of, do I go variable or do I go fixed?
I think it's a very strong assumption that we'll see further cuts. I think the Bank of Canada Governor almost alluded to it. But so therefore, if you have enough of a risk tolerance, if you're secure enough in your job, that's going to become the more important question moving forward for home buyers. Like obviously, if you're a physician or you work at a hospital, you're probably fine. But you can say, yeah, I can take a risk on variable. But for those who may have more precarious job positions, in the light of these tariffs, in the light of an ongoing trade war, then you might want to be inclined to take fixed.
The risk in variable, obviously, is that the rates can go up and your rate can go up, correct?
Absolutely true. And the reality of a trade war, in almost every case, some kind of inflation is a result. Now, it could take a while. There could be offsetting things like rents going down, but still, prices in all likelihood do go up.
Okay, one story that has been shoved squarely to the back burner now, because we're talking about tariffs constantly in this country now, is the mortgage rollover, the mortgage renewal story in Canada. That many mortgage borrowers who locked in 5 years ago or so must renew this year or in 2026 at rates that, while they've come down recently, will likely be higher than they checked in at. What is your take on that situation?
Well, obviously, with every decline in rate, that's a positive for those folks. Here's what we're noticing. So many of these renewers are often asking for what's effectively a refinance. They're saying, hey, can I increase my line of credit? Could I take some money out of my mortgage? Can I get an increase? Because I might want to put some cash aside. I'm a little concerned. I want to pay my bills down. So there is this kind of anxiety that does exist, and we have seen it.
There were questions on in the Bank of Canada press conference today about recession probabilities. The bank, as you can imagine, deflected those questions. Do you think a recession is possible, and how would the mortgage market handle a recession? What would be some of the consequences?
Well, I think a recession is a genuine possibility, and this is the key element to the mortgage market and recession. Unemployment is the biggest driver of default. Nothing else is. It's the thing that keeps bank chief risk officers up at night. And that's something that we will see decidedly. We've had incredibly low default rates in Canada. It was as low a year ago as 0.15 basis points.
Yeah.
Up to 22 now, headed for 24. But a major recession with a lot of unemployment, you're looking at defaults in the 40 basis point, 50 basis point range.
Close to half a percentage point, 4/10 or 5/10 of a percentage point. How high is that historically? Defaults in this country are typically very, very low, are they not? Certainly compared to the U.S., and would it be fair to say compared to many other advanced economies?
Oh, absolutely. Our default rates in Canada on mortgages are extremely low, have been, and continue to be. And in fact, in the last couple of years, they've been half of what the historic average is. The historic average is about 36 basis points.
Right.
So even at 40, even at 50, Still easy for the banks to handle, not a big issue, but very hard for the humans involved.
Yes,
very tough.
Absolutely. What's more difficult for the banks to endure is, as you say, defaults are almost de minimis. What's more difficult is a drop-off in mortgage demand. Would you see a drop-off in mortgage demand in a recessionary environment?
I would absolutely see a drop-off in demand. I mean, the banks are encountering a lack of demand today. They're responding with aggressive rate wars, which is, I know even Dave McKay actually used those words at RBC. It was amazing. It's sort of true. There are aggressive rates from the big six banks, and we'll probably see more aggressive rates. But yeah, fall off in mortgage demand is pretty evident.
And does that translate through or transmit through to pricing, to the price of homes in different markets around Canada?
Yeah, it's super regional, obviously, but I think we're absolutely going to see that translate into lower house prices in Ontario. It's almost unavoidable, and possibly lower house prices in British Columbia. Now, not vastly lower, not 25, 30% lower this year, but a grinding down of house prices in Ontario and British Columbia.
Okay. Just to conclude where we began, your base case prediction is more Bank of Canada rate cuts this year and therefore variable rates coming down.
That is my prediction, and I'm pretty confident.
Okay. Ron, thanks a lot, as always, for coming in.
Thanks.
Ron Butler is a mortgage broker at Butler Mortgage. Coming up, it's not just Canada, Mexico, or China that are fighting back against U.S. tariffs. This time, retaliation is coming from Europe as well. That's next.
At Genesis, centered around you means reflecting your every need. Like respecting your time with 5 years of vehicle care and providing you with all-inclusive seasonal care, including winter tires, installation, storage, and valet service. This is effortless ownership. This is what sets Genesis apart.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
Invest like a champion with Hamilton Champions ETF CMVP and SMVP. Exposure to Canadian and U.S. dividend all-stars. Hamilton Champions ETFs. Zero management fee until January 2026.
This is severe weather. It's getting worse in Canada, and we are all paying the price. But this is what protecting Canadians from the impact of severe weather looks like. The 140,000 people in our home, auto, and business insurance industry working in your community, advocating for solutions that protect all Canadians. It's all part of our plan to protect the things we love.
Invest in high-quality dividend growth stocks. Get high monthly income and enhanced returns. Add these top-performing dividend funds to your portfolio. DGS and GDV on the TSX.
4 legends competing to create the next superstar.
Welcome back for a look at some of the important stories in the world of business this morning. We spoke earlier with Bloomberg's Divya Balji. She's managing editor for Breaking News Americas. She works in the Bloomberg News Bureau in downtown Toronto, and she began with a discussion on why Europe is fighting back against the U.S., slapping 25% tariffs on European metals.
There is a clear reason as to why the EU is doing this. Obviously the US has slapped 25% tariffs on steel and aluminum. There are certain countries in the EU that this impacts more so than others. Obviously Canada is the largest steel exporter to the US. There's Mexico, there's Brazil, but there's also Germany in the EU that, clearly is getting a hit. This retaliatory tariffs, specifically going to industrial products to the US, is also sitting at, for goods, of about 26 billion euros. So clearly it's a huge retaliatory effort that's going on here. The EU has come out to say that this is really not something they want to do, but they do have to do it. They're also saying this is going to impact the economy, it's going to impact jobs. Now the question is where do we go from here? Is it just the US has slapped these tariffs and the EU has retaliated? Will there be any discussions? There are a lot of countries involved in this. It's not just the EU, it's not just Canada, it's countries in Asia as well, and a lot of them are calling for discussions with the US to try to figure out what can actually be done. And I think that's the next step here. We obviously still have April 2nd for reciprocal tariffs, but we also have, this current situation that we're dealing with. Are there going to be more negotiations? Is Trump going to back down? Is the EU going to provide something to the US that could help with these negotiations? There's just so much left on the table here that we're all still trying to sort of put together and see what's next when it comes to the global trade war.
Okay, you and I have spoken recently and to our viewers about Walmart. There have been reports that Walmart has gone to some of its Chinese suppliers. It gets a lot of its retail goods from China and asked those suppliers to cut their prices because of U.S. tariffs. What is the follow-on there?
Yeah, now Beijing is going back to Walmart saying, hey, what are you doing here? You are hurting these companies that are based in China. They've had conversations with Walmart executives. I believe that took place yesterday. And essentially what Beijing is saying is, if you are going to do this, you're going to see more action from us. And I think this is China's way of basically pushing back on some of the global trade war situation that they're in. The fact that they are fighting with the U.S. on tariffs. They have slapped retaliatory tariffs, and I think now they're looking at it from a company's perspective. If Walmart is taking a hit from these tariffs and they are going to Chinese companies that are supplying them with goods and asking them to cut their prices, Beijing is now saying we are going to step in, we are going to help our companies that are based here, and they're trying to have these discussions with Walmart. So I think they're doing it from two perspectives. One is they're trying to figure out what can be done with Walmart, but they're also sending a very strong message to the U.S. that if you are going to do this and it is impacting your companies, you can't come back to China and try to get those costs cut again on top of tariffs that are being taxed on the country. So it's quite an interesting development. Walmart is one of these companies that keeps taking a hit in these situations in particular. They are a discount retailer. If they can't cut their costs, they are going to pass it on to the consumer, which means higher prices, which means it's going to impact the economy as well. So not great news for Walmart, but understandably so. China does have to come back and have these discussions.
Coming up, major airlines have cut their forecasts recently, and Air Canada stock is way down. We'll bring you a deeper dive into that sector when we come back.
Is this how you're hoping to retire? Well, hope isn't a good retirement strategy. You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals. Have someone on your side to keep you on track.
Call for Fisher's Comfortable Retirement Kit with the help you need to make your retirement a success, including the Investor's Guide to a Comfortable Retirement, 12 retirement investment blunders to avoid, and 7 secrets of high net worth investors. Call 1-888-601-1168.
Fisher Investments tailors a plan to keep you on track for the retirement you want. And as a fiduciary, we do better when our clients do better.
Call now for your free Comfortable Retirement Kit. 1-888-601-1168.
If your retirement portfolio is $500,000 or more, call us today. You don't have it coming to you unless you plan for it.
1-888-601-1168.
Gold standard. Gold dust. Pot of gold. Solid gold. You're worth your weight in gold. Golden boy, golden girl, golden goose, golden egg, golden age. golden ticket, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
As we noted before the break, a couple of big U.S. airlines have cut their forecasts recently, citing macro uncertainty. Earlier, we spoke with Robert Konas. He's president and managing director at AirTrav. He says should the sector continue to struggle, airlines may begin to slow or cancel aircraft orders, slow down pilot onboarding to their staffs, and even announce layoffs. Here's that conversation.
It's tough times in the airline business, and in travel, especially discretionary travel, it does track economic, downturns or recessions, and it's also the first sector to come back. You're right about Delta, but also American Airlines and Southwest Airlines also slashed their outlooks for both revenues and profits in the first quarter. United didn't go quite as far, but did note some weakness. That's a challenge. On this side of the border, we're seeing stocks like Transat hitting all-time low, Cargojet 23% off start of year, Air Canada, who is probably the most exposed to the U.S. market, off 31%. So all of our carriers on this side of the border have all taken measures in terms of trying to divert or deflect capacity from this coming summer into other markets, particularly the domestic Canadian marketplace.
And how successful might that be? How the Canadian market is only so large, of course, compared to the U.S. market. How successful can these companies be at diverting capacity, which is our aircraft and seats, to the domestic Canadian market?
Certainly, consumers, and by the way, just like your previous guests have said, business and consumer confidence in terms of how it interacts with travel decisions, whether it's corporate, government, leisure, it's all intertwined, and right now it's really tanking. Canadians have certainly been very vocal about trying to pivot from the U.S. and have talked about leaving their vacation spend this summer in Canada. But to your point, it's only so big. I think the challenge that all of our carriers are going to face is that dumping a lot of additional capacity, seat capacity, into this relatively small domestic market, and there's only so many routes that make sense. That's going to put downward pressure on yields, average pricing, and that in turn is going to impact profitability for all the carriers going through into 2 and 3Q.
Robert, this is Bill Harris. When the oil price originally went up, and that sort of had to get passed on to the flyer, but with the fuel prices coming off, is there any impact yet on that? And can a ticket price get cheaper and then just incentivize people to fly, or are we too early?
Well, just to be clear, in this country, there's only fuel surcharges. They're not even called fuel surcharges anymore. The carriers have called them international carrier surcharges. They only apply to international revenues, not domestic, not transborder. But the carriers have proven over time that the surcharges tend to be an interoperable revenue lever as opposed to a mechanism that closely tracks fuel. To your point, I mean, we've seen surcharges rise when oil prices rise, but they don't always come down in step when oil prices drop. I think the bigger challenge for oil prices is that while we have oil prices falling, that 69 or 70 cent Canadian dollar is tough for the carriers. They're buying fuel, a lot of their aircraft leases, outside third-party maintenance contracts, their product distribution contracts. All of those items are U.S. dollars. I don't know if there's a silver lining there with another cut in the Bank of Canada rate, but all the macroeconomic indicators are pointing the wrong direction for this sector right now.
Air Canada, Robert, as you know, has fairly recently outlined a series of ambitious longer-term financial targets. I believe $28 billion in revenue by 2030 was one of its targets. Does this situation put those longer-term forecasts at risk?
Well, it's just one step back for a second. It's too bad all this is going on because a number of our carriers have had some really good news lately. You had WestJet rolling out a significant upgrade and change to its loyalty program to compete better with Air Canada Aeroplan. You've had Porter making some moves, for example, opening a base in Hamilton, Ontario. But I think profit targets this year are going to be in jeopardy. The International Air Transport Association, of which is about 280 members, including Air Canada, Transat, Cargojet in this country, they announced last December their 2025 outlook of $13.8 billion profit for this year, based upon a 3% increase in capacity, in traffic, and a 2.8% increase in capacity. I think that IATA, by the middle of this year, is going to be having to revisit those figures. All of our carriers are going to have to revisit where they're at. For Air Canada, I mean, you have to look at this industry as cyclical, as a high fixed cost industry, high capex, spending decisions. You've got to consider things, in the 5 and 10 year cycle. So I think Air Canada is probably still okay in terms of this longer picture. This year, though, is going to be a bit more of a challenge.
That's Robert Konas, President and Managing Director at AirTrav Incorporated. Just before we say goodbye, let's take a look at markets on Bay Street and Wall Street and how they are trading. It continues to be a positive day. The NASDAQ Composite in particular has got a good head of steam going. It's up by 1.2%. The S&P 500 in the U.S. is up as well, and so too is the S&P TSX Composite, also up by about half a percentage point. Let's take a look at the Canadian dollar in focus today because, of course, of the Bank of Canada announcement. That announcement came in as expected, so there was no abrupt movement in the Canadian dollar at 9:45 a.m. Eastern Time when the bank, as expected, released its decision to cut the influential overnight interest rate to 2.75% from 3%, a cut of 25 basis points. Here's a look at the S&P TSX Composite Index on an intraday basis, or there's a one-year basis actually, and you can see that despite the recent pressure, it remains up 12% over the past year. On a yearly basis, so far this year, it is down 1.5%. There's the intraday. You can see we've been in positive territory for most of the day. A little bit after 11 o'clock, the TSX spent a little bit of time in negative territory, but buyers stepped in and sent it to what looked like close to session highs so far. Here's a look at some of the sectors within the TSX Composite. Let's go to the bank stocks first. The financials, there you see the financials on an intraday basis as well. Also very similar to the TSX itself. The financials are very influential within the TSX, so it would not surprise that the shape of the two intraday graphs are very similar. Let's go to a stock that is one of the top performers on the TSX, Transcontinental. That's the big printing and marketing company, TCL.ca on the TSX, up by nearly 6%. It reported results after the close yesterday, reporting higher adjusted profit and just declaring a special dividend $1 per share. Let's go to gold. All kinds of attention on gold these days with equity markets under pressure, and there's gold holding steady at about $2,900 per ounce, specifically $2,935 per ounce. Here's West Texas Intermediate crude. It was up the last time I looked at it. Let's see where it is right now. It's still up by 2%, so WTI having a strong session. Quickly, here's a look at Bitcoin, which has been under pressure recently. And there it is again, under pressure again to $81,500 per coin. Market Call gets underway in just a few minutes. Keith Richards is on the show today, President and Chief Portfolio Manager at Value Trend Wealth Management and expert in technical analysis.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me or is there some kind of clue here? I don't know.
On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
We all need fiber for our digestive health, but most Canadians only get about 50% of the fiber they need. Good thing Metamucil gummies are an easy way to get plant-based fiber. 3 gummies have the same amount of fiber as 2 cups of broccoli. Metamucil gummies, the easy way to get your daily fiber.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach. One that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
I just took a shower above the clouds. You know why? Because this is the Emirates A380.
No amount of studying can guarantee a gambling win. Find tips for safer play at gamblingisrandom.ca.
Fernandez, thanks for joining us here on Market Call. Keith Richards is on the show today, President and Chief Portfolio Manager at Value Trend Wealth Management. He's taking your questions today on technical analysis. Here's how to reach us. 1-855-326-6266 if you want to give us a phone call. You can also email us at marketcall@bnnbloomberg.ca. Keith, thanks for coming in. Appreciate that. I know you do technical analysis, so I want to ask you very specifically, in a short-term period, with so many fluctuations as we have seen over the past few weeks, does that make it harder to do what you do?
No, actually, I mean, you don't want to sound like a braggart, but I've been calling this all along. You can look at my blogs. I write a very popular blog, and I do YouTube videos and stuff, and I've been saying since literally the beginning of January that we were going to fall off the cliff a bit. For many reasons, I mean, beyond the whole Trump tariff thing that everybody's talking about, but I always look at the market as a balloon, and you blow the balloon up, and then the balloon gets too tight, and it just looks for the excuse. So, you know, you look at COVID, you look at 2008 with the tech bubble, you look at 2008 was the subprime bubble, 2001 was the tech bubble. Anytime, even 2022, before the market was overdone on many, many factors, technical and fundamental. Well, here we were again. And so I knew that we already had the big balloon. We just needed so tariffs come along and markets sell off, but it would have been something else. So we've been raising cash. And so, no, it's easier when you get either extremely bullish or extremely bearish. And we had a very over-the-top bullish market last year, and we were very, very overdue a strong correction.
Okay, so now that you see the sell-off, I'm wondering if there are certain trends within that you've noticed.
Yeah, I mean, tons of sector stuff. So, you know, what we've tried to do is rotate a lot into the commodities that are not related to the financial assets, like the stock markets. And not all commodities look great, but, you know, we buying, over the past year, we've been buying tons of gold. We still like it, although it's really had a run. It's probably a little overbought. We actually, a couple months ago on the blog, I was telling everybody buy nat gas because it was breaking out, and it's done quite well. We still like nat gas producers and nat gas. So we just sector rotate, and we're also we bought some U.S. bonds because, again, that it's likely that their economy is going to be a bit tighter with the tariffs and stuff. So we bought the bonds about a month ago, and they've done okay. So you can buy stuff. There's stuff you can always buy that makes money. The market, money doesn't sleep, as they say. It goes somewhere. So we're holding cash, we're holding bonds, and we're holding sort of non-correlated assets, and we're doing okay. We've got some stock assets, and they've suffered, but we have some other stuff that's like the gold and whatnot that's doing quite well. So that's what you have to do. You have to be very mobile.
Okay, talk to me about volume, because there's been higher volumes, I imagine, over the last few weeks. And what do you do with that? Where are you seeing the biggest numbers?
Well, it's interesting because by itself, volume, I use money flow, which is volume is a component of that. So it takes whether the market went up or down, and then it attaches the volume to whether it went up or down. So and you can look at a line that tells you whether there's money flowing into or out of the market. And then I'm getting complicated here, but then I look at the momentum of that money flow. Okay, so how
do you determine the momentum of that money?
Well, there's actually indicators that you can
look at.
Yeah.
Okay.
So money flow index is one of them. MFI. If anybody has stock trading, like stockcharts.com or whatever, they have money flow index. So what I saw, and it's been happening for a while now, is the money flow has been falling. So even though, in volume's going up, so it can fool you, but it's been months and months and months. I'm talking like that was one of the reasons why we went 20% cash very early, a couple months ago. We're actually looking to raise more cash if this market keeps moving down. But whatever the case, the money flow was telling me way ahead of time that sure, volume was picking up, but it was only because people were getting out. So this kind of thing, technical analysis is the main tool you want in markets like this.
Got it. All right, Keith is sticking around to take your questions for technical analysis. We will keep him here, and here's how to reach us as we go to a break. Again, 1-855-326-6266 for a phone call. Market call at bnnbloomberg.ca if you are emailing us. We're back in a moment.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Welcome back. Thanks for joining us on Market Call. We want to go right to your emailed questions. This one is from Ron. He says, what do you think about Whirlpool? And that's directed to you, Keith. What do you think about Whirlpool? I haven't talked about Whirlpool in a while.
Yeah. So we're going to start off with 5-year charts, and then if I need to look closer, then I'll ask for a 1 year. But generally speaking, anybody that follows my work, I'm assuming that this person, because he asked for me by name, they maybe follow my blog and whatnot, they know that a trend is defined by peaks and troughs. So if we look at this chart, there is a downtrend. And so how do we define that? A couple things. Are the peaks and troughs going lower? Yes, they are. The other thing is that I can't show on this chart, where is the market against the 200-day moving average or 40-week moving average? And I would assume that it's below. Now, what you are starting to see is possibly, so I'm going to clear the screen, and maybe I will ask for a 1-year chart here, but you're starting to see, oops, that's quick. So there's a possibility, if we go back to June of last year, that would be around, it's hard to see that, but it's maybe, what, $80 or something? Sorry, I'll clear the screen so I can see the number. Yeah, that's $90. So around $90, there is some support. You can see that back June, July of last year. If this zone can hold, that would be called support. If it can bounce off of that, but not until it bounces off, then that may be the end of the downtrend. But until that happens, all we know is that it's at best consolidating with a big question mark beside that.
Okay, for the novice, why 200 days?
Honestly, the 200-day, for two reasons. First of all, it is a big indicator. So in other words, it takes out a lot of the noise. Like the 200-day moving average will tell you the general trend, and things are going up and down. The smaller, shorter indicators, they move around a lot too because they're a short-term moving average. So that's one reason. But the other reason is, honestly, a lot of what I do is behavioral finance. In fact, I wrote a book on the whole subject of behavioral finance called Smart Money, Dumb Money. And really, it's all about what people think is going to happen. So many people believe in the 200-day moving average, it becomes a self-fulfilling prophecy.
Got it, okay.
So, it breaks the moving average. Lots of guys like me, technical people, will go, oh no, it broke the 200-day, like what the S&P did the other day.
It's almost a cycle of personal sentiment. People, this is what they think. Okay.
Yeah, so it breaks because the market's been bad or whatever, and then people go, oh, it broke, and therefore it's bad. It's sort of cart and horse or whatever they say.
Okay, let's go to the phone lines. Joseph is on the line. He's calling us today from Montreal with his question. Hi, Joseph.
Good day. Thank you for taking my call. Keith, I want to know how to say or how you view conflicting pieces of information versus, like, specifically what the charts say versus what some other reports would say through the lens of Tariff. The charts actually look really good. It's above the 200, it's above the 40-week. Money flow is looking up, RSI is looking up, MACD is looking up. But there's a slow but growing short interest against Tariff right now. So if you see those two pieces of information, how do you weigh them against each other, and is Tariff a worthwhile investment? Thanks in advance.
Okay, so well, we'll cover first thing. Yes, you're right. It's actually. Boy, I'm going to get my hand a little bit more steady.
Okay.
I drank a couple of coffees. I'm really
a little jittery today.
A little jittery.
Okay.
So there is a bit of a neckline. I keep drawing this. Okay, that's a better shot at it. There's a neckline there around 22.5. It looks like, and it's trying to break that. And so far, you would see, like you said, some of the momentum indicators and stuff hooking up because we got a nice move. It is struggling a little bit at that 22.5. If it breaks out, that's very, very good news because it means the downtrend ended, the base ended, and a breakout to the upside would be lots and lots and lots of positive resistance points that we could use as targets. So it is a decent chance, but personally, I would not buy this stock until it broke out because I want to see evidence it did. Now, Joseph was asking about shorts and all that kind of thing. It's part of the equation, but we really look at the chart and the fundamentals. Craig O'Coin at Value Trend, he's a CFA, so he'll tear the company apart, see if it's a good company. The short interest and stuff is kind of like icing on the cake. It can matter if there's you get too many shorts on a crowded trade, and then they suddenly have to start covering because the stock moves up. Then like the shorts might have to cover if the stock breaks that base we just looked at. But that's the only reason I would pay any attention to the shorts.
Got it. Okay, let's go back to the phone line. Nazar is calling on the line from Scarborough with his question. Hi, Nazar.
Oh, hi, Marilla. Hi, Keith. May I have your thoughts on technical analysis on Air Canada, please? With so much prevailing negative sentiment resulting from Trump tariffs, Air Canada is cutting summer destinations to the U.S. Your thoughts, please. Thanks for taking my call.
Yeah, we're also hearing about people generally not traveling as more. Mostly, we're hearing that from the U.S. right now, Delta and American Airlines, as a result of recession fears.
Yeah. I mean, the economy, look, airlines are economically sensitive stocks, right? So there's definitely, that is a definite factor. And I don't think there's, even before the tariffs, there was pretty strong evidence that, I mean, Canada was already moving into a softening economy, and there was evidence that the U.S. was eventually going to, and here we are. The tariffs have sped the process up. But we were going to move into a soft economy. It was due. Like I talk about the market being a balloon, well, the economy can be a balloon too. So yes, airlines will suffer. Now, when I look at Air Canada technically, though, look at that base. I mean, this is actually pretty interesting because that's a pretty, like, I do a lot of what's called swing trading. I love this kind of pattern, and it's really as long as you follow the dotted line, you can make money on swing patterns. So if and only if Air Canada arcs up with definite, conviction off of this, whatever it is, $15 or so support, then it could very well head very close to 24. It may not reach it all the way, but it might get close to 24. That's a pretty good trade. I wouldn't do it until it broke up, and you will need some fundamental confidence, such as maybe Trump backs off on some of the tariffs or something. I don't know. But there'll be a reason. It'll need a reason. But if the reason comes along, you've probably got a $24 stock on your.
When you say if it bumps back up with conviction, what do you mean by that?
Well, you know, you can get spikes. So a lot of the things I have a technical analysis course that I have online. And one of the things I talk about is, look, if something breaks out, you don't just go, oh, look, it break out, I'm going to buy it. Or something breaks down, you don't say on day one, I'm selling it because it just broke down a support level. You have to count a few days because you can get head faked, you know, like the boxers get. So I usually count at least 3 days. I have a rule of minimum 3 days, and then I'll make my move. So I need it to move for at least 3, 4, 5, 6 days, something like that. Then I would consider legging in a little at a time.
Interesting. All right. On that, we do have to take a quick break. We're back with Keith Richards in a moment, President and Chief Portfolio Manager at Value Trend Wealth Management. Taking your questions today on technical analysis. We're back in a moment.
Your chance to set everything right. And keep her alive. Save her, you can save her.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help. The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
At Genesis, centered around you means reflecting your every need. Like respecting your time with 5 years of vehicle care and providing you with all-inclusive seasonal care, including winter tires, installation, storage, and valet service. This is effortless ownership. This is what sets Genesis apart.
Looking to maximize your monthly income? Our Yield Maximizer ETFs combine your favorite sectors with a high-yielding income-first strategy to help you meet your goals. More income every month from Hamilton ETFs.
Closed captioning of this BNN Bloomberg program is brought to you by Good Read Investment Council. Invest with confidence.
Stocks on.
Welcome back. Thanks for joining us here on Market Call. We're going right back to the phone lines. John has been holding on the line from London in Ontario. Hi, John.
Hello, Marilla. Hello, Keith. Keith, I have a general and a specific question on two components of technical analysis. The first is, what do you do if an overwhelming macroeconomic intruder appears, such as tariffs, to your technical analysis? Secondly, the specific question, what do you do when a company like Whitecap wants to merge with Varen, subject to tariffs and also in the setting of a merger? Thanks very much.
I've never heard the tariff described as the intruder, but there we go.
Yeah, well, see, so both of those are actually fundamental things, and I don't cover the fundamentals, but here is the answer anyways. Everything is discounted in price. That is one of the original concepts of technical analysis. So, in other words, you already know about the tariffs, so they're discounted. You don't know what's going to happen next, but you have everything that there is to know, and the stock market has, and this is one of the reasons why I like more liquid stocks, because there's more participants, and then the crowd knows overall. So when it comes to this stock, I can look at support, and I can say, that's real because we know everything about, you know, the tariffs and the company and the merger and everything. It's all built into the price right now. And then if the stock, like, I will look for a bounce. I repeat myself a lot on this, but you need a bounce off of support. If it doesn't bounce off of support and it goes below support, then you have a problem. You don't want to own this stock. But if it does break up, move up, then you have a target of somewhere around, you know, 11 or 12 bucks. So that's all I can tell you on this. And as far as the tariffs and stuff, that as well is built in because there is concerns over the tariffs. So that's built into the price right now. That's why it's down.
Got it. Okay, let's go back to the phone line. Deborah on the line from Okanagan Falls in BC. Hi, Deborah.
Oh, hi. Good morning. Keith, my question today is on this wonderful company, CNQ. I took 2 positions before all this mayhem, and I'd love your analysis on the sideways trade and also the long-term chart. But my secondary question is, I know you analyze chart patterns daily, weekly, and yearly, but when you do decide to do a buy or sell, do you analyze like best buy and sell times during the day, or am I just splitting hairs?
Interesting. Do you go down that detailed?
Well, I have no hairs to split.
There you go.
But I don't do intraday stuff. Okay. No, it's fairly meaningless. I mean, even the daily stuff, because I'm looking for a trade that will last me 3 months, 6 months, and if longer if it can. But often we're trading our stocks out every 3 to 8 months. Okay, so I don't care about intraday. So let's just, hopefully that answers that. I just want to go right to the chart. We owned CNQ. We sold it a little while ago, and I'll show you why. It was moving up, and then it started to consolidate, which I'm fine with. I don't mind consolidations. There was an old resistance level here, and it became new support here, and then all of a sudden it broke down. So I was just mentioning that I count a few days. I don't just sell on a day down below. So we actually gave it a good couple of weeks, and then we sold. We sold it, I don't know, 3-4 weeks ago, and we're up. Yeah.
Got it. All right, let's go back to the phone lines. Gary on the line from Toronto. Hi, Gary.
Hi there. Thanks for taking my call. Keith, on B2 Gold, you commented on it last February, about a year ago. Since that time, B2 Gold continues to be an underperformer related to all its peers and its mid-caps. I've been holding it for almost 3 years. The indicator, they're saying it's just hitting the 200-day market. There's a 5% short index position in it. And basically, fundamentally, they signed a deal like Barrick with the Mali government last October, and the stock popped up to 480. Now it's retraced it all back down again because they have not been able to implement the agreement in Mali. So that's the fundamentals. It is at the 200-day. It has been sliding for 3 years. It has not participated. Is it time to drop this doggy to the back door?
Okay, good question.
Yeah, it's a junior gold, or a smaller gold. So yeah, I mean, I own a lot of gold. Like Value Trend holds at least 15% gold, plus we have silver. Like we're in on that trade, and it's been a great trade. But it's been the seniors. Like we own Barrick, for example. We own the ETF, the XGD. So which holds a wide variety of stuff. But largely, I like gold. But on an individual basis, it's been largely the big guys. Now there could be a catch-up trade, so just be aware of that. But what I'm seeing is, like, as a technical guy, if I want to own gold, I'd rather go with something that was at least, maybe had consolidated, like this may be, and broken out. Because for example, we bought our gold positions when gold broke out about a year and a half ago, and every stock that we've bought since has always had to have that same pattern, that breakout pattern. So I wouldn't buy this until it broke out, and that's just the way we operate. Doesn't mean it's the right answer, but it's just we wouldn't buy this.
Got it. Okay, let's move back to the phone lines. Pankaj is on the line from Brampton, Ontario. What's your question today?
Yes, ma'am. Thanks for taking my call. I just wanted to buy these stocks of Tesla for a period of 6 months to 1 year. So is it a good price point, or is the market going to go much down from this? I just like to know your views about it, please. Yeah. Thank you so much.
So Tesla having a bit of a rebound in the last 2 days, but has a long way to go.
Yeah, and it's interesting because I got a text now we're discretionary managers, so we run a model, and our clients can't do individual trades with us. We just do the model. But he asked me, this person has been with me for 30 years as a client, and he texted me and he said, hey, Keith, are you guys looking at Tesla? And I have that relationship with him. I'm like, well, it's funny because I was looking at it the other day. And so there's a principle in technical analysis you're seeing here. Old resistance, which is a level that the stock can't get through, becomes new support. So that may, see, I said it 3 times, so people hear it correctly, may be support, and maybe we see a bounce. A couple of days is not enough evidence for me to say anything, but I would I would look at it seriously because there's a lot of negative sentiment. I can, the fundamentals, people don't like Elon because he's helped Trump or whatever. But at the end of the day, it's a car company. And hopefully people will recognize the car for what it is. I think they're a well-made car and a well-run company. So, at some point, there could be a bounce off of the support level. But until that happens, why risk it? You want to see some evidence that the market is starting to forgive whatever it is that they didn't like about it, and maybe it's a good trade from there.
Okay, so just to clarify a little bit more, how many days would you wait? Because as I mentioned, it's been up the last couple of days, but it's dropped so much. What kind of trend are you looking for?
Yeah, like you can get a dead cat bounce for a few days. So I mean, minimum, rock bottom minimum, at least another week. I go up to, my rule is 3 days to 3 weeks, depending on the stock.
Okay.
So I'd give this one closer to the 3-week mark.
Got it. So. Good to know. Okay, we're going to take a quick break. When we come back, a look at our guests' past picks. That's coming up.
Helium evolution, advancing Canada's quest for a critical mineral essential in today's most advanced technologies. With helium demand forecast to explode by 70% over the next 15 years, a land position of over 5 million prospective acres in Saskatchewan, among the world's cleanest helium producers, and an ongoing development program in partnership with the industry's largest producer. One company is poised for significant future growth. Helium evolution, unlocking Canada's helium potential.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian Preferred Share ETF, Mulvihill.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach, one that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
Have you heard about a weekly? It's the first long-acting insulin with once-a-week dosing. Get the ball rolling. Ask your doctor if a weekly is the right long-acting insulin for you and visit aweekly.ca.
Bitcoin is surging as major financial institutions rapidly integrate it into their portfolios.
Bitcoin since the election has gone from $60,000 to $100,000.
Deregulation across the nation means strong support for Bitcoin, and Hive is thriving. Hive is positioned to quadruple their global footprint in 2025, aiming to capture 3% of the world's Bitcoin supply. Hive Digital Technologies.
Time now for a look at our past picks. Well, not our past picks, Keith Richards' past picks. He joins me at the table to go through some of those. The first one up is ARC Resources, which was recommended November 25th of last year. At the time, it was $26.72. Now it's dropped a bit to $26.12, or down 2% for the return, down 2% for the total return. What has been happening at ARC Resources?
Yeah, and you'll notice that my picks are always pretty, not like a lot of the guests get it like a year or whatever, and it's because we're fairly trading orientated.
All the time.
But we have held this one for a while. It's still a great chart. There's nothing wrong with this chart. You could call it 2% move up or down flat, but so energy has been under a little bit of pressure lately, but this is a great chart, a great company, fundamentally one of the best. So it broke out a while ago, and okay, you are here. It's pulled back a little bit. I'm not going to. It could pull back a little bit more because this old support level could easily be a target for it right now, but the trend is up, and that's all I care about.
So you see it pretty much as in a neutral zone right now?
Yeah, it might pause for a while. It's the pause that refreshes. A lot of stocks do that. They go up, they pause, they move up again. So.
Got it. Okay, let's go to your second past pick. Global X Silver Miners ETF, recommended at $34.92 American. Again, end of November last year. Now at $38.42. So up 10% return, total return of 12%. Obviously, going the right way. What was the trend here?
Well, back when I was on the show, I was telling people that, look, I mean, I've been in gold for more than a year. Gold is great, and I love gold still, but it was already reaching a point of technical resistance. So we actually sold a bit of gold, and we still got some, but we sold some, and we started moving into silver. And why? Because silver was, you know, just like if you look at gold, there's the old time highs on silver. We're way below that, and we got this base, we got this breakout. It's a more volatile looking chart, but we think it's going to go to its old highs. So we bought the silver miners, and we bought some individual stocks as well. We just think it's a catch-up trade for silver. It's a better trade than gold right now, even though I still like gold. It's a better trade.
Where is the resistance? At what point do you hit that resistance for gold? Because you mentioned you hit some resistance to gold.
On the gold producers. So
yes.
gold itself, the bullion has no resistance. There's like clean air up ahead of it, right? But with if you look at any of the indices, whether you look at the U.S. index on gold or here in Canada, okay. So well, what we're going to see on gold is that there's no overhead resistance. So okay, so it's going up. And there's nothing, like if we look at the old breakup points, it's at all-time highs. So the story is good for gold. We still like gold, but we do think it's maybe a little bit overbought, and therefore we think there's a catch-up trade, like I said, with silver. And I'm buying the producers because the producers in silver, just like they were with gold, there was a catch-up trade with the gold producers, and they did catch up. But now there's going to be a catch-up trade on silver, we think. And, you know, so far it has been working.
Got it. Okay, let's go back to your top picks. Berkshire Hathaway, always a good standard pick for a lot of people. Let's take a look at where it was at the time, November 2024, $477.43 American, now up to $491.79, so up 3% return, 3% total return. Berkshire Hathaway.
Yeah, well, you know, I come on the show, and since for the last quarter of 24 and well into January of this year, I've been whining and complaining that the market was overdone, like we mentioned at the beginning of the show. I thought it was an overbought balloon, and so we became more and more defensive through the last quarter in particular of 24, and that included buying things like value, like Berkshire, buying things like gold, buying things, you know, like commodities. We moved into natural gas a while ago. You know, we wanted something that wasn't the stock market. We recently bought the U.S. T-bills, you know. So this was November, so we were just starting that move, probably only a month or two into it. But we're now 20% cash, and we have, you know, value. We still hold this stock because it's a value play. So you got to have some stocks, and I'd rather have value than growth. Look what the Mag 7 did. They just imploded. Berkshire's gone up. That's been the rotation.
Got it. Okay, Keith Richards is sticking around to take more of your questions in a moment. Stay tuned.
We all strive for peace of mind, whether in life or our investments. But that's not easy with today's market complexity. For over 2 decades, Goodread has helped Canadians from coast to coast achieve their financial goals through both good times and bad. Working with our portfolio managers, you can navigate tomorrow's financial uncertainty with confidence. It's time. Take control of your wealth. I'm Gordon Reed. Invest with confidence. Invest with peace of mind. To learn more, visit goodread.com.
Someone told Michael, less is more. But with new Zen and Vibrant Gain Super Flings, he gets more Febreze freshness and more stuff that gets the dirt out. So he's starting to think more is more. Try new Gain Super Flings.
Is this how you're hoping to retire? Well, hope
isn't a good retirement strategy. You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals. Have someone on your side to keep you on track.
Call for Fisher's Comfortable Retirement Kit with the help you need to make your retirement a success, including the Investor's Guide to a Comfortable Retirement, 12 retirement investment blunders to avoid, and 7 secrets of high net worth investors. Call 1-888-601-1168.
Fisher Investments tailors a plan to keep you on track for the retirement you want. And as a fiduciary, we do better when our clients do better.
Call now for your free Comfortable Retirement Kit. 1-888-601-1168.
If your retirement portfolio is $500,000 or more, call us today. You don't have it coming to you unless you plan for it.
1-888-601-1168.
It's life. Practicing medicine on the high seas. Not being stuck. It's addictive. Exhilarating.
Dr. Odyssey, all new, Thursday, 9/10 Mountain on CTV.
Welcome back to Market Call. We have Keith Richards in-house taking your questions today for technical analysis. John is on the line. He's calling today from Unionville, Ontario. Hi, John.
Hi, Miranda and Keith. Good afternoon. Keith, could you please give me technical analysis on BMO? The banks have come down 5% plus, and BMO has come down maybe 10%. And I'm just wondering if it's a good opportunity. Let me know the technical analysis, please. Thanks.
Okay. Yeah, like the banks have been, again, it's been this with the T word, tariffs. There's been a flight to safety. We were talking about Berkshire a minute ago, one of my picks, you know, the golds and stuff. And the banks can be one of those good places to be. And so it's the only thing is that, so BMO, we'll just specifically address this chart. There was sort of a level of resistance going way back to 22. So it is kind of old. It's like 3 years ago. But still, you know, charts be charts, and you know, there's some reason that it decided to fall right at that old point of sell-off from 22. Things happen for a reason. Investors have memories. They remember when it peaked there, and some people are going to start selling it, and that's what's happened. So the question is, like, how much selling will take place? How much memory of those people that did buy it in 22? Because somebody bought it. For every trade, there's a buy and sell. You know, we got to wash them out, and my target would be that if, let's call it worst case scenario, there's not a prediction here, but that it could go down to that, and it's really hard to see the levels. I'm going to say that looks about $130. So maybe it'll pull back to 130. That's not a prediction, but that's probably at least a 50 or greater % chance that it'll do that before it finds support.
Okay, so should he consider selling then at this point when he's got it at 138?
It depends on what kind of trader you are, because if it continues to move down with no evidence of a bounce really soon, then yeah, I would probably, I mean, if I was a more near-term trader, see a long-term buy and hold person just say, okay, I accept it's going to go down to whatever it bounce up. But, you know, if you're more like me, I mean, you would maybe just say, let's get out and then go back in again later.
Got it. Okay. Let's go back to the phone lines. Majinder's on the line from Edmonton today. Hi, Majinder.
Hi there. My question, Keith, is on Oceana Gold Corporation, OGC.TO. I was thinking of that or CN Railway. Your expert matters on that, please. Thank you. Bye-bye.
All right. Here's Oceana Gold over 5 years.
Well, you know, as Austin Powers said, I like gold, Mr. Powers. So
everybody does, right?
Everybody likes gold. And, you know, it's hard to argue with the gold chart, although I will say that this chart looks a lot like a lot of gold charts. You know, it is coming into a point where it's seeing a little bit of pause, and that's because it did this. And so that's okay. Often a stock will have this big run, and then it has to wash out the excess. It's either like the stock market right now. I've been saying the market's got to wash out its excess. The tariffs are the excuse. It doesn't matter what it is. The market's excessive, so it's going to pull back. Well, this could be, markets pull back in two ways. They either go down or they go like this, and they consolidate. And this may be the case. In this case, because there's a really good argument for owning gold, that you may see this stock go up and down like a yo-yo for another month or 2 months or whatever, and then eventually break out. But that's to be seen. It's so far, I'd hold it if I owned it.
As opposed to CN?
We're CN Rail?
Yes.
Totally different company, totally
I know
different
he
business.
bought up Oceana Gold or CN, so I was just wondering, you take the gold over CN.
Yeah, bring up the chart. We have a small position, I think, in CN Rail, and it's been not a great looking chart, and actually I'm looking at maybe selling it. I think we do have a 2% position in it or something.
Okay.
So
you're just about to pull it up.
Yeah,
there we go.
so you can see why I'm looking at selling it. So we haven't sold it yet, but it's on a list. I sent Craig a list this morning. I said, these are the stocks I want to get rid of if there's because we actually kind of bearish on the market. So I said, we want to raise some more cash. Here's some victims that we could sell, and this is on the list.
Got it. Okay, let's go back to the phone line. To Mark's on the line, calling from Cochrane, Alberta. Hi, Mark.
Sure. Hello, how are you?
Good. What's your question today?
My question is on AltaGas. They form synergies with Keyera. Also, LPG stuff goes to Asia. And what's his take on tariffs with their gas distribution in the States? I'll hang up and listen. Thank you.
Thank you.
Yeah, so I don't have any take on the tariffs and what's going to happen in the negotiations. I think probably nobody does, but I'm not a fundamental guy. I just look at the charts. But like I said near the beginning of the show, all knowledge known at this moment is built into price. So that's the only thing we need to know as a chart follower and with my way of trading. So there's an up market. Now, the problem with this chart is that it's not a problem because you've made money on it if you owned it. It's arcing up. So it's making a sharp angle up. And sharp angles up are almost always eventually corrected. You know, here and here, and they correct. They correct just a little bit, or they correct a lot. So I'm thinking that this trend has been in place long enough that it'll probably just correct down to the trend line. So what are we at right now? We're at 38, and if we were to try to roughly draw this trend line, that might bring us back to 35 or something. So I could easily see $35 on this stock as just a regular pullback. As long as it doesn't crack that, I'd be happy with the stock. I'd continue to own it.
Got it. All right, Keith Richards sticking around. We are going to take your phone calls again when we come back. Stay tuned.
The rubber hits the road on a new season of F1 on TSN.
I have missed this. This is so close. Brilliant. This is Formula One at its absolute finest.
And it all fires up down under.
Welcome along to the Australian Grand Prix
on TSN and TSN Plus.
Day traders tend to rely on technical analysis versus long-haul traders that combine technical and fundamental when looking to buy stock. The moving average indicators are very popular with those traders that study the technical aspects of the market. I've always found them to be very helpful since they give me the stock price over a period of time, like maybe the last 20, 50, or 200 days. Another technical indicator that I use is the trend, which can give you a feel for whether the market is overbought or oversold. You could also look at the new high, new low indicator. That tracks stock that are breaking new highs and lows over a 52-week period. When you first get started, be picky about how many indicators you use. Find your favorites. There are so many to choose from, but eventually you'll find a few that make sense to you and your trading strategy. I'm Christine Ibbotson, and this is your Investor Tip today.
From Canada's leader in leveraged, inverse, and inverse leveraged ETFs, Beta Pro ETFs give you the tactical edge. Take command of the market at betapro.ca.
Closed captioning of this BNN Bloomberg program is brought to you by Good Read Investment Council. Invest with confidence.
Welcome back to Market Call. We have Keith Richards in-house, and we are ready to take your questions. Steve's on the line, or Stephen's on the line from Toronto. Hi, Stephen.
Hi, thanks for taking my call. Keith, I watched your video the other day on YouTube. It's a great analysis. For those who don't subscribe, I'd actually recommend that, Value Trade Canada. But speaking of the Mag 7 imploding earlier, I was wondering about Amazon. I was looking at the 5-year chart just now. I was wondering, is this a new ceiling that was just a few months ago, or is it a temporary pull down because of other sell-offs? My theory is that there's strong value there because of AWS, but wondering what the technicals would suggest.
Yeah, you know, well, thanks for asking, because I like this chart. This is an example. I was just on the other color. You know, you get parabolic moves, and they always correct. They either go sideways or they go down. And this is one of those ones where it went parabolic. It was crazy. 2024 was bananas. And I know I repeat myself, but I've been warning people for months and months on this. Talk about my videos back in January. I said the market's going to fall. So I like doing these kind of things because it shows that, you know, I put my money where my mouth is. But so it was dutiful. It had to. So this is a trend line, and it was, I can't see the 200-day moving average right now, but I can almost guarantee it was well past 15% or so over its moving average just by the look of this chart. And I have a rule, 15% or more over the 200-day, we've got to get out. So I think it's pulling back. I'm sorry, I'm going to draw the trend line a little bit better. It's maybe just testing the trend line. I'd want to see evidence of a bounce, but if it does bounce, I'd be all over this stock. I think it's a great company.
Got it. Okay, let's go back to the lines. Henry's on the line calling from Vaughan, Ontario. Hi, Henry.
Hi, thanks for taking my call. I'm asking about the freehold royalties. I checked its balance sheet, and it can cover the dividend quite well. And I bought it at $12 a share, and at that price, they're paying a 9% dividend, and they're paying it monthly. Now, does the dividend yield and the balance sheet help in assessing whether or not it's forming a bottom? Thank you very much.
As far as forming a bottom, it all depends on how secure the yield is, and I can't answer that because that would be my associate Craig at the office. He does all the fundamental stuff, and he'll tell me, "No, you don't think they're going to be able to continue paying it." But so there. Sorry, I'm going to try to draw that line again. There we go. It does look like there was a support level, maybe around 13 or so, that was broken, and yeah, it's trading at 12.5 or something right now. That's not great news. However, the dividend, like you said, may just support it here. I personally, like, I'd want to know from a fundamental analyst, and I'm not the guy for you, if the company is stable enough to be able to continue paying the dividend. If it is, and it's got, then it'll probably move back up again. But the fact that it's broken its support is a bad thing as far as I'm concerned as a technical person.
Got it. Okay, let's go back to the phone lines, get as many callers as we can. Fern on the line from Thornhill, Ontario. Hi, Fern.
Hi there. Thanks for taking the call. Hi, Keith and Marilla. I'd like to know what you think of Cenovus Energy, what your technical analysis is. Thank you.
Cenovus.
Yeah, it's like a lot of the energy stocks. I mean, I like the energy trade. And by the way, we're just coming into the point where you want to own energy. It's usually between mid-February and May or June that the sector can move. So Cenovus is at or maybe slightly below support. I would want to see it. No, I do want to see it bounce to be bullish on it. But I've seen this on a couple of the oil companies. This isn't the only one that's done it. I'd probably say give it another week or two at least and see if it will bounce, because this is the season that you want to own energy. And if it doesn't, if it breaks down some more, then you'd have to get out.
Okay, why is this the season? Quickly.
Seasonality on oil is it's a favorable period of time, basically from around mid-February to around beginning of June or so. It tends to be when oil producers are stockpiling ahead of the driving season, which North America is the biggest driving customer of fossil fuels. So they burn a lot of fuel. There's more fuel burnt, so the producers stockpile ahead of time. So it tends to mean that the stocks can go up a little bit ahead of that driving season in the summer. And funny enough, the stocks go flat usually after June.
Got it. Okay, let's go back to the phone lines. Kyle on the line now from Orillia in Ontario. Hi, Kyle.
Hello there. I'd like your thoughts on MDA Space. I bought it at around $14 a share, and it had pretty good earnings. I would like to know if you have the power of foresight, if it'll break past the $27 mark. Thank you.
So good Canadian company putting satellites into low
And a great
orbit.
call.
Yeah.
Like $14 you bought it at. And
up to 27.5.
Good for you. So yeah, like, okay, so there's that parabolic move. We were talking about that. These things always wash out. Eventually, they wash out either in a downtrend or they wash out in a sideways period, right? So we got the pullback, which was very, very needed. seems to base and seems to be bouncing off. I mean, you're going to have some resistance at this old, whatever, 30 bucks or something level. But so far, it doesn't look bad. Like, I'd say the fact that it's bouncing in the face of all these tariffs and every other thing that's going on out there, it's probably got a darn good chance of going to $30. And we'll see if it goes through there.
Got it. Okay, let's get to one more call here. George is on the line from Mississauga in Ontario. Hi, George. What's your question today?
Hi. I wanted to ask Keith about New Vista Energy. I bought it in the low 11s recently. It didn't bottom as low as the October lows, and I wanted to know where it's going from here. And is RSI a good indicator to look at when I'm trying to exit a stock? I'll hang up and listen to your answer.
Thank you.
Yeah, RSI definitely can help you because it'll pick overbought, oversold signals. We held this stock in our aggressive platform. So we have our regular equity platform, which has the vast majority of the capital held at value trend. But we do have an aggressive platform, and we buy stocks that are a bit more choppy. And this is a good example of one. But it's a great pattern. We like it. I mean, this is one of those swing trades that I like so much. So, you know, kind of support around 10 bucks and resistance at around whatever, $14, $15. I think that if you could use even RSI, you know, it'll probably swing up from an oversold there, and it'll start to get overbought near the top of its range, and so that's a great indicator to help you. But you already know that you're looking somewhere near $15 to sell it. So far, it could return a little bit lower to get to the old support level, but so far, I mean, I'm in it, so that might tell you something. We think it's a good swing trade.
Got it. Okay, we are out of time for phone calls at this point, but stick around because Keith is going to share his forward-looking top picks. We're back in just a moment.
Earn more from investing in Canada's largest banks and lifecos. Get high monthly income and enhanced returns with SBC and LBS. Over 15 years of proven performance. SBC and LBS on the TSX.
I've seen a lot of valleys, I've seen a lot of peaks. I've seen the bitter with the sweet victory and defeat. Sometimes I fell, but a voice kept saying, son, stick to your vision. Keep the composition. Seen a lot of shame in the game.
Donate at lovescarborough.ca.
Harvest Healthcare Leaders Enhanced Income ETF. Maximize your monthly cash flow from Canada's leading healthcare ETF. More income from healthcare leaders. Harvest ETFs. Income happens here.
Join us tomorrow on Market Call. Stan Wong on the show. He is portfolio manager at Scotia Wealth Management, and taking your questions tomorrow on North American large caps and ETFs. And if you missed an episode of Market Call, you can find our daily podcast on iHeartRadio, Spotify, and on other podcast platforms. We're back in a moment. Stay tuned.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me or is there some kind of clue here? I don't know.
Bell 5G Plus? What does the plus mean?
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
Get more from Canadian banks and insurers with HEB and HFN. Exposure to Canadian banks and insurers with 0% management fees until January 2026. HEB and HFN on the TSX. From Hamilton ETFs.
It's great to be connected on a plane, but not all the time.
Top Picks is brought to you by Questrade, now available on the TradingView platform.
Welcome back. Keith Richards is at the table and sharing some top picks at this point. Let's take a look at those. His first one is iShares, the 20-year T-bond ETF. Keith, tell me why you like this.
Well, we started buying this in January, and actually I mentioned it on my blog and the videos and stuff. It makes, actually, I'd like maybe a one-year chart because I can kind of show you the pattern a little bit better. But basically, we're looking for, we don't like the stock market. If I made myself clear through this show, we haven't liked it for several months. So like back in the third quarter of last year. So we were looking for alternatives. And so this is an alternative. So what we saw was two things. It's not stocks, it's bonds. There's the probability of rates having to come down in the US. They have in Canada, but they're kind of set with a pending recession possibility in the U.S. to happen. And so we bought on this little breakout. We know our downside is actually we would sell it at around, I think it works out to be about 86 or something. And our target is, we said, okay, first target is 95, second target is 100. So we're earning a little bit of a dividend on it, and it's not correlated to stocks. So it will march to its own beat, meaning mostly inflation and the dollar and interest rate policy.
Okay, so you were holding on to that for a little while. We'll move to your next pick. Ahead, forward-looking is Imperial Oil, IMO, and the TSX. What do you like about specifically Imperial?
Yeah, so it's interesting because one of the callers before asked about C&Q, and I said we sold that. Well, we sold it and we moved into IMO.
Okay.
So we like this chart because it's a gain. You can kind of see the pattern. I like swing charts, and this because they're easy to trade. You kind of try to buy it as close as you can down here. We were buying it somewhere around here, and we hope to see at least go to 105 or so. And we will have to decide if we were sell it at that point. We probably will.
Okay.
But we just like the chart better than a lot of other oil stocks.
I know it's hard to tell sort of from that specific chart, but it's at 96 today. At the bottom, was it around 85, 86? I can't really tell.
Yeah, that was high 80s.
High
roughly.
80s?
We didn't buy it at the bottom. We wait for a bounce, so we were buying it. And it actually didn't reach it in the point where we bought it. We were buying it off of this move and kind of bought it in here, maybe 92 or something.
And the bounce is above 105, so 100.
Yeah, I'd like to see it go to at least 105, and then we will decide if we're going to sell it. We probably will.
Got it. Okay. Let's get to your last pick, which is a new one for me. Cash is your top pick. You said you've been moving more into cash at the end of last year.
Yeah, we have, we were 10%, then 15% in January, then now we're at 20%. And, the S&P just broke below its 200-day moving average. We have all these rules. We're very rule-oriented. We don't have opinions. We just have rules. And so we say, okay, another few days. We need minimum 3 days, maximum 3 weeks. So we're going to look into next week. If the S&P is still below its 200-day, then we're going to raise another 5% cash. We'll be at 25% cash. But I can't say that's for sure because I just got to see what's happening. So in the meantime, what do you do with your cash? Well, right now we're just holding the cash. But if we feel we are moving into a bear market, and I'd give it at least a 50% chance of that happening, then if we do move into a bear, we're going to move it into something that pays some interest. Because if we know we're going to sit on it for 3 months, we want our clients to earn some interest on it. So one of the we were just talking at the break, the Global X cash thing. I like that because I can cash it the minute I want it. It's not an endorsement for it. We don't even own it. But I have traded that before. You can also buy T-bills. You can buy an independent HISA, high interest savings account. There's lots of ways you can do it, but that's just one way that we like.
And when you say you will sit on the cash and then maybe sort of put it into one of those funds, how long will you wait? What's your point of cutoff where you're like, okay, the cash is sitting here for too long, so it's time to do something with it?
Well, we're always thinking, well, we'll hold the cash because if we think that there's opportunity, because this is just a pullback within a better uptrend, we want the cash readily available. We don't want anything in our way. But when we become more and more convinced, as we are becoming right now, that we're possibly, not a prediction, possibly moving into a bear market, like 22, maybe a 25% drawdown or something. That's not a prediction, but there's a possibility of that. And so if that happens, I'm going to put the money into the cash investment or a HISA or whatever, because I know I'll be in cash for a while and I'll be building it up and I'll probably be there for 3 or 4 months. So as the market continues to wash out. So this is if it turns into a
what are you seeing? And I know you're saying it's not a prediction. You're saying there's a 50% chance of going into a bearish market. What are the bits that you're seeing that you are tracking to say that?
Okay, so I do write a blog, and I encourage everybody to go to my blog at valuetrend.ca, and I actually walk you through the exact steps I'm looking for. But what's going to happen in order for it to turn into a bear market? What's the next move? All that kind of thing. So you can do that. But in a nutshell, we just took a lower low on the S&P 500, around 5,800 was the low. It broke that. It's just now breaking the 200-day. It will rally because it's so oversold. So we'll see a rally in the next little while. And then kind of today it's happening already. So we get the rally. Will the market move back above its 5,800 level and above the 200-day? If that does, then maybe it's not a bear market. But if it kind of falls, it climbs in this current rally, but it only meets something like 5,800 or so, or maybe just a tiny bit above that, and then starts to fail again, I'll say that's a bear market.
Got it. Okay, Keith Richards, great to have you in, sir. Thanks for your perspective on what we've been looking for. And we are going to leave it there for today. We'll see you again soon, and we'll see you again tomorrow. Thanks for joining us.
Quotes about money. Every advisor in every old financial institution has one. Like this gem. A wise person should have money in their head, but not in their heart. What difference does it make if it doesn't end up in your pocket? So, how do you get yours? The answer is zero. Questrade thinks you deserve more zeros. So they changed the game again with zero commission trades. Now go get yours.
We serve Canada's wealthiest investors. Center Wealth Partners of CG Wealth Management deals with investors who have $10 million or more of liquid investments. Contact us today in complete confidence. We'll be here when you're ready.
For a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Gold standard, gold dust, pot of gold, solid gold. You're worth your weight in gold. Golden boy, golden girl, golden goose, golden egg, golden age, golden ticket, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
Hi there, welcome to Trading Day. Let's give you a quick look at some of the guests we have coming up on today's show. As expected, Tiff Macklem's Bank of Canada bringing rates down again. CIBC says the only reason he did that was because of this trade tariff turmoil. We are going to hear from Veronica Clark of Citi, and we'll get her take on how low rates are likely to go. The sell-off in the markets has a lot of investors concerned. We'll hear from Eddie Gifford, wealth advisor at T-Active, on how he is advising clients amid these price swings. And Bloomberg spoke with the Enbridge CEO on the impact of tariffs on imported steel and pipeline costs. We'll bring you that conversation later in the show. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. The federal government has announced new 25% counter tariffs on nearly $30 billion worth of U.S. goods. That's after the Trump administration went ahead with global levies on imports of steel and aluminum into the U.S. Ottawa's tariffs target U.S. steel and aluminum products as well as computers and sporting goods. These new levies will take effect tomorrow. The U.S. tariffs have also triggered a response from the European Union, which announced its own duties on U.S. industrial and farm products. Bank of Canada cutting its key interest rate by 1/4 percentage point to 2.75%, the 7th straight meeting at which it reduced borrowing costs. The governor of the bank, Tiff Macklem, calls the trade battle with the U.S. a new crisis and says there are warning signs already that the trade conflict will disrupt the labor market. Macklem says business intentions to raise prices have increased. Meanwhile, though, firms are lowering sales outlooks and scaling back hiring plans. He also reiterated there's a limit to how much the central bank can do.
We've been very clear, monetary policy cannot offset the impacts of a trade war. We're going to get weaker economic activity, we're going to get higher prices, higher inflation. We can't change that. What we can do is ensure that any rise in inflation is temporary. We're going to do as much as we can to help the economy adjust to the painful adjustment to higher U.S. tariffs.
Let's check in on shares in Peyto Exploration, the natural gas specialist. That stock up around 3% after the company released its earnings. Peyto reported profit that beat estimates. Its earnings topped expectations and overall production rose 11% year over year. Peyto notes that the majority of its existing natural gas contracts are tied to the U.S. Sure, but they're physically delivered within Canada and are not exposed to U.S. tariffs. And there's a look at the TSX and moving up today. We also saw strength in the U.S. market after inflation for February rose less than expected. So you can see there is some relief there, reignited hopes that maybe the Fed will resume cutting interest rates. Bank of Canada cutting its rate yet again, and the big reason is tariffs. Our guest says more cuts are coming. We're joined by Veronica Clark, economist at Citi. Veronica, great to see you. Thank you so much for coming on the show. What was your takeaway from the Bank of Canada? I saw that expression dovish. Tiff Macklem leaving the door open to further reductions.
Yeah, I think there's a couple ways to interpret this meeting. I mean, they are very cautious, to note that there are two-sided risks to inflation. There's the upside risk from tariffs and retaliatory tariffs, but there is the downside risk to inflation from softer growth. And I think some people maybe could have interpreted that as hawkish, but here I think actions really speak louder than that guidance. We would not have probably seen a rate cut today if there hadn't been tariffs, and so I do think tariffs have a near-term dovish effect, and we haven't even seen some of the downside risks to the labor market, to activity materialize in the data yet. So I do think this is a bank that is going to be cutting rates further to 2% this year is my base case.
You reckon that we are looking at more cuts, and in fact, we could well go down by the late summer to 2% on the benchmark rate.
Yeah, exactly. That would be a little bit below the neutral range, just because the immediate risks, I think, to the Canadian economy, even to inflation, are these downside risks from softer activity. Maybe then you have to worry about the inflation risk later. Even the bank's own scenario analysis shows that you get this downside risk to activity before you get the upside risk to inflation. Maybe that means they turn a bit more hawkish later, but I think the immediate impact is dovish for them.
It's frustrating, isn't it, for the Bank of Canada? It looked like their rate cuts 6 prior to today were working. I mean, inflation, for example, under control, apparently.
Yeah, we've seen maybe some stickiness in certain components of inflation shelter, of course, but that looks to be changing. And we did have some stronger activity data, stronger employment. Obviously, Q4 GDP was stronger. So yeah, it did look like there was a bit of this recovery, and they probably would not have been cutting today if it hadn't been for tariffs. So.
And I mean, CIBC is calling this a Band-Aid. The problem is we don't know how big the economic wound is going to be.
Yeah, we really don't. Obviously, as economists, we're having to change our forecasts frequently also, and it is very hard to keep up. I think probably the bank was grateful that they did not have a monetary policy forecast update today. We'll get that, of course, in April. But yeah, it is a really quickly evolving situation. I just think, unfortunately, we haven't even seen the downside risks really materializing yet, and those could be big. And so I think this is a bank that's going to be cutting rates more.
I wonder, will we start getting stimulus on both cylinders, aka the Bank of Canada cutting rates, but then Ottawa, whoever is in government or in office, launching some kind of a bailout package, COVID style, if the economy starts tanking?
Right. We would be looking out for maybe some, fiscal policy response support for businesses and households. Of course, we will probably have to deal with, an election first before we really get more clarity on that fiscal front. So in that sense, maybe it is the Bank of Canada that has to be there to support activity in the meantime if we're not getting that fiscal response maybe until the summer.
If they go all the way down to an overnight lending rate of 2%, I mean, assuming inflation stays around 2%, we'd be looking at zero rates. Or zero rates in real terms, sorry.
Right, in real terms, yeah, that would be a little bit below where the bank thinks a neutral rate is. They put that neutral rate estimate at around 225 to 325. We're kind of at that midpoint already now, but that's because there are big downside risks to growth. There's a wider output gap. You might need those modestly accommodative rates to help re-stimulate activity and get back to a closed output gap.
We had Warren Lovely of National Bank on this morning, and I asked him, do you think Macklem is worried about inflating the housing market again? But his take was that consumers are going to be so nervous that that's less likely. They'll be less likely to take on big mortgage debt.
Yeah, I think that's very true, and we might see the inflation risk, of course, in components like goods prices. We'll see that in CPI, but there could be some pretty big downside risks to other components of inflation, like services, like housing. An added factor to that will be we do have much softer immigration this year, slowing population growth. Those were probably people supporting rents and housing demand, and that's a factor that's changing this year. So you could see some softness there, absolutely.
Now, of course, you're a professional economist. And economic orthodoxy is that free trade is good, tariffs are bad. But I suppose, Canadian and US manufacturing workers could say, well, our jobs went to China. So are people going to start rethinking trade policy in the next 4 years of Trump's presidency?
I think, for an economy like Canada, free trade is certainly beneficial. Obviously, it's a smaller, still trade-dependent economy, especially with the U.S. So I stick to the orthodoxy that tariffs are a net negative for activity.
But have we given away too much? We've seen our auto industry hollowed out, largely because of auto parts coming from China and vehicles from Mexico.
Yeah, there are, of course, shifts that happen in an economy, but trade makes most people better off. I think you have access to larger markets. Certainly, the dynamics of your economy can change. We're not as manufacturing based as we once were, but that opens up opportunity for more services based jobs and things like that. It's part of a growing economy.
Veronica, thank you very much indeed.
Thank you.
Veronica Clark, economist at Citi. Coming up, Canada firing back, announcing new 25% counter tariffs on items from the United States. We'll drill into that story when we return.
Trading Day is brought to you by Capital Group Active ETFs.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between adaptability, strength, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart, so they can make a difference where it matters, the core of a portfolio. They're meticulously crafted to endure. Capital Group, actively different.
I love that my daughter still needs me, but sometimes I can't help due to pain in my hands. So I use Nervive Nerve Relief.
Its dose of ALA helps relieve pain associated with peripheral neuropathy, with results starting in 14 days.
Now I can help again. Feel the difference with Nervive.
Whoa, how'd you get your teeth so white?
You gotta use the right toothpaste.
Dr. C?
not all toothpaste whiten the same.
Crest 3D White removes 100% more stains for a noticeably whiter smile.
New personal best.
Crest.
Is this how you're hoping to retire? Well, hope isn't a good retirement strategy. You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals. Have someone on your side to keep you on track.
Call for Fisher's Comfortable Retirement Kit with the help you need to make your retirement a success, including the Investor's Guide to a Comfortable Retirement, 12 retirement investment blunders to avoid, and 7 secrets of high net worth investors. Call 1-888-601-1168.
Fisher Investments tailors a plan to keep you on track for the retirement you want. And as a fiduciary, we do better when our clients do better.
Call now for your free Comfortable Retirement Kit. 1-888-601-1168.
If your retirement portfolio is $500,000 or more, call us today. You don't have it coming to you unless you plan for it.
1-888-601-1168.
So Canada levelling reciprocal dollar-for-dollar tariffs on U.S. steel and aluminum imports, and that's after U.S. President Donald Trump's administration slapped 25% duties on steel and aluminum imports from numerous countries. We're joined now by Mathieu Dion, Bloomberg's Montreal bureau chief, and of course, aluminum, an important metal for Quebec.
Absolutely. Aluminum is an important metal for Quebec. Most of the North American production is being done here in Quebec, and much of it is exported to the U.S. So Quebec is going to be hit very hard by these tariffs that were put in place today by the Trump administration. And then you have Canada fighting back here today by adding 25% reciprocal tariffs on almost 30 billion of imports from the U.S. So they're fighting back on steel products. So they will hit steel products coming from the U.S. to Canada for worth $12.6 billion, aluminum products worth $3 billion, and also additional U.S. import goods, consumer goods like computers and sporting goods worth $14.2 billion. So in total, $29.8 billion that will be subject to tariffs of 25%. And that adds up to the 30 billion, to the worth 30 billion of products that were announced last week by Trudeau's government. So we're at something like 60 billion now, but there's still room left as the government has a list of worth 155 billion worth of goods imported from the U.S. where they can put some tariffs on.
François Legault, the Quebec Premier, I haven't seen him being as outspoken as Ontario's Doug Ford, but obviously he's not happy about any threat to aluminum exports.
So he's trying to take a different approach here by not being too vocal. We saw this week that what Doug Ford did with electricity, for example, to add some tariffs of 25% on electricity exports to the U.S. We saw Trump's reaction to that. It was really to lift the tariffs as high as 50% on aluminum and steel. And finally, Doug Ford pretty much backed off of this threat. So Quebec's government, like right now, is mainly focused on hoping that this would all settle out by having a more cautious approach, keeping a cool head. Legault keeps repeating that, and they don't seem to see the value of being too harsh against Trump administration like Doug Ford did this week, and it backfired pretty much. And also, if I can say that, according to people familiar with the matter with Legault's office, Legault was not very happy with what Doug Ford did this week about electricity, because Quebec is a major exporter of electricity, right? They export to the U.S. and the northeastern region, and Legault was looking weak by not doing anything on electricity. But what we need to understand is that the electricity exported to the U.S., it is exported on the spot market, where the lowest bidder wins over. So if you come in the U.S. with a higher price, you're just harming yourself pretty much here. So yeah, that was the situation in which Legault found himself this week.
Right, yeah, from what I've seen, Legault is arguing a lot of our sales are under a contract, but he's not entirely ruling out, interestingly, not ruling out possible export levies on aluminum, but as you say, he's been very non-committal compared to Ford.
Exactly. He's not excluding counter tariffs, but he's having a cautious approach. He makes me think a bit like Claudia Sheinbaum right now, who said that she will respond only on April 2nd about tariffs. So currently, Legault is having this cautious approach, wants to make sure that Quebec's economy won't be hit too hard, putting some counter tariffs of 25% on aluminum. Ultimately, you're pretty much hurting yourself and you're hurting workers and businesses in Quebec. So yeah, that's how he views things. Is it the good strategy? That's an outstanding question. We've seen lately that diplomacy didn't work in Washington, and that's the reason why we saw today that the Canadian government struck back again against the U.S., thinking that maybe that's where we are right now with a dollar-for-dollar response.
Mathieu, thank you very much indeed. Mathieu Dion heads up Bloomberg's Montreal bureau. Up next, we're going to be joined by Eddie Gifford. He'll give us his take on the markets. And he thinks Tesla is offering an attractive entry point right now.
The Harvest Diversified Monthly Income ETF. Consistent monthly income. The Harvest Diversified Monthly Income ETF. HDIF on the TSX.
Invest like a champion with Hamilton Champions ETF CMVP and SMVP. Exposure to Canadian and U.S. dividend all-stars. Hamilton Champions ETFs. Zero management fee until January 2026.
Bleeding gums are a sign of bacterial infection. We always recommend Crest Gum toothpaste to our patients. Its unique antibacterial fluoride works below the gum line to reduce bleeding to strengthen gums. Thanks, Crest.
In Hong Kong, every street, every turn is a new experience. Let's check out one of the world's most remarkable cities. We're off to the Peak, one of Hong Kong's most spectacular destinations and best way to capture stunning panoramic city views. You've got to see this. Prepare to be dazzled, strolling along Victoria Harbour's Avenue of Stars, where breathtaking views meet cultural icons, including martial arts master Bruce Lee. Hop on to the historic Star Ferry to get you pretty much anywhere. Dai Pai Dungs, or traditional open-air eateries, are a quintessential Hong Kong food experience. Oi Man Sung is one of the oldest and most famous. Hong Kong's nightlife is as dynamic and diverse as the city itself, boasting some of the world's best bars, including Bar Leone, coming in at number 2 in the world. I love this city. I know you will too.
Have you heard about a weekly? It's the first long-acting insulin with once-a-week dosing. Get the ball rolling. Ask your doctor if a weekly is the right long-acting insulin for you and visit aweekly.ca.
U.S. stocks, broadly speaking, up today, but it has been a rough couple of weeks. Let's get the take of Eddie Gifford, wealth advisor at T-Active. Eddie, it's always hard. Thanks very much for joining us. Always hard to know what's driving the market at any one time, but it seems to be tariffs and maybe just a cooling ardor for those Mag 7 stocks.
Yeah, we're seeing both. And then I think that the big one is just uncertainty, right? The market never likes uncertainty. It ramps up the volatility. It really like tests you as an investor of like, wait, how much do I really like this stock, or how much exposure do I really want to have to equities? So what we've seen the last couple of weeks with the tariffs, with the fact that, hey, we've had this historic run over 2 years and kind of some of the big stocks, the Mag 7, taking breathers, so to speak. It's kind of like having people, investors, clients, second-guessing their portfolios. It's always interesting how the true risk tolerance and risk capacity comes out when volatility kind of ramps up. So we don't think that there's any reason to like run away at this point, but we definitely are watching a few different areas that are causing a little bit of concern.
So we keep hearing this expression, buy the dip, or we did hear it over the past couple of years. Is this a buy the dip opportunity?
From our perspective, with what's happened over the last couple of weeks and with some of the data points that we got last week, we would say it's more of a sell the rally environment now. Take advantage of unless you have just like some really big like conviction buy and holds. Take advantage of the fact that you have had significant gain over the last 2 years and take some of those profits off the table. I do still believe that diversification is going to be the winner over the next couple of years as things kind of normalize again. And concentration obviously was something that was fantastic over the last 2 years. And so it's time to kind of trim that off and use these rallies to your advantage right now, for sure.
You have some ideas for us. Tesla, you think there could be value there?
Absolutely. I mean, maybe not like in the next like 3 or 6 months. We've seen that this is a very volatile holding, even more volatile since the election because of some of the politics involved. But my thing is that if we liked it at 260 a year ago, why wouldn't we like it at 260 now? The long-term trajectory of the company hasn't changed. Now, there are some things that are happening that maybe everyday people and investors and Americans and Canadians and the like don't really like, but that's just volatility. That's just noise. When we look at like the longer term picture, I don't think that anyone's going to be disappointed by buying Tesla today when they look at their portfolio 10 years from now.
That's interesting. A 10-year, if you have a high conviction on Tesla, 10 years time, I mean, that's a long time, obviously, but you think you'll be happy?
Yeah, absolutely. And we got to keep in mind that like anytime that you're buying equities, you can trade them or you can invest in them. And when we're investing, we're really leaning into like 5 to 10 year holds because sometimes it just takes that long for things to kind of balance out and everything. Now, if you're trading it, like that's a whole different world, but we're not huge fans of trading. We like to find the companies that we think will grow over time. And that's where we think that Tesla is an attractive level right now. Of course, I'm not saying go all in. I would probably dollar cost average into a position over the next 6 to 12 months just to kind of take advantage of the volatility. And then, you'll be sitting pretty in 5 to 10 years.
Your next idea, now this is arguably just a trading stock MicroStrategy because, of course, they're a Bitcoin play.
Yeah, I mean, I would say that you're right. It's more of a trade, generally speaking. It's gotten beaten up pretty bad recently, more so than Bitcoin, even though Bitcoin has gotten beaten up as well. And so I think that there's room for a balance, and we've seen that this week a little bit come back the last couple of days. But if you are a purist and you do believe in Bitcoin, and as more and more companies adopt Bitcoin and include the ETFs in the portfolio, the MicroStrategy stock is going to act kind of like a levered play on Bitcoin. So a very small position in the portfolio won't really hurt you so much, but it could help you a ton in the next 2 to 3 years.
That's interesting. And then Palantir, we know that they have a pretty good foothold in the military and the security services among other industries, other clients.
Absolutely, and conflict could drive success for them, and we've been noticing a lot of conflict recently, and also it was on this like meteoric rise and has finally kind of like come back to earth a little bit. And so anytime that there's a stock that we like or that has a ton of momentum or a lot of wind at its back, and we see these severe sell-offs, we look at those as true opportunities to buy the dip. If we're looking at it in the context of like a portfolio, if this is something that we've held for the last couple years, we were already trimming profits anyways. So it is a good time to add to this position or to start building a position in Palantir around the volatility. And because one thing's for sure, the volatility isn't going away anytime soon. It's going to take a few months, maybe a year to kind of figure out everything that's going on with all the retaliatory tariffs and the initial tariffs and all of that stuff. That's not going away anytime soon. And so use the volatility to your advantage, whether that's strategic rebalancing or profit taking, or building positions. But depending on your timeline, there are going to be a lot of opportunities over the next 12 to 18 months for sure.
Eddie, thank you so much for joining us. Eddie Gifford, wealth advisor at T Active. Coming up, Bloomberg's Alex Steele caught up with the Enbridge CEO. They talked about the impact of tariffs on steel and pipeline costs. That conversation is ahead.
Invest in high-quality dividend growth stocks. Get high monthly income and enhanced returns. Add these top-performing dividend funds to your portfolio. DGS and GDV on the TSX.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach. One that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
Honey.
Honey. NyQuil Complete Honey. Effective cold and flu symptom relief with a dreamy honey taste. NyQuil Honey. The nighttime sniffling, sneezing, coughing, aching, fever, honeylicious so you can rest. Medicine.
Quotes about money. Every advisor in every old financial institution has one. Like this gem. A wise person should have money in their head, but not in their heart. What difference does it make if it doesn't end up in your pocket? So, how do you get yours? The answer is zero. Questrade thinks you deserve more zeros. So they changed the game again with zero commission trades. Now go get yours.
No matter what kind of teeth you gotta brush, Oral-B Electric cleans better with one simple touch. Oral-B's dentist-inspired round brush head hugs them, cleans them, and gets in between them for 100% cleaner teeth. Your perfect clean routine starts with Oral-B.
It's great to be connected on a plane, but not all the time.
Gold standard. Gold dust. Pot of gold. Solid gold. Golden opportunity. Is it just me or is there some kind of clue here? I don't know.
The federal government has announced new 25% counter tariffs on nearly $30 billion worth of U.S. goods. That's after the Trump administration went ahead with global levies on imports of steel and aluminum into the U.S. Ottawa's tariffs also target U.S. steel and aluminum products, as well as computers and sporting goods. And these new levies take effect tomorrow. The U.S. duties have also triggered a response from the European Union, which announced its own retaliatory tariffs on U.S. industrial and farm products. A reminder that the Bank of Canada cut its key interest rate by 25 basis points to 2.75%. And the governor, Tiff Macklem, called the trade battle with the U.S. a new crisis that could have a severe economic impact. The governor says the bank will proceed carefully with further rate changes. He also highlighted that a weaker Canadian dollar and tariffs will make imports costlier. He anticipates a slowdown in domestic demand in the first quarter and warned that the bank can't right now provide forward economic guidance. Shares in Walmart under a little bit of pressure. Chinese authorities, including the Ministry of Commerce, have summoned the retail giant over reports that it's requesting Chinese suppliers bear rising costs incurred by increased U.S. tariffs. China warns that Walmart's demands could fracture the global supply chain, hurt the interests of Chinese and U.S. companies, and affect consumers. Walmart sources around 60% of its products from China. And there is the TSX. It is marginally higher today. We did get some relief on the tariff front yesterday when Trump backed away from 50% levies on Canadian metals. Let's have a look at the US markets. We did get a fairly benign inflation read, lower than expected for February. As of today, the Nasdaq's down about 8.2% in 2025. S&P 500 down about 4.6%, and the TSX down just over 1%. Sarah Week 2025 currently taking place in Houston, and it brings together thousands of energy industry leaders and experts to discuss the future of energy. The conference, organized by S&P Global, is seen as setting the industry's agenda for the year ahead. Bloomberg's Alex Steele had the chance to sit down with Greg Abel. He's the CEO of Enbridge, and they, of course, touched on the impact that tariffs on steel will have on pipeline costs. Here's that conversation.
In charge of North America's largest pipeline energy infrastructure company, and you got pipes in Canada, in the U.S., and across the border.
Indeed.
How hard is your life right now?
Well, 43 states, 8 provinces, 5 countries. It's just another day.
It's just another day.
You've got to focus on fundamentals. What do we know? Energy's going to flow. It has to flow. It's the lifeblood of everybody's economy. Consumers want cheap prices. That means provide as much supply as economically possible, and try to stay out of the way of policy and politicians in the short term and focus on the long term. And so we continue to do that. We've got $27 billion of projects that we're going to execute through 2027.
And any of that question marked, on hold, put on the sidelines, on pause because of the turmoil in the market and because of the headlines on tariffs?
No. And here's why. Well, they're already signed up contracts. People need that energy. It takes multiple years to build that infrastructure. Most of the product that we need for those is orders are already in. You know, say steel, for example, largely domestically produced in the United States or in Canada for projects there. So you do need to think 3 or 4 steps ahead, but when you've been around better part of a century in your long-term energy infrastructure, I'm paid to do that every day, and so are our people.
But does that building and all that CapEx get more expensive if the material gets more expensive?
It could. It could. So we have to be, again, you try to lock that in as soon as possible. One of the benefits of running a large pipeline system, largely regulated, economic regulation beyond just, you can pass through some costs if they're reasonable. So again, big buyer, as you said, largest pipeline operator in North America. We buy a lot of stuff, and I think we've got a certain amount of power to be able to get the best deals possible. And then from a competitive perspective, if some prices have to be passed through, fine. But generally speaking, we lock those in.
Have you seen any change in oil flows as of yet?
No, quite the contrary. So January, February flows out of Canada have been close to record highs. We'll see if that continues, but I think people may be getting ahead of those. Exports out of the Gulf Coast, we're the largest exporter of oil out of the United States. That continues to be very robust as allies and customers overseas want to continue to get there. And it was a pretty cold winter, so natural gas was used predominantly to keep people warm and electricity going and industry flowing. So start to the year has been pretty good.
If we do see continued tariffs on Canadian oil, do you think the price then discounts? And then producers respond in kind?
So our pipeline is exactly built for that. So it's been a long time been a discounting Canada, right? Lots of production, trying to get down to lots of demand here in the United States. So the more we can build pipelines, the less there are discounts. But we'll have to see how that shakes out. It's early days. I keep saying everybody needs to take a breath. Everybody needs to be focused on the long term and recall that our people, our economy, the two countries need each other and they need energy.
No, we're media. We want answers now. But what it does seem to highlight, though, is Canada's need for other export partners. And I'm wondering what the stomach is to build up pipelines to Western Canada.
I'm cautiously hopeful. I didn't say optimistic, but hopeful for several reasons. One, going to be a change in government in Canada. You know, one way or the other, there's going to be a new prime minister here in the next little while, maybe 2. We'll have to see. I'm not the politician here. And I think Canadians are united that, you know, it's a challenge to be so tied to a single economy, even if it is the best economy in the world. And therefore, there's opportunities to move off at least the West Coast and maybe the East Coast. Canada did have an opportunity 10 years ago to be the leader in LNG and tripped over itself not to be able to get there. I think many Canadians probably regret that. I hope policymakers regret that. But, you know, you make a mistake once, hopefully you don't make it twice, and that'll create an opportunity, and still will be the largest provider of oil and natural gas in the United States, too.
There have been things floated, like maybe the government could tax exports, and that would then pay for a pipeline, particularly maybe from east to west, that the government could just help pay for these kind of pipelines. Is that in the zeitgeist at all from where you are?
Yeah, I don't think that's not a logical way to go, right? I mean, the government had to step into a pipeline, the one that does go to the West Coast, ended up being a multiple of what it would have cost in the private sector, one. And then two, you would really be asking for a real burden to be placed on Western Canada as the largest producer of, almost the sole producer of oil out of Canada. I don't think a Canadian politician that's thinking about national unity would want to impose one tariff on one part of the country just to benefit another part of the country.
So what would incite the private sector to want to do something like that?
Well, new permitting rules, just like here in the United States and Canada.
Which is worse?
Well, they're both challenging. I don't know which is worse. I think momentum is towards regulatory simplicity here in the United States, and I hope we get the same in Canada. Again, I have to make decisions every day. Am I investing in Canada and the United States? So permitting is a big issue. Speed of permitting is a big issue. Support for proper taxation regimes, etc. Those are all decisions I have to make. Both capital markets are excellent, but I would say the permitting and regulatory regime is quite problematic in Canada.
The other sort of non-related tariff demand driver potentially is AI and data centers, right? How do you play in that?
Multiple ways. So we, again, being such a large producer or large shipper of natural gas, probably the best way in which those data centers will be fueled is natural gas-fired generation. So we are building pipelines now for great companies like Duke, TVA, et cetera, here in the United States, and those will be for new gigawatt-plus power plants. Some of those electrons, I'm quite certain, will go to meet this demand on the AI front. We serve 90% of the gas-fired generation, say, in a province like Ontario. They're trying to track more and more AI, so we will build the infrastructure, the storage, the transportation, et cetera, to fuel those plants, which will then allow the data centers to be connected. Something like the vast majority of data centers are within 50 miles of our pipeline. That's a pretty attractive, right across North America, for us to be able to utilize. So I'm excited about that. I mean, we'll have to see how it all shakes out, but, you know, steady growth. And we also have a renewable power business, and some of those data centers want to use renewable power. So we've signed up new customers like Amazon, and Meta, and Toyota, and Pepsi. So you'll see a lot of those players that are looking for power. We're going to need it all,
what was it like to have those conversations with like Toyota and Amazon? Like, did they contract long power purchase agreements?
Yes.
And what was that like to come to a price?
So the price is largely set by natural gas, even if you're buying renewables, right? So the price is out there, and then you're trying to create a little bit of an escalator. They see the need for stable 6-9s reliability power, but they also want to meet some of their sustainability goals. So
even now, in a different environment?
Absolutely. Okay. That means they will get a mix of gas, and they will get a mix of renewables as well, right? So we need it all. I think that's probably the message that comes out. North America to be Fortress America, North America to be energy superiority, we're going to need it all. We're going to need all the oil, we're going to need all the gas, we're going to need cooperation, we're going to need permitting reform, and that, first and foremost, is going to serve the consumer. Consumers are voters, and I think that wins.
Before we let you go, there's obviously a lot of concern about recession, fears among tariff fears, etc. Are you noticing any slowdown in demand?
So I am starting to see some impacts vis-a-vis be housing. You know, what's going to happen with interest rates, recessions, et cetera. If you're not quite certain about being able to afford a house or your job, et cetera, then, you know, as many houses as we might need, they're maybe not getting built. But that's about it to date. I mean, I think we have to realize there's been a lot of talk of tariffs yet, but we've yet to see a month or two of tariffs. I think when that kicks in, you may see some impacts, which is the benefit of our model. Our model largely regulated, steady as she goes, dividend payer. We've increased the dividend for 30 years in a row, and met financial guidance for 19 years in a row. Recessions, no recessions, one type of government or another. So, yeah, we often see the stuff first, but fortunately the structures we have still allow us to perform.
Coming up, we are going to talk to Ron Butler of Butler Mortgage, always an acerbic commentator on the housing market. He will update us on how today's rate cut will affect homeowners and their mortgages. That's next.
Interactive Brokers pays up to 3.83% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
Did you know cold viruses often start in the nose before they spread and make you really sick? Try Vicks Early Defense Nasal Spray. When used at the first sign of a cold, Vicks traps, blocks, and removes cold viruses at the source. When you can't afford to get really sick, always have Vicks Early Defense Nasal Spray on hand.
If you're looking to invest, Capital Direct's One Income Trust could be right for you.
Our track record boasts stable income, portfolio diversification, and compound growth.
Last quarter, Capital Direct's return hit over 10%.
Find us online.
Call today.
CapitalDirect.ca.
Want to get the most out of one sheet? Grab Bounty. It's inspired by a dishcloth, and you can ditch the mess when you're done. Bounty, the quicker picker-upper.
Tomorrow's leaders are emerging today on TSX Venture Exchange. Distinguishing themselves through strong growth and market performance, the 2025 TSX Venture 50 continue to push boundaries and are boldly redefining what is possible in Canada and abroad. Explore the list today.
Closed captioning of this BNN Bloomberg program is brought to you by Sissel Brands, one of North America's fastest-growing sports nutrition companies, trading on the CBOE under CZZL.
For Canadians waiting to buy a new home or renew an existing variable mortgage, the Bank of Canada's latest rate cut could lead to lower borrowing costs. We heard from Ron Butler, mortgage broker at Butler Mortgage.
We'll have all the major banks switch prime by tomorrow. By the end of the month, those savings will be reflected for variable rate holders and HELOC holders. They'll see their payments in some cases go down, but they'll all see their interest go down. So it's just good news for variable and home equity line of credit people.
A very different story in the fixed mortgage market, correct? It's all to do with 5-year bond yields, correct?
All to do with bond yields, and that's a bit more precarious. As the Bank of Canada Governor addressed this morning, there is probability that there will be some inflation, but before that, there'll be some downward trends. So most likely, the bond yields will come off a bit, and we'll see slightly lower fixed rates, but it's not going to go to the bottom anytime soon.
So how do homeowners grapple with the question of, do I go variable or do I go fixed?
I think it's a very strong assumption that we'll see further cuts. I think the Bank of Canada Governor almost alluded to it. But so therefore, if you have enough of a risk tolerance, if you're secure enough in your job, that's going to become the more important question moving forward for home buyers. Obviously, if you're a physician or you work at a hospital, you're probably fine. But you can say, yeah, I can take a risk on variable. But for those who may have more precarious job positions, in the light of these tariffs and the light of an ongoing trade war, then you might want to be inclined to take fixed.
The risk in variable, obviously, is that the rates can go up and your rate can go up, correct?
Absolutely true. And the reality of a trade war, in almost every case, some kind of inflation as a result. Now, it could take a while. There could be offsetting things like rents going down, but still, prices in all likelihood do go up.
Okay, one story that has been shoved squarely to the back burner now, because we're talking about tariffs constantly in this country now, is the mortgage rollover, the mortgage renewal story in Canada. That many mortgage borrowers who locked in 5 years ago or so must renew this year or in 2026 at rates that, while they've come down recently, will likely be higher than they checked in at. What is your take on that situation?
Well, obviously, with every decline in rate, that's a positive for those folks. Here's what we're noticing. So many of these renewers are often asking for what's effectively a refinance. They're saying, hey, could I increase my line of credit? Could I take some money out of my mortgage? Can I get an increase? Because I might want to put some cash aside. I'm a little concerned. I want to pay my bills down. So there is this kind of anxiety that does exist, and we have seen it.
There were questions on in the Bank of Canada press conference today about recession probabilities. The bank, as you can imagine, deflected those questions. Do you think a recession is possible, and how would the mortgage market handle a recession? What would be some of the consequences?
Well, I think a recession is a genuine possibility, and this is the key element to the mortgage market and recession. Unemployment is the biggest driver of default. Nothing else is. It's the thing that keeps bank chief risk officers up at night. And that's something that we will see decidedly. We've had incredibly low default rates in Canada. It was as low a year ago as 0.15 basis points. Yeah. Up to 22 now, headed for 24. But a major recession with a lot of unemployment, you're looking at defaults in the 40 basis point, 50 basis point range.
Close to half a percentage point, 4/10 or 5/10 of a percentage point. How high is that historically? Defaults in this country are typically very, very low, are they not? Certainly compared to the U.S., and would it be fair to say compared to many other advanced economies?
Oh, absolutely. Our default rates in Canada on mortgages are extremely low, have been, and continue to be. And in fact, in the last couple of years, they've been half of what the historic average is. The historic average is about 36 basis points. Right. So even at 40, even at 50, still easy for the banks to handle, not a big issue, but very hard for the humans involved.
Yes,
very tough.
Absolutely. What's more difficult for the banks to endure is, as you say, defaults are almost de minimis. What's more difficult is a drop-off in mortgage demand. Would you see a drop-off in mortgage demand in a recessionary environment?
I would absolutely see a drop-off in demand. I mean, the banks are encountering a lack of demand today. They're responding with aggressive rate wars, which is, I know even Dave McKay actually used those words at RBC. It was amazing. It's sort of true. There are aggressive rates from the big six banks, and we'll probably see more aggressive rates. But yeah, fall off in mortgage demand is pretty evident.
And does that translate through or transmit through to pricing, to the price of homes in different markets around Canada?
Yeah, it's super regional, obviously, but I think we're absolutely going to see that translate into lower house prices in Ontario. It's almost unavoidable. And possibly lower house prices in British Columbia. Now, not vastly lower, not 25, 30% lower this year, but a grinding down of house prices in Ontario and British Columbia.
Ron Butler joined us earlier, talked to our own Paul Bagnall, and he's a mortgage broker at Butler Mortgage. Coming up, airlines have been struggling amid economic uncertainty and the tariff war. We'll bring you a deeper dive into the sector when we come back.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
It happened on March 9th at 6:17 p.m. First to arrive was Marco, who came by way of train with his plane at first dock, Minnie. The Maui's made it en route to their regional curling championship/family vacation. Self-proclaimed content queen Quinn, well, she'll share how she managed to make it shortly. So how did the never-available host Julie make the unplannable happen?
Find the best time for group dinner and add to calendar.
Plan the unplannable with Samsung Galaxy AI on Bell.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Gold standard. Gold dust. Pot of gold. Solid gold. You're worth your weight in gold. Golden boy, golden girl, golden goose, golden egg, golden age, golden ticket, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
Big U.S. airlines have been warning of weaker revenue outlooks, with consumers in the States turning more cautious with all this tariff turmoil. And of course, Canadians, we're hearing, are cancelling travel plans to the United States. We spoke with Robert Konas, President and Managing Director at AirTrav. He says if the sector continues to struggle, airlines may begin to slow or cancel aircraft orders and slow pilot onboarding and even cut jobs. Here's that conversation.
It's tough times in the airline business, and in travel, especially discretionary travel, it does track economic, downturns or recessions, and it's also the first sector to come back. You're right about Delta, but also American Airlines and Southwest Airlines also slashed their outlooks for both revenues and profits in the first quarter. United didn't go quite as far, but did note some weakness. That's a challenge. On this side of the border, we're seeing stocks like Transat hitting all-time low, Cargojet 23% off start of year, Air Canada, who is probably the most exposed to the U.S. market, off 31%. So all of our carriers on this side of the border have all taken measures in terms of trying to divert or deflect capacity from this coming summer into other markets, particularly the domestic Canadian marketplace.
And how successful might that be? How the Canadian market is only so large, of course, compared to the U.S. market. How successful can these companies be at diverting capacity, which is our aircraft and seats, to the domestic Canadian market?
Certainly, consumers, and by the way, just like your previous guests have said, business and consumer confidence in terms of how it interacts with travel decisions, whether it's corporate, government, leisure, it's all intertwined. And right now, it's really tanking. Canadians have certainly been very vocal about trying to pivot from the U.S. and have talked about leaving their vacation spend this summer in Canada. But to your point, it's only so big. I think the challenge that all of our carriers are going to face is that dumping a lot of additional capacity, seat capacity, into this relatively small domestic market, and there's only so many routes that make sense, that's going to put downward pressure on yields, average pricing, and that in turn is going to impact profitability for all the carriers going through into 2 and 3Q.
Robert, this is Bill Harris. When the oil price originally went up, and that sort of had to get passed on to the flyer, but with the fuel prices coming off, is there any impact yet on that? And can a ticket price get cheaper and then just incentivize people to fly, or are we too early?
Well, just to be clear, in this country, there's only fuel surcharge. They're not even called fuel surcharges anymore. The carriers have called them international carrier surcharges. They only apply to international revenues, not domestic, not transborder. But the carriers have proven over time that the surcharges tend to be an interoperable revenue lever as opposed to a mechanism that closely tracks fuel. To your point, I mean, we've seen surcharges rise when oil prices rise, but they don't always come down in step when oil prices drop. I think the bigger challenge for oil prices is that while we have oil prices falling, that 69 or 70 cent Canadian dollar is tough for the carriers. They're buying fuel, a lot of their aircraft leases, outside third-party maintenance contracts, their product distribution contracts. All of those items are U.S. dollars. I don't know if there's a silver lining there with another cut in the Bank of Canada rate, but all the macroeconomic indicators are pointing the wrong direction for this sector right now.
Air Canada, Robert, as you know, has fairly recently outlined a series of ambitious longer-term financial targets. I believe $28 billion in revenue by 2030 was one of its targets. Does this situation put those longer-term forecasts at risk?
Well, just one step back for a second. It's too bad all this is going on because a number of our carriers have had some really good news lately. You had WestJet rolling out a significant upgrade and change to its loyalty program to compete better with Air Canada Aeroplan. You've had Porter making some moves, for example, opening a base in Hamilton, Ontario. But I think profit targets this year are going to be in jeopardy. The International Air Transport Association, of which is about 280 members, including Air Canada, Transat, Cargojet in this country, they announced last December their 2025 outlook, a $13.8 billion profit for this year, based upon a 3% increase in capacity, in traffic, and a 2.8% increase in capacity. I think that IATA, by the middle of this year, is going to be having to revisit those figures. All of our carriers are going to have to revisit where they're at. For Air Canada, I mean, you have to look at this industry as cyclical, as a high fixed cost industry, high capex, spending decisions. You've got to consider things, in the 5 and 10 year cycle. So I think Air Canada is probably still okay in terms of this longer picture. This year, though, is going to be a bit more of a challenge.
Robert Konas of AirTrav. Remember, this Friday, we bring back Talking Tax. Tune in every Friday, 4:30 p.m. Eastern Time, 5 p.m. to ask your tax questions. Thank you very much indeed for watching Trading Day.
Trading Day is brought to you by Capital Group Active ETFs.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between adaptability, strength, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart so they can make a difference where it matters. The core of a portfolio. Capital Group. Actively different.
Looking for a smarter way to mop? Try the Swiffer Power Mop. An all-in-one cleaning tool that gives you a mop and bucket clean in half the time. Our cleaning pad has hundreds of scrubbing strips that absorb and lock dirt away. And it has a 360-degree swivel head that goes places a regular mop just can't. So you can clean your home faster and easier. Goodbye hassle, hello Power Mop. And with TerraCycle, you can recycle your Swiffer pads.
At Genesis, centered around you means reflecting your every need. Like respecting your time with 5 years of vehicle care and providing you with all-inclusive seasonal care, including winter tires, installation, storage, and valet service. This is effortless ownership. This is what sets Genesis apart.
Just close the doors, and you're in a world of your own. Travel is not just about the destination, it's also about how you get there. Fly Emirates. Fly better.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian preferred share ETF, Mulvihill.
I love Parliament Hill. I love the drama. The stakes are so high. And Question Period is the landmark. Want to know what's truly going on in our country? Here's where you'll find out.
A lot of Canadians are saying, what's this government's vision for the future?
This is a place where real change can happen. Major players, tough conversations, everything off the cuff with real pressure to give honest answers.
These are big, big issues.
These are the people who make news. What they say drives what everyone in Canada is talking about. And right now, that's more important than ever.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Shonali Basak.
And I'm Jackie Duvall in Washington. This is Bloomberg Technology. Coming up, stocks rebound after a positive inflation reading. The relief comes after some market turmoil this week on the back of President Trump's tariffs. Plus, we'll dive into what's behind the retreat from Musk's EV company, with Tesla being the biggest decliner in the S&P 500 index this year. And SpaceX's Crew 10 is launching this evening for a relief mission for NASA astronauts at the International Space Station. But first, let's get a check on those markets. Shonali?
Yeah, absolutely. First, I want to bring you into the NASDAQ 100 here, Jackie, because we did start the day strong. We are losing some of that steam today, and looking at a NASDAQ 100, currently up only about 0.4%. Remember, we've had a lot of malaise in recent days. Let's flip up the board here. Also take a quick look at the Philadelphia Semiconductor Index, because that has been harder hit this year. Yet you are seeing a little bit of a bigger gain there in the index, up almost 2% today. And part of that, of course, is because of Intel. Intel still up about 2.6%. Again, not as much as it was up earlier in the day, but still up off the heels of a report from Reuters saying that, of course, partners are being formed around the foundry business, potential joint ventures led by TSMC, potentially AMD, NVIDIA as well, and Broadcom. But of course, Intel now snapping, Jackie, 7 days of losses.
Let's get into some of these Intel moves right away with Bloomberg's Mike Shepard. Mike, there's still a lot we don't know about some of this report coming from Reuters on Intel. Fill us in on what we do know.
Well, one of the questions is really how much of this would ultimately bear fruit. And we had reported about a month ago now that the Trump administration had approached TSMC to perhaps take over Intel's foundry business. That would be a big undertaking, of course, given all the malaise surrounding Intel and some of the business complications therein. But it also opened the door to perhaps working together with other companies. And this report would certainly fit into that. However, more recent events suggest a different direction of travel. Intel announced this $100 billion additional investment in the U.S. A little more than a week ago with President Donald Trump. And that's the kind of thing that doesn't seem to include or leave room for Intel. Also, there are some thorny problems involved here. One of them is intellectual property. Would TSMC be willing to share some of its precious trade secrets with a company that could in other ways also be a rival when it comes to its business? Likewise, integrating some of Intel's operations into TSMC would also involve a lot of work. So there's a lot of skepticism surrounding this report. We'll have to see what actually develops.
Mike, I want to bring in your broader view here, of course, because you're seeing a market today that is reacting to some of the relief relative to where we were 24 hours ago in the tariff story. Yet you are seeing retaliatory tariffs coming in from around the world, looking at the EU and Canada. How are investors, markets digesting the latest coming out of Washington, and what is still absolutely uncertain?
Well, there is a lot of uncertainty. As you put it earlier in the intro, malaise. That really seems to be one of the operative words right now when it comes to investors, and especially in the tech sector. When you look at the NASDAQ 100, it really has taken the brunt of this downdraft in markets. Obviously, there was a lot of run-up ahead of time in the past year or so on enthusiasm about artificial intelligence. And, you know, what goes up is now coming down. but a lot of that is being fueled by uncertainty surrounding the president's tariff policies. And last night, during a meeting with top CEOs here in Washington, he signaled that they should be prepared for more. He sees tariffs as a tool for getting companies to invest in the U.S. And he has cited in the past Apple's decision to invest $500 billion here in the U.S. And we just talked about TSMC's plans. Both of those he credited to his own tariff policies.
Let's talk a little bit more about that meeting. There was a lot of anticipation. We saw chip stocks really take a beating last week, but now they're getting a little bit of relief. They're up by about 1.6%. What did we learn more from that meeting with tech CEOs earlier?
Well, the tech CEOs meeting on Monday seemed to be less of a fireworks event, and then the business roundtable meeting last night seemed to be a little bit more of a more cordial give and take, even given the circumstances that we're seeing in the market and the concerns that CEOs may have about where to take their business in light of the way tariffs could affect their supply chains. We heard Anthony Neri, the CEO of Hewlett-Packard Enterprises, tell investors on a call last week, look, we don't know where this is going exactly. There may be some pricing changes. We're going to do the best we can through our supply chain to minimize the impact, but they really don't know where it's going. And that was also echoed by the head of Broadcom, Hock Tan, on a call with investors as well, suggesting that, hey, this is really early and we don't know where this is going.
Mike, we appreciate all your time and all your analysis. That is Bloomberg's Mike Shepherd. Now, I quickly want to check in on shares of Tesla as well, because as Mike was talking about, a lot of malaise in the tech sector, but not today. And Tesla is the one that's really leading the NASDAQ 100 higher. It is still up more than 5%. But remember, it was down 15% on Monday. So between Tuesday and Wednesday's gain, we have not recouped all of those losses. Yet it sure helps that it's up today for the broader NASDAQ 100. And to zoom out now, we're going to bring in Amanda Agatti. She is the CIO of PNC Asset Management Group. You know, you think about what's happening in the tech sector. Yes, today is a day of relief, but the Mag 7, the relative underperformance that you have seen, at what point do you see that overhang start to disappear? Really, the only member of the Mag 7 that is up year to date is Meta.
That's right. It's great to be with you, and I would say that overhang is going to stick around for a while here. The challenge is that we're still very much in a purple haze of fiscal policy uncertainty, and it's namely tariff and trade-related policy. And so it's not so much of a direct hit to the underlying fundamentals of the Mag 7. In fact, I think for the most part, their business models tend to be somewhat insulated from it. But the challenge is that in this purple haze of uncertainty, there's pretty extreme valuation multiple compression. And the Mag 7 have been priced to near perfection. So we're not seeing fundamentals deteriorate. We're just seeing multiples come down materially until we start to get past some of this growth scare narrative that's been gripping markets. I think it's going to continue to be an overhang.
Amanda, you mentioned fundamentals. They look strong. There was so much reassurance from companies and appeased investors that a lot of the CapEx going in isn't going to stop. That spigot is going to keep going. But are we bracing for a more fragile tech sector now? What catalysts going forward do you see kind of providing more assurance to investors that they're not going to be that easy to break?
It's a really great question, and it's a really hard one to answer. And I think that's why tech investors in particular are struggling in this environment, because we are craving more catalysts. We're in a little bit of a lull in terms of innovation. And so the focus these last few years has really been on chips, one stock in particular. But where are all these use cases? We need to see broader based use cases, new business models really developing and broadening in terms of adoption across the market. I think that's really the critical catalyst or next step to this next wave of innovation, and perhaps even getting the market rally catalyzed again. So I think it's going to take a little bit of time given some of this policy uncertainty, but I think it absolutely could become a tailwind in the second half of this year and into 2026. It's just we're in a little bit of a void at the moment, which is very frustrating, certainly.
Now, you know, one interesting part of the tech trade as well is just how much much it has contributed to the weakness in the consumer discretionary sector. For the S&P 500, you think about Amazon, you think about Tesla. In reality, how levered are some of those giant tech names to the U.S. consumer and any potential further weakening?
Well, I always say that the U.S. consumer is in the driver's seat, right? 70% of GDP or spending in this consumption is tied to the consumer in some way, shape, or form. And so the path for the consumer and the health of the U.S. consumer is critical for all of us in terms of both the market and the economic cycle. But I think you're right to make a little bit of a distinction here in terms of how much influence directly hits some of those business models. I think the story and the concern is much more around, do consumers start to get a bit more paralyzed by this policy uncertainty, and so they slow down or even stop spending, which sort of cascades into a more material slowdown than what we're seeing. The earnings growth backdrop is continuing to be strong. It's not so much about one quarter. The full year expectation still looks very strong. The economic cycle looks pretty strong. Consumer spending related data looks solid. So again, it's all about this sort of narrative and this sentiment concern. It's not so much translating into the underlying fundamentals breaking down yet.
Now, when you think about the consumer also, we're thinking about the U.S. consumer so much, and you have to wonder whether Europe, China is a bigger headwind or tailwind for this group. Do you see any risk there?
I'm most concerned, I think, about developed international exposure, and so Europe in particular, just given some of the continued geopolitical tensions and conflict. Are we going to get a resolution out of Russia and Ukraine or not? That's a really critical thing that I think needs to happen to see signs of life improve in a more material way across the Eurozone. I think it is possible to see a bit of a relief rally. We started to get it at the beginning of the year, and then we've seemingly seen it falter a bit here. So, I am most concerned about that area. I think in terms of emerging markets more broadly, there's a really attractive valuation opportunity there. So for investors who can be patient, I think this is a very attractive entry point, even in the midst of, additional tariff policy aimed specifically at China. I think there is a real opportunity set there for investors to be focused on in terms of allocating capital early this year.
Amanda, on that emerging market story, China is a huge competitor here in the tech space. Are you seeing any interesting opportunities with some of those up-and-coming companies unveiling new features and AI models every week that could give investors perhaps another choice outside of the traditional U.S.-based tech players?
Well, I'm never going to bet against our U.S. Tech industry. Just as a general rule, I have a very home country bias here. But of course, I think innovation shows up in all different shapes and forms. And so, even just what seemingly is old news now, but the DeepSeek story that sort of came out of nowhere recently, I think is fascinating in terms of this innovation story being born out of anywhere and sort of this natural comparative or competitive advantage that we have as it relates to AI, automation, robotics, et cetera. The story continues. And so I think it's really healthy. And I think it's important for investors to think much bigger and more holistically than just, one or two names. This cycle is very early innings. We have a long, long runway here. And so we are absolutely believers in the secular tailwinds here. And so from a multi-asset investor perspective, I think you really do have to look beyond U.S. equities in this environment. Even in private markets, I think there's a tremendous amount of opportunity in VC land.
We'll have you down as not betting against the U.S. Amanda Agatti from PNC Asset Management, thank you so much for joining us. Coming up, Google DeepMind launches a new branch of its AI model to help robots navigate the physical world. We'll get the details after the break. This is Bloomberg.
Bitcoin is surging as major financial institutions rapidly integrate it into their portfolios.
Bitcoin since the election has gone from $60,000 to $100,000.
deregulation across the nation means strong support for Bitcoin, and Hive is thriving. Hive is positioned to quadruple their global footprint in 2025, aiming to capture 3% of the world's Bitcoin supply. Hive Digital Technologies.
This is severe weather. It's getting worse in Canada, and we are all paying the price. But this is what protecting Canadians from the impact of severe weather looks like. The 140,000 people in our home, auto, and business insurance industry working in your community, advocating for solutions that protect all Canadians. It's all part of our plan to protect the things we love.
A diaper this leak-free sets them free. Only Pampers Cruisers 360 have a 360 stretchy waistband for up to 100% leak-free fit on every wild child. Pampers Cruisers 360. Live wild and free.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Gold standard. Gold dust. Pot of gold. Solid gold. Golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
Google DeepMind has unveiled a new Gemini model that it says helps robots understand the physical world around them. Bloomberg's Mark Gurman joins us now. Mark, it seems like every big tech company has been unveiling some kind of new robotics venture as of late. How does Google stack up?
Yeah, I've been trying to tell everyone on here, robotics, consumer robotics is the next big thing in the industry, right? We had autonomous cars, we had mixed reality, AR glasses, we have voice, right? But artificial intelligence is going to be at the core of everything. And really the ultimate hardware expression of AI is robotics, right? Being able to understand how a human acts, right? Artificially learn from data, right? And mimic a human. And that is what a robot is, right? And so you've seen Tesla play in this space. Now you're seeing Meta make a big investment in that space. And now today, Google is announcing new Gemini models and infrastructure specific to powering robots. So all of these companies want to play in this space. Meta announced versions of Llama, right? In a big investment to build consumer robots and to be at the center of everything. Meta wants to be the future operating system to power these robots. But they're going to have a big competitor here with Google, right? Yeah. Who has experience building operating systems for first-party and third-party hardware. And obviously, Gemini is right up there with Llama and ChatGPT and the other AI systems. So this is a big deal not only for Google, but the industry at large.
So, Mark, how convincing is this push? Because we have seen Google try, or Alphabet try, to get into the robot world before. My understanding is that they shut down a spin-off company that was associated with this. So this time around, what's the difference and how big is the push?
I think the difference this time is Gemini, right? The underlying AI technology is much different. It's much more advanced. It's more reputable, right? And now appears to be the time where companies are willing to put in the proper investment, the necessary infrastructure to make robotics happen, right? Waymo has been pretty successful comparatively in the industry. And so what you're seeing is a lot of data collection there, a lot of experience in autonomy and cameras, and that's technology that Google could ultimately use if it wanted to build its own humanoid. But don't count out Apple. Apple has skunkworks teams working on humanoid robots as well. The big difference is they're not going to publicly release an underlying robotic model, right, in order to support third-party robots and other consumer hardware. They're going to go all in-house. They're going to follow the Tesla method that you've seen from the Tesla bot over the past couple of years. So at some point in the next 5 to 10 years, you're going to see real competition between Google, Meta, Apple. Tesla, the Chinese companies, and others in consumer robots. So stay tuned. This is going to be a really big deal. And some of those movies we've seen over the last several decades, they're starting to come to reality.
Mark, we thank you so much for your time today, breaking it all down for us. That is Bloomberg's Mark Gurman, and as you know, I'm excited about having a robot at home, and we're going to talk more about robots here. Not as pleasant of a story. Shares of consumer robotics company iRobot, they're sliding today after it warned of, quote, substantial doubt over its ability to continue to operate. You might remember that the company was once sought after by Amazon for more than $1 billion, and it has begun a formal strategic review to evaluate options. For more, Bloomberg's Veronica Clark joins us now on set. Was this warning a surprise, especially given the kind of unicorn standing that it once had?
Not totally. The company has been losing money and burning cash for the past at least 3 years. And then when the Amazon deal failed, basically last year, the company lost a big option. It started a strategic review last year. It has cut losses, but it's still loss-making, and it has cut expenses, but it's still struggling.
Irene, what does this tell us about the state of consumer demand in this space? As we were hearing, it seems like the time horizon for some of these technologies to really get in the hands of consumers takes time, especially for those to get used to them. What does this tell us?
So in the case of this company, I guess it's another example of consumers cutting on discretionary spending. We've seen it in other names like casual dining companies like Hooters considering bankruptcy filing. We've seen it in a broad range of retailers also struggling. So this is another example. And the company mentioned in the going concern warning that consumer spending could be one of the reasons why, like weaker consumer spending could be one of the reasons why it doesn't manage to survive. And tariffs was another one that they mentioned as a potential threat to the company's viability.
Tariffs weighing in here as well. Bloomberg's Irene Garcia Perez, thank you so much for joining us. Still coming up, Tesla investors may be sitting on the sidelines as shares of Tesla fall over 42% so far this year. More on that next. This is Bloomberg.
Eric Gorman is the VP of Operations at Capital Direct. What's the latest?
Well, I'm back with more good news. In 2024, Capital Direct One Income Trust beat analyst predictions as our return trended upward. Our Class F unit hit 10% annualized return, and our Class A and C kicked out over 9%.
Those are impressive numbers. How do they compare to historical returns for the fund?
Yes, 2024 was a good year, and that's in line with our track record. We've been in the market for 19 years now, and we've continued to kick out consistent, stable returns for our investors with a low standard deviation.
And what's the growth rate for the fund over several years?
Over the last 10 years, the number of accounts holding the fund has increased by over 1,000%. Also, the trust assets have grown over $500 million. We believe this growth shows the trust that both individual investors and financial advisors have in Capital Direct One Income Trust.
What does the fund offer investors as far as flexibility?
Well, to start, monthly liquidity opportunities. And then in regards to our quarterly distribution, some people take it as cash, so see it as an income vehicle. Others take advantage of compound growth by opting into our automatic DRIP program. I would say the DRIP is the most popular. For most investors, it's a set it and forget it scenario.
And can people change if they want the cash or reinvestment option?
Yes, we realize that people may need access to their distribution, whether for a family event, a down payment, or even to satisfy a minimum RIF payment. They or their advisor can opt back into the DRIP program at any time.
And where can people find out more?
So we are registered in every province throughout Canada. People can find us online at incometrust1.ca or call us directly 1-800-625-7747.
Now, some long-term Tesla investors are backing away from the stock after falling as much as 42% so far this year. And this is as questions arise about the company's future. For more, Bloomberg's Max Chafkin joins us today. Now, I want to point out also, of course, today people are buying the dip. People are believing the story today. You have the president himself looking to defend Musk in many ways. What is the trouble in paradise?
I mean, more than defend, holding a sales event on the White House lawn. The trouble is that Tesla's customer base is not especially Trumpy, and that's probably an understatement. You think of a typical Tesla owner, this is like an upper middle class, suburban, progressive, or at least a centrist, somebody who cares about the environment. These are not Trump voters. These are very much the constituency that backed Barack Obama, Joe Biden, and to a large extent Kamala Harris. And those people, which include a lot of Tesla customers, are very mad at Elon Musk right now. We've seen protests all across the country and the world, including some acts of vandalism, and just this kind of tone of mockery of seeing Elon Musk as kind of a lightning rod for the worst, for what these Tesla customers see as the worst excesses of the Trump administration so far.
Max, and it's not just about the political leanings of who's buying some of those cars, but they've recently gotten some pretty good support, especially under the Biden administration, for EV credits. And I'm having trouble reconciling how Elon Musk can really back Trump in some ways, but his company is somewhat dependent on the government also supporting the transition to electric vehicles. How is that working out?
Yeah, Trump kind of ran to some extent as an opponent of electric vehicles, talking constantly about ending the quote-unquote electric vehicle mandate, and in fact signed an executive order early on stating an intention to pull back some of these regulations. Even brought this up during the event yesterday, offering it as an example of how selfless Musk is. I think from the kind of bull perspective, like why Tesla investors could be potentially okay with this, is the fact that Tesla has a leading market position. So if you remove these subsidies from electric cars, it arguably hurts GM and Ford and Tesla's other competitors more than it hurts Tesla. Tesla has wider margins on EVs. It's able to better absorb this. Now, that said, those companies are bringing out new models and they're stealing customers away from Tesla.
Right. That's Bloomberg's Max Chafkin. Thanks so much for joining us. Still coming up, another NASA SpaceX mission to set launch later today. It's hoping to bring back 2 NASA astronauts stuck there since June. This is Bloomberg.
Helium evolution. Advancing Canada's quest for a critical mineral essential in today's most advanced technologies, with helium demand forecast to explode by 70% over the next 15 years. A land position of over 5 million prospective acres in Saskatchewan, among the world's cleanest helium producers, and an ongoing development program in partnership with the industry's largest producer. One company is poised for significant future growth. Helium evolution, unlocking Canada's helium potential.
Have you outgrown your wealth advisor? At Standard Wealth Partners, we specialize in managing significant portfolios of at least $10 million and higher. Contact us today in complete confidence. We'll be here when you are ready.
What keeps baby's skin healthy? A diaper that doesn't leave skin wet. That's why Pampers Swaddlers absorbs wetness better for up to 100% leak-proof protection and 0% skin irritation. Pampers, for healthy baby skin.
Invest like a champion with Hamilton Champions ETF CMVP and SMVP. Exposure to Canadian and U.S. dividend all-stars. Hamilton Champions ETFs. Zero management fee until January 2026.
It happened on March 9th at 6:17 p.m. Gathered was Marco with his dog Minnie, curling champs the Malleys, and content queen Quinn. So how did the never-available host Julie make the unplannable happen? With Samsung Galaxy AI on Bell.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help.
The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
A lot of hot women away from home, acting all anonymous.
I just don't understand why you wouldn't hook up with me.
Because you're soulless.
That's the perfect week for a fling. She's an aging actress. It's pathetic.
Actresses are all basically prostitutes. Am I right? I grew up here, and so did a lot of the girls working the avenue today.
Saturday, 3 females have been found dead.
Mickey, what's going on?
It's Casey.
Why are you looking into this?
She's still out there.
This thing is far bigger than we thought.
Mickey, don't go in!
You gotta let it go.
Amanda Seyfried.
I'll let it go when I find her.
Long Bright River. 2-episode premiere. Saturday at 10, 7 Pacific on USA Network and Crave.
And welcome back to Bloomberg Technology. I'm Shonali Bassick in New York.
And I'm Jackie DeValos in Washington.
Let's get a check on these markets because you do have a NASDAQ 100 that has been fluctuating. We are well off of session lows for the morning, but only up now about 0.6%, and it's trying to fight for dominance. You have the NASDAQ 100 with only roughly half of its component parts up on the day. The other half, of course, down. The Philadelphia Semiconductor Index maintaining its lead after a brutal stretch the last couple of weeks. It is now up about 2.3% heading into midday. And for a check on other movers this morning, we're going to bring in Bloomberg's Isabel Lee, who joins us now on set.
Hey, Shonali. So there's really a ton of uncertainty in the markets right now. A gauge by city shifted from risk off to risk on to risk off, rather, in just 6 weeks. And really just a slew of headlines crossing the wire this morning, from Canada firing back on tariffs to inflation, is really causing some more angst. So back to inflation, that's a big data today. It showed some signs of easing, but even so, economists are anticipating that the escalating trade war will really just drive up prices. And you see waves of selling, even in tech high flyers. So Tesla, Supermicro, and Palantir, for instance, have wiped out more than a quarter of their value in the last 14 trading sessions since they peaked. So their losses are more than triple the decline of the S&P. So really a tough market right now. And of course, the NASDAQ 100 tumbled into correction territory last week.
Isabel, talk to us about what we're seeing in some of those Mag 7 names. You mentioned Tesla seeing some relief. What else are we seeing when it comes to the big tech giants that absolutely got battered earlier this week?
They're still really battered. Tesla is leading the losses in the Magnificent 7 index, and you see the rally broadening out, and there are the losers right now. In fact, a note earlier this morning says Maleficent 7, and you see that people are now questioning whether the U.S. exceptionalism has cracks. We have Citigroup and HSBC downgrading their views on U.S. equities this week. I talked to a bank yesterday, and they said that they're underweight the Magnificent 7, which is really a stark contrast to when everyone was just piling in, because if you don't pile in, then you underperform the benchmark. But we have JP Morgan David Lebowitz, which I talked to yesterday, said that, you know, risk premiums have jumped, credit market has yet to crack. Economic data, at least for now, points to expansion, so bullish overall in the long term.
That's Bloomberg's Isabel Lee. Thank you so much for joining us. 2 astronauts stranded at the International Space Station since arriving aboard Boeing's Starliner in June could finally be heading home. That's part of the goal for the SpaceX Crew 10 mission scheduled to launch later today. Joining us to talk about this is Clayton Swope. He's Deputy Director of the Aerospace Security Project and a Senior Fellow at the Center for Strategic and International Studies. Clayton, this is a really big moment. Everyone has really become so endeared to Sonny and Butch. What did this tell us about what went wrong, and will this ever happen again?
Well, Jackie, it's funny. I was thinking, too, the one thing that I have as a takeaway is just it's about Sonny and Butch and just their endurance and their patience and their grace. And it's something that I think back on. I think I admire that. I'm sure a lot of Americans admire that, and people around the world. And probably you, like me, I get upset when I'm 3 hours delayed at the airport, and they've been there since June. So it's a very different thing to think how long that they've been up there and everything that they've been through. But they've had that poise throughout. I think what we've learned, too, is that space really can still throw us curveballs, but that we have gotten to the point where we have flexibility and adaptability, that we can still do human space flight safely and do that at scale. And that's a lot of credit to NASA on the approach that they've taken to get us here, and then also to SpaceX on whose technology we really relied on to make this happen.
How do you think about the next steps moving forward when it comes to the Starliner? What do you think is the future from here?
Well, there's still a lot of things that we don't know. We do know that Boeing has said they want to stay in the space game. It's less clear on what happens next for Starliner specifically. That will depend a lot on what NASA decides with Boeing about certifying that capsule to fly astronauts again into space. So we don't really know how long that would take. But if we look to the horizon, just with the International Space Station, we're planning for it to deorbit in 2030. So that's less than 5 years away. So there's really only a few more opportunities, really, in the grand scheme to bring astronauts to that station, and that window is quickly closing.
There's been a lot going on in the space field as of late, and I think it has many people wondering, are we in a new space race of some kind? How does the U.S. stack up with what we're doing in the field versus other countries?
It's really hard to not think about China and all their achievements in space. Right now, there's 7 astronauts and cosmonauts on the International Space Station.
Hold that thought for a moment here, because we want to bring our audience some live images of President Trump, who is greeting the Prime Minister of Ireland. The two men are about to take part in a bilateral meeting at the Oval Office. Now, we will bring you those headlines as they come in. You could also check for updates on Live Go on your Bloomberg terminal. Now, Jackie, back to you.
Talk to us more about how China is really getting to the space race.
Yeah, there's 3 Chinese astronauts on their space station, Tiangong 3, right now, as we speak. So they've really made space look routine in a lot of ways that America has also been able to do. They're also eyeing the moon. They want to land Chinese astronauts on the moon by 2030. So is NASA. I think it's hard to avoid the notion that this is a space race, maybe a moon race 2.0. The United States is still the undeniable space power, lead space power in the world, but China is definitely nipping at our heels.
Let's talk about who's making us the space power. We hear a lot about SpaceX, but over in Silicon Valley, there's a lot of contenders really coming into the fore as well. What are you seeing in terms of concentration of who's taking us to the next level?
SpaceX is the main player right now when it comes to launch, when it comes to broadband from low Earth orbit, when it comes to a lot of the things that we rely on to get people and cargo to the space station. But there are a lot of other companies that are innovating in Silicon Valley and around the country. You have companies in Pittsburgh and Texas and Florida. They're trying to catch up and come up with new ways to do space, to do it cheaper, to do it more efficiently, to mine asteroids even. So there are a lot of up-and-comers that really will challenge SpaceX's dominance, and it will be their game to lose, though, over time, because there's a lot of smart people, though, right behind them.
Let's talk a little bit about who's behind SpaceX, because Elon Musk has been making waves here in Washington for other reasons. But one of the areas that he's poised to potentially benefit from are his relationships in Washington, SpaceX potentially getting more contracts. Does his politics detract in any way from the progress that SpaceX can make, or does it really operate independently of that?
SpaceX has led the way for what we call commercial space today, and it has taken a number of years for them to get to where they are. This isn't something that just happened with President Trump's inauguration in January. This has been a long trend where NASA, the Department of Defense, and other customers, both commercially and internationally, have really grown to depend on SpaceX for launch and then now for broadband from space. So these are areas that have been trending in that direction for a long time. Those business opportunities that exist in space, SpaceX built over the last few years, probably starting around 2008. So it's not something new, and they're just really taking advantage of all of that time and effort that they put into this for almost 7 to 8 years at this point.
Clayton, we thank you for joining us, of course. Fascinating establishments in that space race. That is Clayton Swope from the Center for Strategic and International Studies. Now, coming up, startup Celestial AI hits a $2.5 billion valuation. We're going to speak with the CEO, Dave Lazovsky, next. This is Bloomberg.
for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
You've got a Pepto predicament, Ace. You overdid it on your poutine routine. Undo it with Pepto Caplets.
When you have nausea, heartburn, indigestion, upset stomach, diarrhea.
When you overdo it, undo it with Pepto-Bismol.
Do you need financing for your business? Get up to $800,000 in less than 24 hours from Merchant Growth. Apply online today and get your no-obligation quote. Trusted by over 10,000 businesses, Merchant Growth is Canada's leader for convenient business financing. Apply now at merchantgrowth.ca.
This Charmin Ultra Soft Smooth Tear has wavy edges.
It's no ordinary square. Charmin Ultra Soft Smooth Tear has wavy perforations that tear so much better, with more cushiony softness. Enjoy the go with Charmin.
Just close the doors, and you're in a world of your own. Travel is not just about the destination. It's also about how you get there. Fly Emirates. Fly better.
At Interactive Brokers, registered advisors work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for Advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
What do you want?
To bring people together.
Welcome to the villa.
Hello!
For my family.
Family forever, baby. Oh, what a moment!
Doesn't that sound good?
Seriously? I give to you best team in the league ever!
Get the Crave TSN bundle, the ultimate entertainment and sports bundle. Start streaming. Visit crave.ca/subscribe.
I love Parliament Hill. I love the drama. The stakes are so high. And Question Period is the landmark. Want to know what's truly going on in our country? Here's where you'll find out.
A lot of Canadians are saying, what's this government's vision for the future?
This is a place where real change can happen. Major players, tough conversations, everything off the cuff with real pressure to give honest answers.
These are big, big issues.
These are the people who make news. What they say drives what everyone in Canada is talking about. And right now, that's more important than ever.
Startup Celestial AI has raised $250 million in its latest Series C round, valuing the company at $2.5 billion. Its photonic fabric technology aims to improve speed and efficiency in AI computing. For more on this, Dave Lazowski joins us now. Dave, help our viewers understand how your technology is actually making this part of AI computing that much more efficient.
Thanks so much for having me. Yeah, Celestial AI is the creators of the photonic fabric, as you'd mentioned, which is the optical interconnectivity technology platform for accelerated computing. So said another way, we're interconnecting AI processors with light. What's happening in AI right now is that artificial intelligence workloads are growing exponentially. They're now so large, trillions of parameters, that they need to be partitioned over hundreds of processors, which puts more and more demand on the network as the processor doing the work needs to move across the network to fetch information from another processor's memory, moving it back to where the work gets done. And there's no more efficient way to move information than photonically.
Dave, you managed to snag $250 million from some institutional investors by the likes of Fidelity, Tiger, BlackRock, Maverick Capital. How do you plan to put this money to use?
Yeah, we're focused right now on scaling. So we have multiple deep collaborative development engagements with the largest hyperscale data center companies on Earth. Right now, we're collaborating with them to integrate our photonic fabric technology into their next generation AI accelerators. These are programs that are on the order of 18 months, so through the balance of 2025 and into the first half of next year. We're working together to get this technology scaled and qualified. So right now the focus is on our volume manufacturing supply chain because our customers are immense scale. They require hundreds of thousands of units to serve their demand.
You know, Dave, back to the fundraising question as well. Not only do you have kind of like the blue chip of finance involved in this round, Fidelity, BlackRock, but the Mavericks and Tiger part of this, it's interesting. When you have those traditional hedge funds getting in, they have been cautious in the world of startups, especially with a dearth of public market exits. So bring us behind the conversation. What is it about you and them that served as a good match?
Yeah, so we took a hard look at the types of investors that we wanted to have involved at this stage in the company's life cycle. So just as you develop a technology for successful qualification and implementation in a large market like artificial intelligence, we are developing and optimizing our cap table for having the right investors involved, not just at this phase in the company's life cycle, but through an IPO, should we make the decision to take the company public over the course of the next few years, and to have the right investors that can invest with us over the course of the next decade or more. So on their end, the decision, I think, was made based on the fact that we are the only company in existence that has the ability to provide optical interconnectivity that meets the requirements of what are called scale-up networks. This is a processor-to-processor interconnect. The gold standard today is NVIDIA with NVLink and NVSwitch. All of that is run over copper. So data communication today between processors at NVIDIA and elsewhere throughout the industry today is entirely electronically over copper. With the photonic fabric, we are changing that, right? We're moving information optically at a fraction of the energy and at much higher bandwidths and lower latency.
You know, an interesting part of your cap table also that I've noticed, and this was an existing investor, is Porsche. And with all that's going on in the world, worries about the consumer, worries about international trade, auto parts also facing risk of tariffs. I'm wondering what role you play in the automobile story. Have they led to meaningful work with you as an investor?
So there's two different branches of Porsche. There's Porsche AG, which is the automotive group, which we all know and love. That's my favorite brand, by the way. And there's Porsche SE, which is the mothership. That's the holding company for all of the Porsche's family money, as well as they control about 50% of the assets of the Volkswagen group. So this is the financial arm of Porsche. Now, Porsche can, and certainly we anticipate will be, a strategic partner for us as well on the automotive group side, as their requirements for artificial intelligence training and inference will be similar to that of Tesla, who has played kind of a leading role early on in building out AI infrastructure in support of autonomous vehicles.
Dave, how do you think about kind of diversifying your customer base? You noted that your target clientele, that those effectively control more than 90% of the trillion-dollar end market. Do you get to expand past that as the company grows, or are you more dependent on those select few?
Well, like you just said, those select few represent, there's 8 companies that represent roughly 90% of this trillion-dollar market, and we'd be fine with just those, right? So if you think about it, that's a good problem for us to have, right? You've got 4 major hyperscalers. I think the world knows who they are. That represent roughly 70% of the addressable end market. And then you have the ecosystem around them, right? The GPU manufacturers, which include NVIDIA and AMD. AMD, by the way, being one of our strategic investors as well. And then there are a couple of design services companies, which include Broadcom, right? So Broadcom is playing a larger role. I think you heard from their earnings announcement over the last week and a half that they're gaining traction in building custom silicon for the hyperscalers.
Dave, we thank you so much for your time today. Congratulations on that fundraise. We are looking forward to seeing where it all goes. That is Dave Lazovsky of Celestial AI. Now, another AI story that we're watching, Alibaba is accelerating its efforts to lead in the AI space, and they're pushing out an AI model that can read emotions. For more, Bloomberg's Peter Elstrom joins us now, and I think just back to a couple days ago, I tried so hard to read the story that Sam Altman posted online about the creative writing exercise that you saw through OpenAI, and that does go down to the ability to read beyond the objective and into the subjective, right? And so when you think about Alibaba, how successful are they in emotional intelligence?
Well, we're seeing this very rapid innovation of AI models really around the world, but China now particularly has gained a lot of attention because of the breakthrough of DeepSeek a few weeks ago. Alibaba is, of course, best known for its e-commerce business. It competes with Amazon in that market, but of late, the past couple of months, they've come out with a number of AI models that are quite innovative. They have one called Gwen that it compared with DeepSeek and said that it was ahead on certain metrics. They're also striking an alliance with Apple to be able to provide some of the AI features for the iPhones within China. And now we see this. The model is called R1 Omni. They're saying it's able to detect emotions within the people who are asking questions and give better answers because of that. They can customize in certain ways. Now, this follows very rapidly on the heels of OpenAI, which has tried something like this with their GPT 4.5. Now, OpenAI is charging $200 a month for that service, and here Alibaba is putting this out there for free. It doesn't have all the bells and whistles that you would see in some other models, but it's a pretty aggressive move into this space, and the China market is not one where you're going to see the American companies play, so it's a pretty far step ahead for Alibaba.
Peter, we have about 30 seconds left, but talk to us about how this now stacks Alibaba up against some of the players here in the U.S. Is it really going to depend on things like emotional intelligence?
Well, it's important to understand how bifurcated these markets are. The Western companies can't get into China. These Chinese companies are largely not competing outside of their own market at this point. So they're pretty separate at this point. But I think what's been surprising to a lot of observers is how quickly some of these Chinese companies have been able to evolve their AI models, especially because they're cut off from the most advanced chips. You were talking before about the NVIDIA chips that are used to train these AI models. Most of the Chinese companies can no longer buy those from the Western world. So they're doing this with some pretty hardcore engineering. DeepSeek in particular showed that they could make some advances that would be very difficult in the Western world. That's partly because of the constraints they have on the chip side.
Peter, we thank you so much for all of your reporting. That is Bloomberg's Peter Elstrom. And Jackie, something I've been thinking about that is interesting about this emotional intelligence aspect of things is if you believe that leadership needs EQ, maybe AI can be your next boss.
Yeah, let's hope not. I don't know about you, but I wouldn't want AI giving me my eval, if you know what I mean.
Right, or a raise. Anyways, coming up next, remember, speaking of big companies, we are coming out with Adobe earnings after the closing bell. It has held up relatively well in the tech malaise we've seen through the broader market. We're going to take a look at what to expect next. This is Bloomberg.
You are one with the rod and pipe. You are the golden arm.
I need a minute. I'm meditating. That's not meditating. I just heard your weird self-recording.
Introducing the Brompton Cash Flow Kings ETFs. Investing in high cash flow yielding companies, putting their power to work for your portfolio. Brompton Cash Flow Kings ETFs. Because cash is king.
I just took a shower above the clouds. You know why? Because this is the Emirates A380.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between adaptability, strength, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart, so they can make a difference where it matters. the core of a portfolio. Capital Group, actively different.
A diaper this leak-free sets them free. Only Pampers Cruisers 360 have a 360 stretchy waistband for up to 100% leak-free fit on every wild child. Pampers Cruisers 360. Live wild and free.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me or is there some kind of clue here? I don't know.
Closed captioning of this BNN Bloomberg program is brought to you by Sizzle Brands, one of North America's fastest-growing sports nutrition companies, trading on the CBOE under CZZL.
Adobe earnings are out after the closing bell, and we're going to bring in now Anurag Rana of Bloomberg Intelligence for a look at what to expect. It's interesting because Adobe has held up relatively well relative to a lot of those Magnificent Seven names, relative to what you've seen in a lot of the Philadelphia Semiconductor Index. Is there a story, something to buy right now, or are there real risks after the market today?
So, Shonali, when you look at it, Adobe is probably the cheapest large cap software stock right now, much cheaper than any of its peers. And there is a reason behind it, because it is also the most controversial one right now. They have a huge segment, one of the most profitable businesses in the world, their Photoshop creative business, which is under threat or perceived threat by a lot of open source models out there. Now, the company has guided to their annual recurring revenue for their digital media segment to go up by 11%. That's the only number we are looking for when they report, because any kind of disturbance in that number on the downside really is not going to be good for the stock. But meanwhile, if they are able to hold on to it or even raise it, I think that's going to be perceived very well. So that is really something different that's happening from a macro side right now.
Anurag, thank you so very much for your time. That is Anurag Rana of Bloomberg Intelligence. We are looking forward to your readout after they report. To your point, very controversial at the moment, and we are hitting that tail end of earnings season. And of course, as we hit that tail end, we are also keeping an eye on these markets for you as before we let you go, because we are looking at that NASDAQ 100, trying to maintain those gains for the day. It has been a volatile morning, but we are back up to 1% worth of gains on that NASDAQ 100. Really, the leaderboard here, the Russell 2000 losing its gains, though, on the day, and the S&P 500 up, but less than you're seeing in big tech. The semiconductors getting some relief, a nearly 3% rise, now at 2.8%, and you're looking at that bid come back into the market. The dip buyers are on the sidelines and hopping back in. That does it for Bloomberg Technology, though, today. Don't forget to check out our podcast. You can find it on the terminal and on Apple, Spotify, and iHeart. This is Bloomberg.
Gold standard, gold dust, pot of gold, solid gold. You're worth your weight in gold. Golden boy, golden girl, golden goose, golden egg, golden age, golden ticket, golden opportunity. Is it just me or is there some kind of clue here? I don't know.
Oh, and T, you can't put that right in the dishwasher.
Watch me. With Cascade Platinum Plus, I have upped my dish game. I just scrape, load, and I'm done.
In that dishwasher?
In that dishwasher.
Only Platinum Plus is packed with more Dawn to remove up to 100% of grease and food residue, breaking down food so small it flows cleanly through the filter. Our highest standard of clean, even in your machine.
Clean enough for you?
Yeah.
Scrape, load, done. Cascade Platinum Plus. No pre-wash, no rewash, or your money back.
What keeps baby's skin healthy? A diaper that doesn't leave skin wet.
That's why Pampers Swaddlers absorbs wetness better for up to 100% leak-proof protection and 0% skin irritation. Pampers, for healthy baby skin.
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Daddy, that man, he looks like a...
Congrats, that's huge.
Wow. Late bloomer. Catch up before the new season, April 11th, only on Crave.
Hi there, welcome to Commodities. Let's check in on the energy complex first, as ever. Now, we got some data out of the United States that did encourage the oil bulls, oil moving towards $68. There were numbers indicating that U.S. domestic demand for gasoline is pretty resilient right now, despite the worries of economic dislocation because of Trump's tariff war. Meanwhile, U.S. consumer prices rising at the slowest pace in 4 months last month. That is after several months of worries that progress in fighting inflation was stalling. And of course, that could, the decent inflation number in February could encourage the Fed to reduce interest rates, and that's seen as good for growth. Gasoline demand in the United States topping 9 million barrels a day, the highest level since November. There was a build in oil inventories of 1.5 million in the U.S., but it was smaller than had been projected by at least one industry survey. Political story here. The Environmental Protection Agency says it will reconsider that so-called endangerment finding on carbon dioxide that came through under the Obama administration. And Bloomberg says this could dismantle the legal foundation for sweeping climate change rules. This was a 2009 determination that CO2, methane, and 4 other greenhouse gases threaten public health. But if that is discounted, the agency could roll back regulations limiting pollution from power plants, autos, and oil wells. Let's have a look now at the metals. We didn't see that dramatic a reaction in metals prices. Maybe we can have a look at aluminum in a second. It looks as though Trump's move on tariffs, which kicked in today, the 25% levy on imports of those metals into the United States, had already been discounted in the market. And there you have it. Thanks, control room. You have aluminum, little changed, up 20% in the past year. But of course, North American trading has been distorted, certainly in gold anyway. There's been a rush to move metal into the United States in advance of tariffs. And there is gold up and not far off record highs. And finally, let's have a quick look at the agricultural commodities. There was some weakness in corn, and there are concerns about demand for that cereal in China amid these trade wars. So we saw some pressure on corn. And of course, the Chinese are set to slap a tariff on Canadian canola as well. And that's some years that's the country's most important crop. Here are some other commodity-related stories we're bringing you from the BNN Bloomberg newsroom. Still on canola, Canadian farmers are planning to plant more wheat and less canola this year. Data from StatsCan indicates that farmers forecast planting 27.5 million acres of wheat. Due to strong global demand, that would be up almost 3% year over year. However, canola is expected to decrease due to lower profitability relative to other crops. And let's check in on shares in Algoma Steel. That stock up about 4% today, but it has been sliding lately. As expected, the company has paused exports of steel from Canada to the U.S. until Canadian ministers meet with our U.S. counterparts. The Algoma CEO, Michael Garcia, who joined us on BNN Bloomberg yesterday, says tariffs on U.S. steel will give the company the opportunity to acquire new customers in Canada. Now, remember, Garcia told us that Algoma is looking at redirecting as much of its business as possible to the domestic market. Shares in Peyto Exploration up about 4%. That natural gas specialist reported profit in its latest quarter that beat estimates. Overall production was up 11% year over year. Now, Peyto notes that the majority of its natural gas contracts that are tied to the U.S. are actually physically delivered within Canada, and it says those will not be exposed to U.S. tariffs. And the company also says it sources most of the materials for its operations domestically. Let's get more on this tariff war in metals. Trump's tariffs, 25% on steel and aluminum, came into effect today. European Union and Canada immediately hit back. So we got this global trade war in metals worsening. Let's get more from Joe Doe, Bloomberg's metals and mining reporter. Joe, give us the latest here. I know it's early days, but it's going to be disruptive for industry, isn't it?
Right. I think we're probably already seeing some disruptions. I mean, I'm already hearing of customers, middlemen in the markets who are already talking about having to change some of their supply chains, change the way shipments are going. It's going to take a while for these things to really bear out in the market. So I don't think you're suddenly going to see tomorrow like a massive shift of a company in the way that they're shipping or receiving metal. But you are starting to hear of anecdotes around the market of these things happening. And listen, it makes sense, right? Before now, a lot of the tariff talk has been exactly that, just talk. But as of 12:01 a.m. this morning, we now have 25% tariffs on steel and aluminum, all steel and aluminum coming into the United States. And that's the law of the land.
And companies have been responding. I see the Wall Street Journal today is talking about the Ford F-150 truck. The price of that could go up something like $400 US, apparently, in America because of higher metal tariffs. But apparently Ford has been trying to snap up supplies of metals.
The concern for automakers and beverage companies, packaging companies, we've heard them in the lead up to these tariffs, and they have been telling their investors, listen, if these tariffs come into place, and they weren't just talking about steel and aluminum, but they were also talking about the Canada